Good morning, everyone. Let's start our advanced accounting marathon. Small, simple, small day we are going to have. Okay. So non-AS or the heavyweight chapters is what we are going to discuss today. Let's start with the heavyweight chapters. So you know the weightage of the heavyweight chapters. At least from the past 3 exams, we know what the pattern is. Okay, they follow a particular pattern where amalgamation, consolidation are always there. Okay, and internal reconstruction, 2 out of the 3 attempts it is asked. In the last 3 attempts, out of 3, 2 they have asked internal reconstruction, and financial statement also they have asked once. Cash flow is like there both the places. MCQs also in descriptive also. Then that should be it. And branch accounts also regularly they are asking. So this is how it works. Now, what we are expecting today? Marathon, yes, obviously. You have to study and come. I hope you have studied and come to the marathon. Okay, so it's only revision that we are going to do, and we are going to look at all those problems which are not nice. Are you getting my point? The nice questions we are not going to see. All the tricky questions, all the irritating questions, all the questions which you thought that let's go to the next one. Okay, those questions only we are going to focus on today, and that don't keep any end time in your head. Okay, just chapter by chapter we'll keep going further. Okay, and target is you need to score high in advanced accounting. Okay, because when your first exam goes well, automatically the confidence level goes up. Okay, when your first exam goes fine, no, that confidence will get shifted to law and then to tax. Then even if any exam is actually a little tricky or irritating, you are already on good confidence level, so it will automatically like rub off. You'll be able to clear. Okay, so do well in the first exam. See, other exams there is one additional challenge, that is revising everything in 1.5 day. Revising everything in 1.5 day challenge is there for all the other exams. Advanced accounts is the only exam where you don't have that. But advanced accounts, obviously everyone will be doing 5 days, 6 days, last 6 days they'll be doing only accounts. Okay, but it has a different kind of challenge. That is the first exam pressure. New environment, we don't know where the exam hall is. Okay, we don't know where our bench is, where we are going to sit. Okay, so searching that, reaching there, all that creates you'll be in a new environment. So maybe first day you can go little 5-10 minutes early. Okay, too early is also not good, because if you go too early, then you'll start talking to others in the exam hall, and whatever they tell, you'll be tensed only. Okay, so we don't want that to happen. Too early you don't go, because it's better to avoid talking to anyone before and after exams. Before exams also go straight to your place. After exam also go straight to your house. Okay, don't go to talk to anyone. Okay, because whatever they tell, good, bad, we don't know their intention, but good, bad, whatever they tell, you'll be under stress only. It's not going to make you feel better or something. Okay. Especially before exams, if they ask something and that is not what you revised in the last 3-4 hours, then you will get that urge to go and see it. And if that time bell rings and you don't have enough time to go and see it, now you are like stressed. You are like, oh, I should have seen that at the last moment. And imagine that chapter only is asked first question over. Your tension level has gone to some other level only, and because of that, you will not be able to be at your best. So accounts always has that challenge, that first exam pressure you need to handle. Okay, so go early, sit in your place, just close your eyes or whatever meditation, prayer, whatever you believe in, you do it, so that you're adjusted to that, and then once they ring the bell, they give the papers, focus. And in case in that 15 minutes reading time, if you feel that your heart is beating fast or you're still under pressure only, don't read. I feel don't read. It's better to not read in pressure. Okay, sit quietly. Just sit quietly for 5 more minutes. Spend 5 more minutes. See, anyways, in 15 minutes you're not going to read the entire paper. If you read the entire paper also, before solving again you'll read the question. So if you are under stress, then spend 5 more minutes on just like breathe. Okay, get your breathing to normal. Then you start reading. Anyways, 1 or 2 questions which you're going to surely start with. Focus on that and attempt. Read that properly, so that as soon as the answer paper you're allowed to write, first question you should go in top speed, so that you do it in earlier than what time you actually spend on other questions. and then rest of the things 30 MCQs are all obviously there. MCQs, try to finish 30 in 30 minutes. It makes your entire job easy. 30 MCQs in 30 minutes, 30 marks in 30 minutes. There are no 30 questions actually. Only 15 questions they are asking off late. So try to finish that. It makes a huge difference, because usually for attempting 30 marks in descriptive, we usually spend around 1.8 minutes per mark. So that goes to around 45, 48, something like that. So you are actually taking less time, so that you can spend that on other things, because amalgamation is also lengthy, consolidation is also lengthy, internal reconstruction is simple but still lengthy only. It is so many journal entries and so many narrations again, and if they ask again balance sheet, there again some time. Okay, so all the heavyweight chapters will take time, and you have to develop that speed. Okay, when you are solving at home and all, you should develop that speed. If you are writing a mock, okay, at home, at the academy, wherever you are writing a mock, your target is to finish advanced accounting in 2 hours 45 minutes. No 3 hours. 2 hours 45 minutes without taking the reading time. Put yourself under tougher situations in mock. Okay, there you will get 15 minutes reading time, so you can plan, the strategy can be planned, and you will get 15 minutes extra. So you think that your mock is from 2 to 4:45. Don't even think that it's from 1:45 to 5. Reading time you don't give. Straight away, time starts, you start reading the paper that time, start writing the paper. If you can do that in 2 hours 45 minutes successfully, then in the exam you'll be able to complete the paper. In mock, you're putting more pressure, so that there, whatever additional pressures are there, that will get nullified with the extra time. Okay. So let's begin, guys. We should start with buyback. Okay, let's begin with buyback. From buyback, we'll go to amalgamation and so on. A small chapter which can be asked in the exam. If it is asked, you should be very happy, because scoring. But there are some additional concepts also, which is not actually part of the chapter, but still part of the chapter. Okay, not there, but there, like that. Okay, so we'll start with buyback. What is buyback, guys? Company purchasing its own shares from the market. You go and purchase own shares from the market. What shares are they talking about over here when you're talking shares? They're talking about equity shares. Why are they not talking about preference shares? Because for preference shares, you already have a concept called as redemption of preference shares. Clear? So company purchasing its own shares from the market to be cancelled by the company. What does it mean? That means I purchase the share from the market. I cannot go and issue it back. This is cancelled. If I have to make a issue again, it becomes a fresh issue. It becomes a fresh issue, and fresh issue goes through the same process. You have to issue prospectus and so on. Same process you have to follow. It is not like you buy it, keep it, after 2 months again sell it back in the market. You can't do that. That means company cannot trade in its own shares. Okay. Share capital to reduce. Obviously, if you're doing buyback, share capital will reduce. Now, objectives of buyback. Why company goes into buyback? Increase the earnings per share. Okay, they want to increase the EPS. More number of people. Okay, less people. Okay, more dosas is always better than more people, less dosas. Correct? So increase the earnings per share. Usually promoters, they want to send outsiders. They want to send the outsiders. They got the outsiders because we are doing expansion. So now we want to send them. That's why when company is doing good, they automatically, to increase EPS, one of the things is buyback. Increase promoters holding. This is what I was telling, sending the outsiders away. Okay. To discourage outsiders making hostile bid for takeover. What is it? You are the promoter. You realize that some outsider is there who is trying to take shares from lot of people in the public. Okay, making purchase so that he can increase his control, and then the promoters will be in trouble. So to discourage outsiders. So what you do? You tell the outsiders, you want to sell, I'll give you a premium price. Come to me only. Come to the company itself, I'll give you premium price. Clear? So that anybody cannot take control of our company behind our back. To increase the share price in stock exchange in a depressed market. Market is like right now, market is down. So when you do buyback, what happens? Quantity reduces. When quantity is less, automatically the price will go up. So you can do that in a depressed market. To pay surplus cash to shareholders. You have extra money. Okay, you have extra money. People want exit. Okay, nowadays in this era of Shark Tank and all, you hear, no? That people want, they will invest, but they don't want to be forever. Like how you learnt in your business studies. People may come, people may go. The company lives on forever. Okay, the shareholders don't want to live forever in this company. They want to invest. They want to get returns, 3 times, 4 times returns. Then they will take exit. So to pay surplus cash to the shareholders. If you have extra money, pay to the shareholders. Now, conditions for buyback. Buyback out of what? Okay, out of your reserves, free reserves, out of securities premium. Can you use securities premium for buyback? Yes. And proceeds from fresh issue of shares. You issue fresh shares. Okay. Equity for equity is also possible, but usually in exam, it is preference for equity. So proceeds, fresh issue you do, get money, use that for buyback. For buyback, preference shares must be issued. Okay, usually. But actually, if you go legal, it's possible. You know, there is one concept in law called as issue of shares, differential voting rights. So that is possible here, but they are not testing you on that. Okay. Buyback must be authorized by articles. What is articles? Like a rule book. Okay. There the power should be there for buyback. Now, authorization. Okay. First the power should come from here. The power is there. Then we go into who can go ahead with buyback. Okay. Buyback up to 10% of paid up share capital plus free reserve. Board resolution is enough. That means first power should come from the articles. Once the power comes from the articles, up to 10% board resolution is enough. Okay, more than that, automatically you have to go to shareholders only. Special resolution is required in a general meeting. Clear? Now complete the buyback within 12 months. Okay, you give the offer. Buyback, is it compulsory, guys? Is it compulsory? I'm telling, I'm buying back your share. You have to give it. No, I give an option to the shareholders. Now that's why if at all the market price per share, let's say is 50. If I offer at 50, nobody will be agreeing. If I offer at 40, they'll not even listen to me. So I will give something higher, 60, 70, 80, something like that, so that I can induce the shareholders to give their shares. So it's an option. Okay, completed within 12 months. Extinguish shares within 7 days. What is this? Cancel. Okay, cancel the shares. Maximum buyback. Maximum buyback. We have 3 tests. Okay, in exam you can get 2 types of questions. One, in the question only they will tell you company wants to buy back 25,000 shares or company has decided to buy back 25,000 shares. Another, company wants to buy back, please tell according to Companies Act whether it is possible. If it is possible, go and pass journal entries. Clear? So maximum buyback is 25% of shares outstanding. This is called as share outstanding test. Whatever number of shares are there, 25% you are allowed to buy back. Okay. Then second one is called as resource test. What is resource test? Maximum buyback is 25% of paid up share capital plus free reserves plus securities premium. Not just this. Remember, you have to include even securities premium when you are calculating resource test. Okay. Then this is the most important of them all. For the first 2 tests, the numbers will be there in the question itself. You pick the number, multiply, you will get the value. Okay. Now, debt equity ratio test is post buyback. After buyback, you should have 2:1 ratio. 2:1 means what? Debt should be more or equity should be more? Whatever debt is there, half should be equity. Clear? So debt equity ratio test, minimum half of debt. Clear? Debt means what? Long term plus short term. Now exams, they can just tell current liability in the balance sheet. Now do you include this for debt equity ratio test or not is the question. You can go both ways. They just told current liabilities. They said short term debt. In current liability, everything is not debt. In current liability, you have trade payable. Current liability, you have short term provisions. Are you getting my point? And in current liability, you have short term borrowings. So this is what we require over here. Are you getting my point? If they only tell current liability, then you can actually ignore the current liability and focus on that also. ICAI also in their suggested answers, they give both alternatives. Okay, when they tell current liability, they are keeping the option guessing, right? You don't know what is in it. If they tell current liability and then they give you notes to accounts, then you go and see in the notes what is there in the current liability. Is this clear? Otherwise, you can only focus on long term if they don't tell you. Now, shares must be fully paid up. What does it mean? Partly paid up share. You have not done your work only, no, fully complete it. Then you are going to go ahead with buyback. So, exam, there is a question where they tell you equity shares of 10, rupees 6 paid up. What will you do? Equity share of 10, rupees 6 paid up. What will you do? Are you going to ignore the question telling that partly paid up shares buyback is not possible? End. 7-mark question. Done. Finished in 1 line. Can we do that? No, right? So first you make the final call. collect the final call amount, make it fully paid up, then go ahead with buyback. Clear? Then you can't buy back. Now, for example, they only will tell the call is made on 1st April. On 25th April, all shareholders except one person holding 100 shares. Now that 100 shares you cannot do buyback. Focus on the others who have paid fully. Okay, shares must be fully paid up. Only buyback is only one buyback is permitted in a year. Again and again you can't do it. Okay, that also makes sense. After buyback, no fresh issue in next 6 months. These are all company law points I have put. In case they ask in MCQ, you should be able to answer that. Okay. Exception is bonus issue is possible, because bonus issue you are utilizing the CRR and all, it is possible. Okay. ESOP is possible. Already there are convertible debentures. Now you can't tell them 6 months I am not going to convert your shares. They have the right from before itself. Okay. And convertible preference shares as well. So for these people, this rule does not apply. What is this rule? After buyback, no fresh issue in next 6 months. For these people, that rule is not there. Okay. Now CRR. You have seen CRR. You will see CRR only in 2 places in accounts. 2 places. Not utilization. Creation of CRR. Creation of CRR happens only in 2 places. That is when the share capital goes down. Okay. Not the share capital going down in internal reconstruction. Share capital going down. CRR will be created in redemption of preference shares and in buyback of equity shares. Redemption of preference shares and buyback of equity shares. Now, how much CRR, sir? Journal entries and all we'll discuss, but how much CRR should I create? Always, just remember, always, whatever might happen, but it is face value minus face value. Whatever might be there in the question, that is required for passing journal entries, but it is face value minus face value. See over here, face value of equity shares bought back minus face value of preference shares issued for the purpose of buyback. This is very, very important. Now, what students make mistake? There will be one balance sheet given in the question. In that, equity share capital is also there, preference share capital is also there. Then like, oh, preference shares are issued. This minus this, I will do CRR. No, those preference shares, we don't know for what they issued, when they issued. Are you getting my point? So only the preference shares which are issued for the purpose of buyback. In buyback chapter, either they will tell you in the additional information that preference shares are issued, or in the balance sheet given, they will tell in bracket that these shares were issued in the last 12 months for the purpose of buyback. Those things only are going to subtract. Other than that, you are not going to subtract any other preference share capital which is there in the question. Clear? So this is very important. Okay. Not only to write, also to remember when you are doing the calculation. Now CRR can be used only for one thing that you know, that is for issue of bonus shares. So automatically, you know, if buyback happens, CRR can happen, and if CRR can happen, they can put bonus issue point also in your question. Sir, bonus issue is not there in our syllabus. Yes, but still they can ask. ICAI things, just ICAI things it is. Okay, ICAI removed bonus issue was there before in Inter only, old scheme. They removed bonus issue, they removed redemption of preference share, they removed redemption of debenture. All three went into foundation. It went into foundation. But you know ICAI, right? They don't spend too much time on creating new questions. Study material remains same. So earlier there were merged questions. Now also there are merged questions. Now you have to study it. You have no other option, because ICAI again will do copy paste in the exam also. Take from here straight into the exam. Okay. It's, see, basically I'm telling you, concepts are there. Yes, 100%. When we are in regular class, I keep telling you have to learn concept, you have to learn concept. Now when you have limited days left for the exam, no, it's a data game. It's a data game. You cover the ICAI database, from there only somewhere the question will be there. Okay. But obviously without concept, that data game won't work. So that's why you have to learn the concepts. Basically you have to study everything. Yes, there is no other option. Okay. So CRR can be used only for one thing, that is bonus issue. Now let's go into journal entries, guys. Journal entries, obviously don't know by hearting journal entry and all, like how we did in 11th and 12th. Oh, share issue 8 entries, done, finished. Share forfeiture 2 entries. Okay, that one we are not going to do. Okay, due entry. First the due entry. If it is issued at par, if it is if it is bought back at par. Okay, bought back at par means what? Okay, what does it mean? Is it even possible? It's very, very rare. Okay, see over here, equity share capital account debited to equity share buyback. Hypothetical situation. Face value will be here. Market price will be somewhere here. Now you are going to buy back at this face value. Nobody will even think about it. But if they ask question, you should know what to do. So equity share capital debited. Why share capital goes? When share capital reduces, what will you do? Debit it. And equity share buyback account. This is like a temporary account you're creating, because the day you announce will not be the day you are going to pay. In exam, it might be there. Same. On 1st April, they completed everything. It's not possible. Okay. So first you pass the due entry. Then if it is at premium, equity share capital debited. Always equity share capital, there is a golden rule. What is that? Entry and exit will always be only face value. Entry into equity share capital, exit from equity share capital, face value only. So now you are going to pay more. Imagine I'm going to pay for 10 rupees share, I'm going to pay 80 rupees. So equity share capital debited 10 rupees. You're going to pay extra. That is premium on buyback. It's an expense. It's a loss. Debited for 70 rupees. To equity share buyback account 80 rupees. Clear? This is the normal situation. Always buyback will be at premium only. Okay, 99% of the time. Payment entry. You're going to pay money to equity share buyback. The temporary account which you created gone. Okay, to bank account. Money also gone. Is this clear? Next, premium transfer. Premium, I told you over here, it's a loss. Correct? Premium is a loss. Loss should be adjusted with profit. Now, can I write, I didn't like this here. Can I write, when I have securities premium, can I write general reserve and P&L? I have securities premium. I can write actually, but securities premium has only 5 uses. Now in that, when you are getting an opportunity, use the securities premium. You might not get an opportunity. General reserve and P&L, they have unlimited use. They are called as free reserves. You can use it for anything, anytime. Correct? That's why when you have securities premium, utilize securities premium. So securities premium debited to premium on buyback. Okay. Next, CRR creation. How much CRR to create? We already discussed. Now CRR creation will be general reserve P&L account debited to CRR. Is this clear? Now, additional entries. Whenever you want to do buyback, additional entries. First, you might have a situation that investments are sold. We don't have enough money. So first we'll sell our investments. When you sell investment, what will you get? Money. Bank account debited. Bank account debited to investment account. If sold at profit, credit P&L. If sold at loss, debit P&L. End of story. Just like any other, it has nothing to do with buyback concepts. If you sell investment, what entry you will pass? Any chapter, that is the entry you are going to pass here. If equity shares are issued, that means that we saw, no? Buyback is possible by issue of shares also. If equity shares are issued, bank account debited to equity share capital to securities premium. If you issue extra, at higher value, securities premium. Debentures are issued. Again, arranging money, all these are sources of arranging money. Bank account debited, percentage. There will be some percentage given in the question itself. Percentage debentures debited to credited to securities premium. Basically, rule applies here also. This will always be at face value. And this will always be at face value. You cannot put higher amount over there. Higher amount will always go to securities premium. Clear? Redemption of preference share. This is not there, but still there. Are you getting my point? It's not that. There are questions where they have included redemption also, so you have to know it. If you know buyback, redemption is just like mirror image, changing some keywords, that's all. Okay, due entry. Preference share capital to preference shareholder. If it is redeemed at par. In buyback, what was it? Equity share capital to equity share buyback account. Clear? Now here, if it is at premium, preference share capital debited, premium on redemption of preference shares debited to preference shareholders. Same thing there. It was equity share capital debited, premium on buyback debited to equity share buyback account. Now, payment entry. Whom are you paying here? Preference shareholders. Whom did you pay there? Equity shareholders. So here it's going to be preference shareholder account debited to bank account. Okay. Premium transfer. Premium transfer. This is one crucial area where there is a difference. There you wrote securities premium, right? Here P&L account debited. Actually here also securities premium is possible, but for not all companies. So to avoid conflict, what ICAI has done, written in one box nicely that we will use only P&L for all this. So always just use P&L. Redemption of preference shares, P&L only you use. Don't make the mistake. P&L account debited to premium on redemption of preference shares. Do not use securities premium here. Buyback, use securities premium. But redemption of preference shares, use P&L. Clear? Can you use securities premium? Yes. But we don't know which the company falls into which category. So ignore it. Let's not overcomplicate. CRR creation, I told you, it happens in 2 places. Buyback and redemption of preference shares. Okay. General reserve P&L account debited to CRR. How much CRR to create here? Face value minus face value. Face value of preference shares redeemed minus face value of equity shares issued for the purpose of redemption. Difference amount, if it is there, you'll take it at, you'll create CRR. Clear? debenture cancellation. What is this? Redemption of debenture. What? Investing in own debenture. This concept was there in the topic called as redemption of debenture. And in redemption of debenture, when it got moved into foundation also, the investment in own debenture, they removed it. It's not there in foundation, it's not there in inter. But there are some old questions which they have transferred to study material where redemption of debentures happen. Now they are not going to ask you how to pass the entry for purchasing from the market. They will only tell you already there is own debenture, you are only going to cancel it. Okay, so the cancellation entry you have to know. What will you do? Debentures are gone. Debentures are a liability. If you are going to cancel, debenture account debited. You can cancel it at higher value or lower value. So you can have loss on cancellation or you can have profit on cancellation. Now you see, face value of the debenture is 100. I had purchased the debenture at 102. That means I paid more money, no? So obviously, what is it now? Investment went 102. Liability went 100. So 2 rupees is loss. This is possible, but very rare. If it is trading at a higher value, I might not go and buy back my debenture or purchase my debenture. But if face value is 100 and debentures are right now at 98, I purchased at 98. That means this is profit on cancellation. Clear? Now, profit or loss on cancellation obviously will be transferred to P&L. Now, ESOP is again a topic which is not there, but still there. Okay. It is there in the study material itself, not old RTPs. Old RTPs means we would have skipped it because now they cannot ask that. But in study material question only ESOP is there. So now what you will do, ESOP, issuing ESOP and all that concepts are not there. Okay, don't worry about that. That's a huge different area altogether. Only exercise of ESOP they will tell you. Exercise of ESOP. What is ESOP, by the way? Quickly we'll discuss. Employee stock option plan. So company is giving options to employees that you can, if you stay in my company for some time, vesting period it's called. If you complete the time period, you can purchase the shares. I will give it to you at a little lesser price than market. So now imagine the market price of the share is 50, but I'm giving to my employee at 20. That means the 30 is a loss for the company. That falls on company's head, correct? So now employee will give 50 or 20. Employee will give only 20 to me. So bank account debited for exercise price. That is this 20. Bank account debited for exercise price. That is this 20. I already know from starting only know that this fellow might exercise the option. So 30 I would have made arrangement for it. It would have been on my liabilities. Provision would have been created. So ESOP outstanding debited, market price minus exercise price. That is the 30 we are talking about. Clear? 2. What are we giving them? Shares. Equity share capital, always face value. Here you won't go and put 50. Always face value only 10. 2. Securities premium. Whatever the extra amount is there. Market price minus face value. Is this clear? This ESOP exercise also can be asked in the exam. Now, bonus issue also can be there. Again, not there, but there. Okay. CRR got created. They can tell 15 days later, we are going to issue bonus shares. For bonus shares, first one due entry, one issue entry. Clear? What we are going to do in, due entry. Due entry, you are just going to take the money, keep it aside. Take the money, keep it aside. From where will you take money for funds for bonus? First preference is CRR. Why? CRR has only one use. If you don't use it now, you might not get an opportunity. CRR one use, so CRR account debited. Then securities premium. Securities premium has 5 uses. So next what will you do? Take from securities premium account debited. Then after that you can use general reserve or P&L. Either of them you can interchange and use. But general reserve usually will be used because it's older profit. So utilize it first. 2. Bonus to equity shareholders. This is the due entry. Why again due entry? Because on the day I announce the bonus, I will not make the bonus. Correct? I announce it on that day. We follow accrual concept, pass the entry. Then on the issue date, bonus to equity shareholder is debited and we give them what? Shares to equity share capital. Face value. Clear? Yes. Now, note. For debt equity ratio test, there is one debt equity ratio test which we discussed. You have to form equations. There is a shortcut method, but you have to form equations. You have to remember your X and you have to remember why you did it also. Okay, so form equations. Now, X is maximum amount available for buyback and Y is amount transferred to CR. Clear? Once you see that equation in one question, no, every question, the equation formation is same. There won't be any twists and turns in the equation. Clear? This, forget it. I have already picked the questions. So that's it with Buyback, guys. You're coming out of the exam hall like this. Okay. We don't know what to do. Running out of exam hall. Yes. Buyback. First question is a study material question. I don't think there are too many questions from buyback. Only 2 questions I have picked from buyback. With that, we should finish buyback. Okay. First question is a study material question. Let's focus on that. Okay. Now, Extra Limited furnishes you with the following balance sheet as at 31st March 2021. They've given the balance sheet rupees in lakhs. Now, can you see the share capital, reserves and surplus over here? Obviously, notes are there. You need to see what and all is there in that share capital. Long-term borrowing. Can you see? Under current liability, specifically they have told trade payable. That means in current liability, there is nothing that is going to affect your debt equity ratio test. Okay, long-term borrowing. Then property, plant and equipment, non-current investment and cash equivalent. Let's see the notes. What is there in the notes? We have equity shares also. We have redeemable preference shares also. Anywhere did they tell you that this is issued for the purpose of buyback? No. Till now they have not told, so you are not going to bother about subtracting that when you are doing buyback. Reserves and surplus. You have capital reserve, revenue reserve and securities premium. Okay, out of this, can you use capital reserve anywhere? No, usually we refrain from using that. Revenue reserve can be used, securities premium in some places can be used. Okay, now company redeemed the preference shares at a premium of 10% on 1st April. First, what is happening? Preference share redemption. Preference shares was at what value? 20. So what you will pass the entry? Preference share capital account debited. Premium, you are going to pay 10% extra. Premium on redemption debited to preference shareholders. Next, what is the entry? Payment entry. Preference shareholders account debited to bank. Done. Okay. Do you have a premium over here? This premium, what? Can I use securities premium? Can I use securities premium? No, I think somewhere at the end only they are passing that entry. See, just ICAI things. Telling in the box not to do it, then they are doing it. Okay, telling in the box not to do it. 8 out of 9 questions not doing it and 1 question doing it and then creating full confusion what to do in life. Are you getting my point? So I told you, that's why I told to stay on the safer side, just avoid using securities premium. Okay. Now, after that, the first thing is done. What did they tell after that? It also bought back 3 lakh equity shares of 10 each at 30 per share. The payment for the above was made out of huge bank balance. That means money, there is no problem. You can see the current assets over here. Cash and cash equivalent is there. Okay. So now, how much is the equity share capital? 100. 100 divided by 10 means what? 10 lakh shares. How much are we buying back? 3 lakh. Again, just ICAI things. It's not possible only to buy back 3 lakh. Why? Maximum permissible buyback share outstanding test 25%. Maximum permissible buyback share outstanding test is 25%. 10 into 25% if you do, you'll get 2.5 lakh shares. Here they have told 3 lakh shares. Just ICAI things. Please go and do what they asked. Okay, let's not do extra thing. Let's not pass all journal entries for 2.5 lakh and give a note that it is not possible only. They have told 3 lakh. You write like that only. Okay. I don't think they'll make the same mistake in exams, but if at all. Okay. So 2.5 lakh shares we are buying back, but at what price? 30 per share. So what we are going to do now? Equity share buyback. Okay. 3 into 30. See. No order, nothing. Payment first, due next. Okay. Okay. 30 into 10. Equity share capital gone. You're paying extra 20 rupees. 30 into 20. You should have written premium on buyback. Then you should have adjusted it with securities premium. Okay. They have merged 2 steps over here. And equity share buyback 90. And buyback to bank payment entry. Clear? Now you have to create CRR. How much is the face value of the equity share which is bought back? 30. I mean total 30. Correct? Did we issue any preference share? No. What was there only we redeemed. We did not issue any preference share. So 30 minus 0 is 30. But here there is one redemption of preference shares also. So 20 minus 0 is 20. So 30 plus 20, 50 we have to create CRR. We have revenue reserves, nothing to worry. Revenue reserve is general reserve and P&L. Any of them you can take it as. Okay, 50. So what will you do? You'll pass the entry revenue reserve account debited to CRR. Clear? Next, after that, there is also debenture cancellation. Included in its investments were investment in own debentures. You have investment in own debentures costing 2 lakhs. So you purchased it at what? 2 lakhs. But face value is how much? 2.2. That means your liability, you paid only 2 and you bought it back. Correct? That means you will have 0.2 profit on cancellation. Clear? You can check out over here. 10% debentures debited to investment in own debentures to P&L, that is profit on cancellation. Okay. Next, company had 1 lakh equity stock options outstanding on the above mentioned date to the employees at 20. Employees at 20 means what? Employees at 20 means what? Employees can buy it at 20. That is exercise price. They can purchase the shares at 20 when the market price was 30. That means 10 rupees is going from company's pocket. Clear? This was included under current liabilities. What is this? ESOP outstanding. The 10 rupees which we have kept aside, that is there under current liabilities. Okay. On 1/4/2021, employees exercise their options for 50,000 shares. So you don't worry about this 1 lakh. 1 lakh options were there. We are only worrying about what is exercised. Okay, 50,000. That is basically 0.5 lakh. Everything is in lakhs. So 0.5 lakh. Clear? So when you exercise the option, what will you get? Money. You won't get bank. You'll get only money. Okay. So bank account debited 0.5 lakh into how much will you get? 20. You'll get 20. Not 10 rupees. 20. They're going to pay 20. 10 rupees is going from your pocket because the price is 30. So 0.5 into 10. Can you see employee stock option outstanding? Bracket current liabilities. Why it was included in current liabilities? 5. You already made provision for this. 2. What are you giving them? Shares. Can I write 0.5 lakh into 30? No, only face value. 0.5 into 10. Equity share capital. 2. Securities premium. Extra 20. 0.5 into 20. Which 20? Sir, this 20 and this 20 same. Huh? Whatever number comes here, that only I should put over here. Huh? No, it's just a coincidence here. This is the exercise price. What is this? This is the difference between what is the market price and what is the face value. In this case, it is just coincident. That's all. Okay. Now, after that, what you're going to do, premium. This we already discussed. Okay, that is it. Balance sheet preparation. You shouldn't have a problem. How much was there in the balance sheet before? You can see 120 share capital. Out of that, preference share gone, no? Preference share fully gone. You won't have this preference share. Out of this 100, 30 went, no? So the share capital should be 70. But how did it become 75? ESOP. Don't forget the ESOP. ESOP also you just pass the entry to equity share capital 5. So this became 75. Clear? Now reserves and surplus, if you see, capital reserve is still there. Revenue reserve went. Okay, securities premium also they have removed something. So balance is your reserves and surplus. Basically balance sheet preparation shouldn't be a problem. See the old balance sheet. See your journal entries. This minus this will give you the new figure, or this plus whatever you have added will give you the new figure. Clear? After that, what do we have? Long-term borrowing. How it became less? Because when we cancelled debenture, the face value went. Okay, that is how it went down. How much was it before? It was 4 lakh. Okay, now it is showing 1.8. How is that? 2 lakh was the investment value. Face value of the debenture was 2.2. Clear? 2.2 lakh face value. I bought it at 2 lakh. That's why I got profit on cancellation. Okay, so 2.2 went from here. And other current liabilities, did we make any change to that? ESOP only went. We had kept one ESOP outstanding, right? How much was the ESOP outstanding? 5. Do you remember? Now actually current liability here they told trade payable. But there they told it's included. So now you have no other option. You have to call it as other current liability. You can't call it as trade payable. Just ICAI things. Okay. Next. PP and all, no change. Investment and all, we sold a little investment, I think, right? No, we did not sell. It's same. Okay, 118 it was. What went? We did not sell the investment. Sorry, the debenture got cancelled. 120 minus 2. The debenture got cancelled. And from debentures minus 2.2 because face value was 2.2. Is this clear? That is it. And then cash and cash equivalent. From where did money go? Where did money come? From where did money go? Where did money come? 142 was there. Correct? Preference share redemption. How much did you utilize for preference share redemption? Can you see over here? You have written 2 bank, 22. So 22 went. Buyback of equity shares. Buyback of equity shares you wrote again 2 bank, 90. 90 went. Then after that, ESOP. ESOP you wrote bank account debited 10. So plus 10. This should be your value. Clear? Let's have a look at it. 40. Clear? This is your first question. Notes, accounts, and all you know how to prepare. Will not stress on that over here. Okay, prepare the notes. Buyback question. If you have time, do it. But otherwise, only share capital and reserves and surplus. Focus on that much. Those two notes are must. You can't avoid that because changes have happened in that only. So don't skip those notes. Now let's go to the next question from buyback. This is also study material question only. Following is the balance sheet of Competent Limited. Following is the balance sheet of Competent Limited. You can see the share capital, reserves and surplus. Long-term borrowing is also there. In current liability, they have told other current liability. That means this is not considered for debt equity ratio test. They didn't tell short-term borrowing over here. Then you have PPE, other current assets. Clear? Now, in your share capital, what do you have? Only equity shares. There is no preference share only. Securities premium, P&L, revenue reserves. All the ones which we can use. Then debentures and unsecured loan. Oh, sir, unsecured loan is also this. This we should not use for debt equity ratio test. We should. Borrowing. They just told borrowing. They just told debt. Secured, unsecured, they didn't tell over there. Even short-term, long-term also they didn't tell. They just told debt in Companies Act. Clear? Now, property, plant and equipment, you have all these things. Company wants to buy back. What did they tell? Wants to buy back. They didn't tell that you are going to buy back. They didn't tell that they took the decision. Sir, how is it different from the previous question? See in previous question. It also bought back. They are telling you information. Do the journal entry part. That's all. Here they are telling their intention. They are telling they want to buy back 25,000 equity shares of 10 each on 1st April 2021 at 20 per share. What is the price they are willing to pay? 20 per share. Buyback of shares is duly authorized by its articles. Did we see that in that articles there should be power? It's there. And necessary resolution has been passed by the company towards this. That means whatever company law requirements are there, that we have taken care of. You worry about only the accounting part. Okay. The payment for buyback of shares will be made by the company out of sufficient bank balance available out of the part of as a part of current assets. Money is there. No worries over there. Comment with your calculations. Last question. There is no calculation because they have just told you to pass journal entry. Whether buyback of shares by companies is within the provisions of Companies Act. That means calculate maximum permissible buyback. Once you do that maximum permissible buyback, then what you're going to do? Then you focus on journal entries. If yes, what is if yes? If it is possible, then pass necessary journal entries towards buyback and prepare the balance sheet also after buyback. Obviously, it should be possible on in exam. If it is not possible, so many extra things are gone from the solution. Okay. Now, the problem is what here. Students make a mistake. Imagine my share outstanding test. I got 28,000 shares. My resource test. I got 29,000 shares. And my debt equity ratio test. I got 26,000 shares. What is the maximum permissible buyback? 26,000 shares. They'll go ahead and pass all journal entries for 26,000. Is it correct or wrong? 100% wrong. Why? That is the maximum permissible buyback. But they want to buy back only 25,000. Are you getting my point? There are other questions in the study material where they'll tell you company wants to buy back whatever is maximum permissible. So you calculate maximum permissible, pass the entry for that maximum. But here they told they want only 25,000. If your maximum is 26,000, you don't go and pass journal entries for 26,000. You are going to pass journal entry for 25,000 only. In case this number was 22,000, then also you'll pass journal entry for 25,000. No, 22,000 is the maximum permissible buyback. Then you can pass journal entries only for 22,000. Are you getting my point? Okay, whichever is less. They didn't tell in Companies Act that whichever is less. But if you have to follow all three rules, which number is less, that number only you have to take no. Yeah, because they want to buy back 25,000. They want to buy back 25,000. But what is the maximum now? 22,000 if you want to buy back. Clear? Now, we'll go further, guys. Question number 2. See, share outstanding test. 25% was the rule. Go and check how many shares are there. 12,50,000 is the value. That means 1,25,000 shares. 1,25,000 shares into 25%, 31,250. What was their intention? 25,000. What was their intention? 25,000. What is test 2? Resource test. In resource test, what happens? Paid up share capital plus free reserves plus securities premium. Okay. Take 25% of that. Now, if you see, paid up share capital is 12,50,000. Free reserves, this. And securities premium, this. So this plus this, whatever is there, 25% has to be taken. Can you see over here, paid up share capital, free reserves, Okay. And then even securities premium also they added in this only. Whatever is there over here, 25% is 781, 250. Sir, you cannot compare these two numbers, sir. Why you can't compare? This is quantity. This is value. Either you have to convert value into quantity or quantity into value. So what you will do, buyback price was 20, no? Divide by buyback price, 39,062 shares you got. Okay, this is the second test. But they want to buy back 25,000. Will still it is possible. Okay. Actual number of shares for buyback is 25,000. They are telling. Actually, there is this debt equity ratio test also. Debt equity ratio test is what? Whatever is debt, half should be equity. Whatever is debt, half should be equity. When now in future, because they are telling post buyback, after buyback they should be half. Now see over here, debt equity ratio test. Okay, loans cannot be accessed, that we already know. Loan funds secured. Remember we had loan funds over there. Now see what ICAI did. You have 1875, you have 10. 1875, 10. They took this 1650 also. 1650 is actually what? They told other current liabilities. If it is debt, it won't be there in other current liability. If it is debt, it will be in short-term borrowings. Okay, they have given alternative solution also. Okay, so now, just ICAI things, I can't do much about it. This is my loan fund. Half of this should be my equity. 2262 500. What is there right now? We already saw 31 lakh 25,000. Right now, what is there? Paid up share capital plus free reserves plus securities premium 31 lakh 25,000. Can you see 31 lakh 25,000? That means right now I have 3125. I want minimum this much. That means the difference can be utilized. The difference can be utilized. You have to follow X and Y. You have to form an equation over here. Actually, no. If you want to see what is the difference between this, can you give me the difference between this? 3125, 8 lakh 62,500. This is the amount that you can utilize. Okay. What is the buyback price? 20. Okay. What is the 10 rupees you have to put for CRR also? So divide by 30. What are you getting? What? 28,750. This is only verification. This you can't do in exam. Are you getting my point? Do you understand? Okay, I have this much that I can utilize. I can utilize that much, correct? I know that 20 rupees I require for buyback. 10 rupees I require for creating CRR. So total 30 rupees. Divide by 30, you should get the answer. But you have to form equations. You have to form equations. Okay, what you will do? X and Y. Wait, let me see if... Okay, I think I have not taken that part. Now what will you do over here? In this case, X is equal to... What did I tell in the concept? X is maximum amount available for buyback. How much do you have right now? How much do you have right now? We saw, no? 8,62,500. But can I use 8,62,500 fully? No. This is before CRR. How much is CRR? I don't even know. I will know what is CRR when I know how many shares I am buying back. So CRR will be taken as Y. This will be your equation number 1. CRR. We know X is what? Maximum permissible buyback. X, if you divide by buyback price. What is the buyback price? 20. Multiply into face value. That time you will get your CRR. So basically this becomes, when you cancel, 2Y is equal to X. When you substitute. Okay, when you substitute, what will you do? X we already know. 2Y is equal to 8,62,500 minus Y. There it becomes 8,62,500 divided by 3. How much you are getting? 2,87,500. This is what Y. What is Y? CRR. CRR will be always at what value? Face value. Divided by 10, you are getting the same 28,750 shares. Clear? But you can't do the shortcut. You have to show the equations. Clear? Okay. But after doing it in equations, you can just check in your calculator. If it is verification, you can do. That's all. 28,750. Which is the least among this? 28,750. That means maximum permissible buyback is 28,750. Okay, sir, I will go and pass all journal entries for 28,750. No, I should pass it for 25,000 because that is what they want to buy back. 25,000. Okay, apart from that, there is nothing. Journal entries we already discussed in the previous question. If you want, you can just quickly, we can glance through it. See, equity share buyback account debited to bank account Don't do it. Please don't do it. First you pass the due entry. Okay. Equity share capital, securities premium, that is premium on buyback, to equity share buyback account, then the payment entry, then creation of CRR. CRR, you can see it is created for face value only, not the entire 5 lakh. Sir, how did they get 5 lakh? 25,000 shares and they want to buy back at 20 rupees. That is the 5 lakh. Is this clear? Done. Sir, at this speed, if we finish everything, we'll go so soon today, no sir? Buyback done, sir. Within 50 minutes, we finish buyback. At this rate, if you go, we'll finish everything. Correct? But we will not go at this rate. Only buyback happens very fast. Okay. Next, we will move on to amalgamation. The chapter which everyone loves. Everyone. Universal love is there for this chapter. Amalgamation. Yes. Amazing chapter it is. We'll see what questions we are going to solve and all that we will see later. Yes, Muttu. Your favorite chapter is here. Do you remember the days when amalgamation RTPs we were solving in the afternoon? All the RTP days, Muttu used to be active, giving the answers, finishing question fast. And they'll like, sir, next question. We'll go to next question. Okay. Amalgamation RTP days. I think it was 3 or 4 days. Amalgamation RTP days. Muttu. Just waiting for the day to get over. Because he can't leave also, no? He can't leave alone. If you know, you know. Okay. Yes. Too much roasting we can't do in marathon, but still little we can do. Yes. Let's start with amalgamation. Amalgamation. First accounting standard we are going to finish in marathon is AS 14. Small accounting standard. Even smaller than AS1. Correct? Even smaller than AS1. Yes. Now, amalgamation means what? Oh, amalgamation means amalgamation. Okay. What does it mean? Okay, 2 or more companies join to form a new company. 2 or more companies join to form a new company, or one company taking over another company. Absorption, amalgamation. General language. In general language, we tell absorption for it. But here, everything is included under the terminology of amalgamation. Merger. What is merger? One company merging with another company. But that is also covered under amalgamation only. Clear? Okay. Now, both are covered under AS14. We have discussed AS14. Amalgamation obviously will have one selling company and one purchasing company. Selling company is also called as transferor company, and this is also called as transferee company. Clear? Now, AS14 not applicable for selling company. Why? For person who is going, what rules will you tell? He is anyways going. Are you getting my point? He is closing his books and going. So no AS14 and all, just closure of books. What you would have done in dissolution of partnership also will be applicable over here. Just create realization account and close their books and send them. That's all. Clear? Purchasing company, person who is going to stay, follow AS14. Person who is going to stay, follow AS14. Sir, in exam, which one they'll ask, sir? Selling company they'll ask or purchasing company they'll ask? Okay? Both they will not ask. Then your life is gone. If they ask both, okay, closing the books, then again passing journal entries, preparing one new balance sheet, that will not happen. But we don't know which they are going to ask. So we are going to study both. Are you getting? In one question for 14 marks, it's impossible that they'll ask both. If they ask both also, it will not be complete. Realization account over there, new balance sheet over here. That is almost like both only. That is almost like both, no? Okay. Now, first thing, very, very important. Okay. See, amalgamation and consolidation, we are spending, doesn't matter what time it ends. Okay. We are going to spend a lot of time on the concepts. Maybe financial statement, I will not spend any time on concepts. Just run through that. Okay. We'll focus on problems to see what different adjustments they are asking and all that. But amalgamation, consolidation, we'll focus on concepts. Consolidation especially, we have to focus on concepts. Okay, otherwise we will not know how to consolidate only. Amalgamation, obviously we have to focus. Amalgamation has tough concepts and tough problems. Okay, consolidation, you have to learn the concepts. Problems are not difficult if you learn the concepts. Okay, if you learn the concepts of consolidation, it almost becomes like fill in the blanks later. Okay, now PC. Who is PC, Anada? Priyanka Chopra. Okay. Here people don't know Priyanka Chopra. In this part. Little less, right? Do you know Priyanka Chopra? Yes. Who is that person? Shah Rukh Khan's ex-girlfriend. Indirectly, yes. If you know, you know again. Okay. Recently, Shah Rukh Khan's old jacket was with Priyanka Chopra. Okay. Those gossips only we should watch on YouTube. Motivation and all we should not watch. And YouTube also knows as well. Once we watch over, then jacket, shirt, shoes, everything they will show. Yes, purchase consideration, very important. By default, you have to learn this properly. Clear? Whenever class tests are given, we have noticed that you mess this up. So early, how did you reach? Enter. Regular class 7:30. They're also late. Marathon starts at 8, just to give you an extra cushion. They're also late. Nice. If you would start at 9, still she would be late. Yes. Purchase consideration, very important, guys. Now see, students are like, sir, nothing to worry, sir. ICAI follows step-based marking system. Purchase consideration is the first step. Wrong? Chain reaction, everything wrong, go wrong. Correct? Finally, it will become hardly 14 mark questions. Some 2-3 you might get, that's all. I'm telling you. Okay, recently I was conducting some class tests, not here, some other class. I was conducting class tests. Class tests, you know, we don't like to give easy questions. Okay, I gave some tricky questions only. Everybody knows the process. Selling companies books, purchasing companies books, everybody did the process correctly. PC was wrong. Entire class, except 2 people, got 0. 0. PC goes wrong, there is a high chance that you will end up with 0. PC goes correct. After that, then you are creating error of commission, it is done. After that, if you make mistake after PC, are you getting this? So PC is very, very important. Every question you have to understand. What is PC? Purchase consideration. Amount payable by. This sentence will define lot of adjustments. Amount payable by. Again, we'll stress on this sentence when I go to the questions. Amount payable by. Purchasing company to. 90% of the people think that this is amount payable by purchasing company to selling company. That is why 90% of the errors are also made. It is not amount payable by purchasing company to selling company. Amount payable by purchasing company to shareholders of selling company. Shareholders of selling company. Are you getting this? So that means if the purchasing company is paying to the employees of selling company, not PC, it is not purchase consideration. It is settlement of liability. If purchasing company is paying to the debenture holder of selling company, not PC again, it is settlement of liability. Are you getting my point? Very important. Payable by purchasing company to shareholders of selling company. This is the most important thing. Computation obviously is important, but based on this, lot of errors are made by not understanding this one sentence. Clear? Okay, now how can you pay? You can pay in cash. Now, just because we have written over here pay in cash, that doesn't mean you are going to give cash. It means payable in money. That means you'll use bank only, company accounts, right? Do not use cash anywhere. Okay, do you want a raid later? No. Okay, bank itself. Payable in cash means money. Now, shares. Payable in shares. That means we are going to give the shares of purchasing company to shareholders of selling company, not to selling company, to shareholders of selling company. We can give shares even to the debenture holders of selling company, not PC. It is liability settlement. Yes, Harsha, finally we heard your voice. Yes. Debentures. Okay, payable in debentures. That means debentures are issued to. Debentures are issued to shareholders of selling company. Debentures are issued to debenture holders of selling company. See, imagine that side full shareholders, this side debenture holders. Okay, selling company. We came to purchase this company. These guys are there over here who had given loan to that company. Now, either I have to pay them and send them home, or I should tell you also join our new company. When I'm joining new company, their old debenture certificate, it is useless because in that debenture certificate, it is written selling company. That debenture certificate, that company only is not there. So what I should do? I should tear it. I should issue new debentures of my company now. Then only makes sense. Are you getting my point? You are a person who gave loan to selling company. I am taking you with me. Clear? Now either I have to pay you and send you home. If I'm taking you with me, I have to give my company debenture to you. Are you getting this? Is this clear, this concept? Okay. So cash, shares, debentures or any other asset. Imagine we gave building to the old shareholders. Okay, hypothetical situation. We gave that, but that is also PC only. I gave building to my employees. Like Ratan Tata, in his will, he gives a lot of things to his employees. Will that be PC now here? No. If at all it happens in amalgamation, not in will. Okay, note. Amount paid by purchasing company to debenture holders, creditors of selling company, not PC. Clear, not PC. Is this clear? Are you following this? Any doubt with this? Clear? So, purchasing company paying to shareholders of selling company. Shareholders are equity and preference both. Clear? Now, computation of PC. Computation of PC. Two methods. Net asset method, net payment method. Now we don't know which method to choose only. What to do? In question, if they tell how to pay, okay, given, how much to pay, not given, that means it is net asset method. They didn't tell you how much. They didn't tell you how much. That means you have to compute. Okay, sir, what does this mean, sir? How to pay, how much to pay and all. I am not understanding anything. Okay, in the question they will tell you. Purchase consideration to be settled in shares of 10 each. How to pay? Shares of 10 each. How much purchase consideration? Net asset method. Purchase consideration to be settled by issue of 5,000 preference shares of 10 each. 10,000 equity shares of 10 each. Balance in cash. Balance in cash. We don't know what is the balance. Whenever we don't know something, that time automatically we come into net asset method. Net payment method is on the plate, they put everything, you just eat it. If you spill it, your mistake. After they put on the plate also. Net asset method is, they told food is there, go and search. Go and search, that's all. Okay, so in question, how to pay is given, how much to pay is not given, then you are going to follow net asset method. Sir, what if how to pay is also not given, sir? Then it will be paid in equity shares. Are you getting my point? If they have not told how to pay, how much to pay you can calculate, no, net asset method. How much to pay you will calculate PC. How to pay is not given. Then you will issue equity shares. This is intrinsic value method. Okay, intrinsic value. That means you will issue equity shares, not at face value. You have to see the market value or you have to see the intrinsic value of both the companies. Clear? Now, rare it is, but that is also there. Okay, net asset method. Simple. Asset minus liability. All assets are. All assets. Whatever is there in selling company, everything are. No. Assets taken over by purchasing company. Understand this. That is a selling company over there. I'm going to take their selling company. There is one amazing TV. They told we will take it home. We will not give it to you. Will I pay money for that TV also? That they are taking it? No. I am not taking that asset. So only taken over by purchasing company. Liabilities taken over by purchasing company. There are some liabilities. 5 loans are there. 3 loans it was used for business. 2 loans they took and directors did betting and they bet on CSK match recently and they lost it. Ouch. Okay. Okay. If that happens, now I am the purchasing company. I'm like, this you didn't use for your business. I am not going to take it over and pay that liability. Okay. You only settle it. So liability is also taken over only. Okay. Now you understood. Okay, sir. Whatever assets I'm taking minus whatever liabilities I'm taking, net amount if I get, that is purchase consideration. At agreed value. In the books, there might be value showing 100. But I negotiated. I told I will take it at only 80. Agreed value. 80 will be taken. In books, it is showing 100. He is not ready to give that asset to me unless we take it at 150. Then agreed value is 150. Where will I find, sir, all this agreed value and all? In the question, it will be given. Land and building 10% more, plant and machinery 5% less, stock at 90%. These are the languages that will be used. Is this clear? So if they tell like this, then it will be taken at agreed value. If they don't give agreed value for an asset, then it is taken over at book value. If they don't tell you, we assume that all the assets are taken over. If something is not taken over, they will tell you. If they don't tell you, then assume that everything is taken over at book value. If something is not at book value, they will tell you. Are you getting this? Again, remember this. we assume that all assets are taken over. All assets and liabilities are taken over. If something is not taken over, they will tell. We assume that everything is taken over at book value. If something is taken at other than book value, they will tell. Is this clear? So at agreed value, this is our net asset method. Next one is net payment method. In question, they will tell how to pay. They will tell you how to pay, and they will also tell how much to pay. How to pay and how much to pay, both are given. What you have to do? List it, total it, and take it as PC. That's it. Equity shares issued to shareholders of purchasing company. Basics. Preference shares issued to shareholders of purchasing company. Oh, what am I writing here? Sorry. Shareholders of selling company, no. Shareholders of selling company, shareholders of selling company, shareholders of selling company. Okay. Then debentures issued to shareholders of selling company. Cash paid to. Cash means money. It does not mean literal cash. Money paid to shareholders of selling company. You might have paid money to others also, but that is not in PC calculation. That is liability settlement. Clear? That is payment of liabilities. Total of this is purchase consideration. Total of this is purchase consideration. Is this clear? Now, in question, they will tell you how to pay, how much to pay. That means everything they have told. Now, if they tell you in the question, equity shareholders are going to get 5 shares for every 6 shares. 5 shares for every 6 shares. Is it net asset or net payment? Net payment. They're telling you know how much and how to pay. They're going to get 5 shares for every 6 shares. You are able to calculate how many? Okay. That will be net payment only. Whenever they use the word balance or they don't tell you how much, that will always be net asset method. Now, intrinsic value method, which is also share exchange method. Okay, 1 or 2 questions are there in old RTPs also about intrinsic value method. Okay, now see, net assets of selling company will be paid by purchasing company by issue of shares at intrinsic value. Now I told you, no, how much to pay if we don't know? Net asset. How much to pay if we don't know? Net asset. That means asset minus liability. How to pay if you don't know? Equity shares. But equity shares, will it be, now you are the selling company, I am the purchasing company. I don't know how much to give you. I'll calculate net asset. Asset minus liability, asset taken over minus liability taken over at agreed value. Clear? How to pay if I don't know? Equity shares. But equity shares, will I issue to you at face value? Doesn't make sense. Market value is something else. So what I have to do, I have to calculate my value of the share. My value is intrinsic value. Intrinsic value. How to calculate my intrinsic value? Intrinsic value per share is net asset of purchasing company. Calculate my own net assets divided by the number of shares. I'll get my value. I will issue share to you at that value only. Imagine my share value is 30. My share value is 30. Okay, I got net asset of 30 lakhs. By mistake, if I divide it by 10 face value, what will happen? I will end up issuing 3 lakh shares to you. 3 lakh shares to you. Now, if you go and sell these shares, what will happen? You will not get 10 rupees now in the market. Value is 30. So, it will be either overvalued or little undervalued. Okay, into 30, you will get 90 lakhs where you are supposed to get 30 lakhs. So, if you divide by 30 here, then what will happen? 1 lakh, what? 10 lakh. 1 lakh shares will be issued. 1 lakh into 30. That time you will get 30 lakhs only. That means what value you were supposed to get, that value only you will get. This is very important. Haven't been tested by ICAI for a very, very long time. That means it is due. Are you getting my point? Intrinsic value, they haven't tested you on for a very long time. New scheme, they have not asked only this question on intrinsic value. Okay, can be asked. Simple. Intrinsic value means what? You don't know 2 things. How much and how, both you don't know. When you don't know how much, what you do, you follow net asset method. So go and calculate net asset method. Now you know how much. This is going to be your PC. This is going to be your PC. Okay, I know the PC, sir. How to pay? Shares. There is no other way. When they don't tell you how to pay, shares. Shares of what value? My company's actual value, not my company's face value. Face value might have been 10 years ago ka value. Clear? My company's intrinsic value. How to get intrinsic value? Calculate net assets of purchasing company divided by the number of shares in purchasing company. You will get the intrinsic value. Use that for PC. Is this clear? Did you understand this intrinsic value method? So, majority of the times it is net asset method, net payment method. intrinsic value also is possible. Again, net asset method is when you don't know how to pay. How much to pay. Net payment method is when everything is given. Intrinsic value is both are missing. Clear? Okay. Now accounting in the books of selling company. What we are going to focus first? Selling company accounting. I tell you one thing. Selling company accounting, the primary goal is what? To close the books and send them. Close the books and empty the books. That's all. Clear? Now, transfer assets and liabilities taken over to realization account at book value. Sir, there you told agreed value, sir. Here book value, sir. What is this? Why? They are taking. When they are taking, what value you have agreed? That value only. Are you getting my point? Now, for example, you go to the mall. You see one shirt. There, that shirt is there like this. Okay. The shirt is there. That shirt they are telling that it looks like space suit, no? But moon landing never happened. Why do you need space suit? Oh, for that you have to use your knowledge. Okay. Now there is a shirt like this. They told 1,000. Now at 599. Clear? You go and buy the shirt. You will record it at agreed value. From their stock, the shirt went. They will take it at 1,000. 1,000 went from their stock. Are you getting my point? Here? Is this clear? Are you following this? He said my... Okay, now listen. So when you are emptying the books, you have to remove from the books. When you are removing from the books, what will you remove? From the books, what will you remove? Book value only you can remove, no, from the books. Clear? So transfer assets and liabilities taken over. Transfer assets and liabilities taken over to realization account. Why only assets and liabilities taken over? Because if it is not taken over, it is still here. We will sell it or we'll pay it separately. Clear? Only taken over to realization account. Okay. Now, asset gone. Modern approach. Once upon a time in life, you have studied something called as modern approach. Asset reduces. What should happen? Asset should be credited. Debit to realization account. Okay, liability gone. Liability reduces. What should happen? Liability should be debited. Credit to realization account. That means everything is going to be taken over. No. All this you put into a common place. This common place is called as realization account. Asset by asset, I cannot calculate profit or loss. Doesn't make sense. Actually what? My land went. Book value of land is 1 crore. They are taking it at 1.2. Do you agree 20 lakhs is profit for me? My plant and machinery book value is 10 lakhs. They agreed to take it at 9.8 lakhs. 0.2 lakhs is loss for me. So asset by asset, liability by liability, I should actually calculate profit or loss. But anyways, I'm closing, no. So I put everything here and calculate total profit or loss at once. Are you getting my point? Okay. So realization account debited to asset and liability account debited to realization again at book value. Step 1, that's clear. What is the step 2? Dispose assets not taken over. Dispose assets not taken over. What is the word here? Dispose assets not taken over. Not sell. Not sell. Somewhere in some amalgamation question, there is one patent which is not taken over. Everyone will come and ask a question. Sir, patent is not taken over, sir, but still it is sitting in realization account, sir. That means it is sold at zero value. Are you getting my point? It is sold at zero value. Now understand this. First you have to understand this, then I'll explain that patent thing. Dispose assets. Okay. Dispose assets not taken over. That means now you are thinking sell. Correct? If I sell, I'll get money. Bank account debited to asset account. Profit or loss should go to, you are thinking P&L. Normally it would have gone to P&L, but all my assets are sitting in realization account. Profit means credit to realization, loss means debit to realization. Clear? Done? Clear? Okay. Now, settle liability is not taken over. Not taken over means I have to pay the liability. So liability account debited. Sir, liability is sitting in realization account. Only the ones which are taken over are in realization account. Which are not taken over are still in liability only. Are you getting this? Only the ones which are taken over are in realization account. See the first step. Transfer assets and liabilities taken over to realization account. Which are not taken over are still in asset account only. Still in liability account only. Clear? So, liabilities account debited. Everything is moving. Morning. Okay, liabilities account debited to bank account. Here also you can pay lesser value or more value. You can tell I'm closing my company, give me one discount. Okay. Or you're closing the company, doesn't matter, still pay all the penalties they might tell. Okay. Profit, credit to realization, loss, debit to realization. Usually profit or loss goes to what? P&L. But now you're closing books. If it goes to P&L also, it goes to shareholder. If you put to realization account also, it goes to shareholder only. Clear? Okay. This is the situation. Now, tell me one thing. I have one asset in books at rupees 90. At rupees 90. I sold it at rupees 30. What should be the entry? What should be the entry? Bank account debited 30. Loss, no. Loss on sale is not there. Realization account debited 60. 2. Asset account. Correct? 100%? Okay. I have an asset at 90. Not taken over. Okay. And I did not sell it. I did not sell it. Nobody is ready to buy it. I did not sell it. What will I do that? That means it is like sold at zero value. That means realization account debited to patent. That patent example. Okay, there is one question somewhere. Okay, in our database, patent is not taken over, but still you are finding patent in the realization account. Why? It is not taken over and they did not tell that it is sold also. That means it is just disposed. That's why the word here is dispose assets not taken over. Yeah. What did I write? Did I write 30? Oh, okay, I didn't write 90. Okay, dispose assets not taken over. When you are disposing, someone is giving you money, bank account debited. When you are disposing, nobody is giving you money, everything will go to realization account as loss. Are you getting this? Same way, settle liabilities. When you are settling, if you are paying money, bank account credited. When you are settling, if you are not going to pay money, everything will go to realization account because it is profit. Did you get this? Is this clear? Liabilities not taken over, we assume it as paid. Yes, that is a very good question. Assets, if it is not taken over, we don't assume it is sold because we need the sale value, right? Liabilities, if it is not taken over, we assume that it is paid and we have to pass the payment entry. Are you getting my point? Because obviously, no. Logic is what? Now you're closing books. If you don't pay the liability, you have money, but you are not paying liability, you have money. That money you are giving to owner. First you pay the outsider, then you give the money to owner. That's why if they don't tell also, liability you pay. Liability, if you are not going to pay, they will tell creditors are not traceable. So you don't have to pay them or you can't find them. You want to pay but you can't find them. Clear? In that case, that time what you will do, you will put everything to realization. Otherwise, liability, if it is not told, you are going to pay. Okay. Now, all done. Assets, liabilities removed from books. What is not taken over is also gone. What is taken over is sitting in realization account. For taking over this asset and liability, they are giving us something that is called as PC, which we calculated first only and kept. PC due. Why due? Why due? Because the day I go and shake hands, that day only the settlement won't happen. I shook hands. See, if at all you have ever in your family anywhere, if you have sold land anytime, land sale you have done or land purchase you have done, the day you decided or the day it was agreed, that day only the land did not come to your name. Now here not land, like land, many other assets are there. Entire company only you are taking over. In one day it's not possible. Clear? So first PC due, we follow AS1 accrual. Remember, AS1 accrual. Okay. In AS1 there is something called as, there are three things. Oh yeah, going concern, accrual and consistency. What is this called? What? Fundamental accounting assumptions. These three are always followed. So we follow accrual concept. I don't think we have any chapter where we follow cash concept. At least at inter level we don't have. Okay, we don't have anything. Incomplete records and all, something was there in foundation. Their cash concept can be followed. But otherwise nothing. Accrual everywhere. PC due. PC due means what? Am I the person who is receiving the PC or am I the person who is giving the PC? I am the person who is going to receive the PC. Did I receive it? I have to receive it. Somebody have to give me. Receivable is always asset. Purchasing company debited. Purchasing company debited. 2. I am receiving it for what? For the assets and liabilities I am giving. Where are the assets and liabilities sitting? In realization account. To realization account at purchase consideration. Is this clear? Okay. Obviously they will give me PC receipt. What will I get? I can get money. I can get money. Bank account debited. I can get equity shares. Equity shares in purchasing company debited. So equity shares, usually we write 2 equity share capital, sir. We write 2 equity share capital. That is the person who is issuing. This is the person who is receiving. For the person who is receiving, it is asset. Clear? Equity shares in purchasing company debited. Preference shares in purchasing company debited. Debentures in purchasing company debited. This debenture, all this are the ones which are issued to whom? Shareholder only. If it is issued to somebody else, it is not going to be taken. Clear? Okay. To purchasing company. When they give you, you remove them from debtor position. They were sitting in a debtor position over here. They gave you something. You remove them from debtor position. Tata bye bye. They are out of your books. Purchasing company gone. Now, realization expense. What is this? Closing the company. You will have one agent. Agent will help you sell the assets. Agent will help you value the assets. There is one lawyer who will do all the legal formalities. Correct? There is one chartered accountant who will sit and pass all these journal entries and all calculation they will do. Are you getting my point? How much to pay, how to pay, and all they will be seeing. Okay. Now, realization expense. Clear? This is realization expense. Now, paid by selling company. Who are you right now? Selling company. Paid by selling company. Paid. Expense when you pay, usually what entry you pass? Expense account debited to bank. That expense will go to P&L. That will go to shareholder. So, realization account debited to bank. Everything is sitting in realization right now. Realization account debited to bank account. Is this clear? Now, paid by purchasing company. Paid by purchasing company. What should be the entry? No entry. It's not a transaction related to selling company. Who is paying? Purchasing company. To whom? Those people, agent, lawyer, all those people. Correct? Who are you? Selling company. No entry. One more. Paid by selling company. Reimbursed by purchasing company. Purchasing company is telling, first you pay. Show me the bill. Then I'll give the money to you. First you pay. Show me the bill. I'll give the money to you. You paid, no. But when you're paying only, you know that it is not going to go from your pocket. You're going to get it back. Who is going to give you? Purchasing company. So purchasing company account debited to bank account. Purchasing company account debited to bank account. When you get it back, bank account debited to purchasing company account. When you get it back, bank account debited to purchasing company account. Now they might tell you a question. Okay. Purchasing company has agreed to pay 10. Actual 12. Actual 12. Now what entry will you pass? You will pass the entry realization account debited to, because that is going from your pocket, purchasing company account debited 10 to bank account 12. Then what will you do? Bank account debited 10 to purchasing company 10. Can this happen? Yes, it's there. Yes. Okay. Now all the things are done. Close the realization account. When you're closing realization account, no, you have to remember one note. You have to remember one note. What is that note, sir? Note you didn't tell only. It is there at the end. Where did I write? Note. When preference shareholders are there in selling company, first settle the preference shareholders, then close the realization account. Why? Preference shareholders are showing 3 lakhs. If you're paying 3 lakh 30, then what happens? Extra you're paying, for you it is loss. That loss will fall on whose head? Equity shareholder. Take that 30, put it to realization account, then you can go ahead. Are you getting my point? If there are preference shareholders in selling company, close the preference shareholders ledger. Difference if it is there, transfer it to realization account. Then you close realization account. Clear? If you close realization account first, then the difference, where will you put it when you close preference shareholders account? Logically, you can just put it to equity shareholder, but don't do that. Clear? If there are preference shareholders, close preference shareholders, transfer the difference to realization account, then you close the realization account. Clear? So when you close realization account, only 2 things can happen. What is that? Actually 3 things can happen. One profit, 2 loss, nothing. No profit, no loss. Break even point. Okay. close realization account. Costing. Yes, if profit. What? Somewhere costing marathon is also going, no, at the same time it's happening. Yes, close realization account. Tell me, what should be the entry? Profit, no. Profit should go to whom? Which shareholder? Equity shareholder. Realization account debit to equity shareholder. This, I shouldn't have written, you should know this at inter level, just telling you. Credit side of realization account is more. That is when it's called as profit. Clear? Are you getting my point? Okay, if loss, equity shareholder account debited to realization account, that means, debit side of realization account is more. Clear? Loss or profit will be borne by equity shareholder. Now, settlement of shareholders. Clear? Preference share capital to preference shareholders. Settlement due entry. Remove preference share capital, transfer to preference shareholder. Payment, what will you do? Preference shareholder account debited, equity shareholder debited, equity share capital also you have to transfer to equity shareholder. Sir, here this much only, here little more. What is that? Reserves and surplus also goes to equity shareholder. Clear? Whatever reserves and surplus are there, general reserve, P&L, whatever you find under reserves and surplus, remove that, transfer it to equity shareholder. That is the amount due to them. Their share capital plus what was earned in the past which was not given to them. What is reserves and surplus? What was earned in the past which was not given to them. Now at least we have to give it to them, to equity shareholders. Is this clear? Are you following this? Yes, this is your settlement due. Settlement due. Now you will pay preference shareholders, equity shareholder. You got something that time, no, from purchasing company, you kept it in the side. Give that. Debentures are also there. Give that preference shares in purchasing company, debentures in purchasing company, equity shares in purchasing company. Okay, to bank. All this you will give. Where did you get all this, sir? In our PC receipt entry. Do you remember the PC receipt? See, all these assets were received. Finally, all these assets will be given to the shareholders. This is our settlement entry. Is this clear? Note we have already discussed. This is actually accounting in the books of selling company. Clear? Okay, let's go further. In the books of purchasing company. Still we have purchasing company. Clear? In the books of purchasing company. Now, two types of amalgamation in the books of purchasing company. Amalgamation in the nature of merger. Amalgamation in the nature of purchase. Amalgamation in the nature of merger. Amalgamation in the nature of purchase. Okay. If it is in the nature of, sir, how do we know which it is? We will discuss. Okay. But if it is in the nature of merger, pooling of interest method. If it is in the nature of purchase, purchase method. What is amalgamation in the nature of merger? 5 conditions. 5 conditions. First, all assets and liabilities are taken over by purchasing company. Second, all assets and liabilities are taken over by purchasing company at book value. Just ICAI things again. AS14 drafting. Look at the amazing drafting by ICAI. I mean, standards are drafted by ICAI, approved by central government. Correct? When they were drafting, they thought, ICAI thinks of future things always. They always think of students. They're like, if at all we make 4 points, then we should ask it for 4 marks. But if you make it 5 points, we can ask it for 5 marks. What is the difference between first one and second one? All assets and liabilities are taken over by purchasing company. If they would write here only, all assets and liabilities are taken over by purchasing company at book value, 1 point less, no. But we can't ask for 5 marks, no. Are you getting my point? But I say next level, you know what? They are asking for 5 marks. What you know? Define amalgamation in the nature of purchase. 1 line answer. If any condition is not fulfilled, amalgamation in the nature of purchase, ICAI will give 1 mark and send you home. Are you getting my point? Okay. Without writing amalgamation in the nature of merger, there is no definition of amalgamation in the nature of purchase. So, amalgamation in the nature of merger, all assets and liabilities are taken over by purchasing company. Just remember, second point is just extension. All assets and liabilities are taken over by purchasing company at book value. 2 points done. Clear? Now, purchase consideration. Purchase consideration to be settled in shares only. Cash can be paid for fractional shares. Sir, fractional shares, I know, sir, stock market. Fractional shares not allowed in India. Sanjit will tell. Fractional shares not possible. Correct? Trading person, no. Yes. So now, what is this? Imagine. Okay, we'll discuss this point here only. Maybe we'll not come across this point in questions. So here only we'll discuss. One question is there, but we can't search it now. Okay, marathon. You see, already I feel that I've picked more questions, but every question, I was feeling like a student when I was picking questions for the marathon. I was like, when we are studying previously, you feel like Oh, I should see this also. Next, you don't feel like leaving any questions. I was feeling like that. Okay, we'll see that. Now, imagine my PC is 10,000 rupees. Imagine my PC is 10,000 rupees and I am going to issue shares at rupees 15. I am going to issue shares at rupees 15. Now, if I do PC 10,000 divided by 15, you're going to get, use your calculators, 666.67. I cannot issue 0.67 share, no. Sir, what you're doing, sir? Just make it 667. Done. Job done. If you do that, 667 into 15, how much is it? 10,000. That means you'll end up giving 5 rupees more than the PC. Sir, 5 rupees, why are you concerned? Now we are talking about 10,000. The PC might be in crores. PC might be in crores. Are you getting this? So, what is the PC? That is what you're supposed to pay. If I round it off to next number, I'll end up paying more. I'll end up paying more. So, now what I should do in this case, 666. Okay, I'll round it off to the previous number. Now, 666 into 15. 9,990. Sir, you gave less, no? Less, no. Fractional cash. Fractional cash. This is the only thing that can go against this point. What did they tell over here? Purchase consideration to be settled in shares only. Only exceptional cases cash can be paid for fractional shares. Other than that, if you give 2 rupees extra cash, that will be straight away amalgamation in the nature of purchase. Are you getting my point? Other than this case, if you give cash anywhere, it will be amalgamation in the nature of purchase. Now, at least 90% of the shareholders of selling company to become shareholders of purchasing company. There are 100 shareholders. Okay, 90 should become shareholder here. Is that correct? There are 100 shareholders in selling company. At least 90 people should come this side. Is that correct? Value. At least 90% of shareholders of selling company to become shareholder of purchasing company. 90% of value of shareholders, not the number of shareholders. 1 lakh share capital, 90,000 should be this side. Are you getting my point? Value. Now, purchasing company has intention to continue the business of selling company. That means going concern concept. Going concern concept should be followed. AS1. Okay. Now, AS1 done. Tomorrow we can tell. Yesterday we did know AS1 finished. Okay. Purchasing company has intention to continue the business of selling company. Now, in the question, only first 4 can be determined. First 4 can be determined. Last one cannot be determined. How will you go and check the intention in the exam hall? Are you getting my point? So if first 4 are fulfilled, fifth one also fulfilled, it will become amalgamation in the nature of merger. Now, if you miss any condition in this, amalgamation in the nature of purchase. If you miss any condition in this, it becomes amalgamation in the nature of purchase. Are you following this? That means in the first line of the amalgamation additional information, they have told fixed assets taken over at 90%. Overdone. Don't read anything. Forget about all the conditions. Straight away amalgamation nature of purchase. Are you getting my point? Even one condition you miss, or they tell PC to be settled in 5,000 shares and 2,000 rupees cash. Over. Finished. When cash comes into the picture, done. Clear? Amalgamation nature of purchase. But if they tell you theoretical question, amalgamation nature of purchase, you have to write these 5 conditions. Then you tell if any of the above condition is missed, it becomes amalgamation in the nature of purchase. Clear? No. Pro tip. Stay calm in exam hall. Sir, easy to tell, sir. 100% of paper can never be tough. Search for easy questions. This is 100% true. Okay. When people come out of the exam hall telling no tough paper, 20% tough. 20% twisted questions. In that 20%, you lost all your mind. Clear? All easy questions, you only made it tough. ICAI also knows where to put the tough questions. Starting only. Seeing that, okay, you have messed it up. Now your easy questions also, you are only making it tough. Clear? Okay. Now, accounting in the books of purchasing company. Accounting in the books of purchasing company. These people are supposed to follow AS14. That's why we learned that pooling of interest method and purchase method. Now, purchase method. Purchase method is used for which kind of amalgamation? Amalgamation in the nature of Purchase. This is more common actually. Practically, what do you think? This or the other one? This one only. Why? Why? Because some asset value we will change. No, we will not agree with everything that is there in their books. Asset and liability taken over at book value. Everything, whatever is there in these books, will I agree for that? One asset, at least I'll feel this is not the real value of this asset. Are you getting this? So, accounting in the books of purchasing company, purchase method, first we will discuss. Okay, PC due. We shook hands. Correct? We shook hands. Now, that fellow is asking, give me money. I am like, I have to pay money. Oh, are you getting my point? That fellow, he put into realization account, happy. Now, purchase consideration due entry. Understand this. Business purchase account debited. Now, once upon a time, somewhere in our life, you have seen transactions. Goods purchased from Ram. Then next, goods purchased from Sham for 5,000. Clear? One was credit purchase, another was cash purchase. Now, here I am actually doing credit purchase of a business. I am doing credit purchase of a business because I agreed to purchase, but I didn't pay the money now. So, what did I purchase? Business purchase account. Sir, can't we just write purchase account debited? It would be stock then. It would be stock. It would go into your closing stock. One entire business would go and sit in your closing stock. Then you will do changes in inventory. Are you getting my point? Okay, it is not possible. So, purchase consideration due, business purchase account debited. Is this clear? Business purchase account debited. 2. Whom should I pay? Sir, entire concept till now we learned that we have to give the money to shareholder of selling company. And here you are writing liquidator of selling company. We will not go and search for every shareholder and give it to his hand. We are bound to give it to the liquidator, who is like a middleman, who is the agent who is doing everything over there. We will give it to liquidator, liquidator will distribute. Is this clear? Okay, liquidator of selling company. At what? PC. Purchase consideration. What is told as receivable over here, over there, is payable over here. Clear? Takeover of assets and liabilities. You are taking over the assets and liabilities. First you pass the due entry. Now, what are you getting? Assets account debited. Sir, their asset was removed and it was put into realization account at book value, sir. So here also I should take at book value. No, agreed value. There they were emptying the books. Here we are creating the asset. What we agreed, that will be the value. Agreed value, asset account debited. Liability also came to liability. Okay. Now, if I pay more, if I have paid more, that means net asset is less, purchase consideration is more. Net asset is less, purchase consideration is more. That means you paid more than the worth what you're getting. Why did you agree to pay more? Because they have a reputation. Their reputation, we will record it as goodwill. Goodwill account debit. Is this clear? Their reputation was something, the worth you are getting is something, but you have paid less than that. That means it is good for you. It is profit. Profit should go to P&L, but this does not happen on a day-to-day basis. So you'll put it into capital reserves. Is this clear? Okay. Now, let's go further. PC receipt. Okay, can we have both in the same goodwill and capital reserve? Either you pay more or you pay less, or you don't pay more or less, nothing. Clear? So this will be the situation. Let's go further. Purchase consideration receipt. Again. Purchase consideration payment, not receipt, payment. Feeling cold? Yo, okay. Tell. Purchase consideration. Huh? No, if AC is turned off, it will be extremely silent. Huh? He's? You told her? Yes. No, if you turn it off, it will become extremely silent. And as Indians, we don't like too much silence. Noise should be there. Okay. Okay, guys. They'll turn it off. Don't worry. Purchase consideration, payment. We are going to pay. Whom are we going to pay? Shareholder, yes. But we are going to give it to liquidator. He will give it to the shareholders. Liquidator of selling company debited. Liability gone. What is gone now? Money also gone. Correct? What is gone now? Equity share capital, preference share capital, debentures. One more thing can be there. 2. And also 2 securities premium account. What is the securities premium? All this will be at face value. No, something extra will go to securities premium. Clear? So now if you pay money, bank account, otherwise extra what is share issued at higher value will go to securities premium. This is the payment entry. Okay, liquidator gone and all these things are also gone. Now, only if debentures are issued to shareholders. Remember we discussed that already, that if it is issued to shareholders of selling company, then it will be taken. Otherwise, no. Okay. Realization expenses. It was there also. Okay, paid by selling company, ignore. They have paid, why will you bother? Paid by purchasing company. What should be the entry? Goodwill or capital reserve account debited to bank. Sir, actually it is expense account debited to bank. No. Now see, already you paid more. That's why it was considered as goodwill. Now after paying more, again you are paying one more expense. So goodwill increases. Goodwill debited. You paid less. That time you got profit. That you called it as capital reserve. Now after getting this profit, you went and paid one expense. So your profit will reduce. Capital reserve debit. Is this clear? Are you following this? Now, examination you can just see whatever was created in step 2, use the same thing over here. But what is the logic? You paid more over there. That's why it was called as goodwill. Now you pay little more for some expense, goodwill increases. You paid less over there. That's why you got a profit. That profit is sitting in capital reserve. Now after you got the profit, you paid one expense from your pocket. The capital reserve reduces. Is this clear? To bank, money goes obviously. Settlement of debenture holders. I told you, no, that time, that side shareholder, this side debenture holder. Debenture holder, I'm telling, come along, we'll go. You also join the new company, correct? Now I have to give them new debentures of my company. Okay, my company debenture, I can give it to them at par, premium, discount. Sir, discount is prohibited. That is only for shares. Clear? Par, premium, discount, I can issue the debentures. No, debenture holders debited. Okay, debenture holders debited. If I issue it at discount, that means 100 rupee debenture, I'm issuing it at 90. Then discount on issue of debentures debited. If I issue it at 120, then securities premium credited. Two debentures will always be only face value. Two debentures will always be only face value. Is this clear? Are you clear with this? Okay. Cancellation of mutual owings. What does it mean? Before we were two separate people, no. That time I had to pay you money. You had to get money from me. Now we both are one company. So that time I cannot tell payable, receivable, because payable and receivable in the same balance sheet. That is like I have to pay money to myself. Are you getting my point? So to eliminate that, what we will do, remove all mutual things. Creditors debited, bills payable debited, loan taken debited, liability gone. 2, debtors, bills receivable, loan given. That means liability account debited to asset account. Whichever liability is common, that is removed and asset is credited. Clear? Unrealized profit. What is this unrealized profit? What is this unrealized profit? Stock reserve. Yes. Selling company has sold goods to purchasing company. Okay. Selling company has sold goods to purchasing company at profit, obviously with profit. Okay. And it is in the inventory of purchasing company. This will create stock reserve situation. This is basically unrealized profit. What happened over here? Selling company sold goods to purchasing company. Purchasing company has the goods which is in the inventory. Now purchasing company and selling company come into the same balance sheet. That means inventory is also there in the asset side and profit is there in reserves and surplus. That is looking like I made profit by selling goods to myself. It looks like I made profit by selling goods to myself. This profit is unrealized profit. That means we didn't realize. Imagine selling company sold goods to purchasing company and purchasing company has already sold it to some outsider. That means goods are not inside us. Within us it is not there. That means this is realized profit. This is realized profit. Is this clear? Realized profit you don't have to worry. Unrealized profit we have to worry. Is this clear? Now what if the other way around? Purchasing company has sold goods to selling company. This is at also profit. And it is in the inventory of selling company. This also is unrealized profit only. Does it make any difference if selling company sold to purchasing company sold to selling company? Does it make any difference? No. You're getting some concept, but it is not this. You're getting some concept, but it is not this. That we'll discuss somewhere else. Clear? Huh? No, not branch. It is in consolidation. Branch, there is nothing upstream, downstream. That we'll discuss in consolidation. Okay, so whoever sold to anybody, our thing should be somebody sold to somebody within this group here, and it is sold with profit. That means at invoice price, and those goods are still in stock. That means it is within us. Stock is still with us. That means it is unrealized profit. If it is sold, then it is realized profit. Now they will tell you 3/4 of the goods are still in stock. That means we have to calculate unrealized profit for only 3/4. 1/4 of the goods are sold. We have to calculate for 3/4. We have to worry about what is remaining. Clear? This is your unrealized profit. What is entry now? Profit should be removed, right? Profit should be removed. That means it's a loss. P&L account debited usually. But here what we do? Already we had paid more. Now one more loss. Goodwill account debited. We had paid less. So we had a profit. So capital reserve debited. Clear? To stock reserve. Basically whatever happened in step 2, use that. Stock reserve, remember this. Stock reserve, okay, in the balance sheet will be subtracted from stock. Inventory. Okay, in the balance sheet when you prepare no of the purchasing company, it will be subtracted from inventory. Clear? Okay. Now, statutory reserves. What are these? Reserves which are supposed to be maintained because of some law. Correct? Some statute. They told you have to maintain for 5 years. Now in this 5 years, 2 years are over. Selling company went. Now it is the responsibility of the purchasing company to continue it. So you'll just pass one dummy entry. Amalgamation adjustment reserve account debited to stock statutory reserve. What will happen over here? Shown as negative under reserves and surplus. This is shown as negative under reserves and surplus. This is shown as positive under reserves and surplus. Net effect is nil. Net effect on reserves and surplus is nil. Is this clear? Are you following this? Yes. This is your statutory reserves. Now, let's go into accounting in the books of purchasing company under pooling of interest. Oh, so many errors. This is pooling of interest method. What is pooling of interest method now? Amalgamation in the nature of merger. First entry will not change. You have to pay money. That is by default same thing. So business purchase account debited to liquidator of selling company at PC, whatever is calculated in PC computation. Takeover of assets and liabilities. Assets account debited. Reserves account debited. 2 liabilities. 2 reserves. What is happening? Reserves debited also, reserves credited also. If PC was more, net asset was less, you used to call it as goodwill. Here and there, PC was less, net asset is more, we used to call it as capital reserve. But here what we are going to do, if at all, understand, net asset is less, purchase consideration is more. That means reduce it from reserves. And here one more thing you have to understand. Okay, when I am telling liabilities over here, all liabilities including reserves and surplus, excluding share capital of selling company. Is this clear? Now, yeah, every method business purchase is there. Which above method? Yeah, that I didn't write over there. Oh, here also you are not written, no? To business purchase, obviously, because business purchase is gone, credit purchase it was. Now, one thing we have to remember over here is if purchase consideration is more, what we will do? Reduce it from the reserves. If purchase consideration is less, add it to reserves. Here, all the things are taken. Sir, why sir? One of the condition was all assets and liabilities are taken over at book value. Everything, whatever is there, it is going to be continued. No, whatever is there in that balance sheet, everything will come this side. Shareholders, share capital will not come because we are going to issue new shares to them. They will come and get added to our share capital later. Clear? Now, understand this. Imagine you are getting a difference. Okay, what you will do? Already maybe your reserves are showing 3,200 and you are getting a difference of 3,000. So you'll subtract 3000 and you'll take only 200. That means you are paying more already. You will subtract 3000 and you will take only net figure. Correct? Are you getting this? Imagine PC is 3200. Okay, or PC is 9000. Okay, net asset is 6000. Did you pay more? Did you pay more? Yes. Therefore, 3000 will be subtracted from reserves. No goodwill. Clear? In case PC is 6000 and net asset is 9000. So what you will do? Therefore, 3000 will be added to reserves. Reserves. Not capital reserve. Reserves, general reserves. It will just get added to reserves. Is this clear? So what is the same thing if it is amalgamation in the nature of purchase? This 3000 would be taken as goodwill and this 3000 would be taken as capital reserve. Is this clear? Are you following this? Yes. Now, let's go further. PC receipt. That is one major change in amalgamation in the nature of merger. Okay. Everything you should take at book value. Yes. Ayo. That's why you should not do last moment. Okay. PC payment. Liquidator of selling company account debited. Liquidator gone. Okay, to equity share capital, to preference share capital, to debenture. Okay. Oh, what and all is there over here? To bank account. And also to securities premium. Also to securities premium. These things you know it is at face value. It is at face value. Clear? Only if debentures are issued to only if debentures are issued to shareholders. Same point we had already discussed over there also. Now, realization expense. Sir, there I wrote goodwill account or capital reserve account debited. Here what I'll write? Reserves account debited to bank, because goodwill capital reserve didn't get created only. Reserves account debited to bank. Don't use goodwill capital reserve. Oh भैया देखो आपका पहले वाला स्टूडेंट्स. अब आज भी रोएंगे क्या आप? हाँ? आज रोना है? कल रोना है. कल भी आएंगे ये लोग. Huh? I told, just like he cried on that day. Are you going to cry again? On your last day, he was crying, no? Oh, you don't know that Bhaiya cried on last day? You're busy with someone else. You don't remember? Twins. Yes. Now twins have moved on, man. They have forgotten you. They are with someone else. They are putting stories with someone else. What is this? You focus on exams. Yes. Realization expenses. Paid by selling company, no entry again. Okay, paid by selling company. Paid by purchasing company. Reserves account debited to bank. Don't use goodwill capital reserve here because goodwill capital reserve didn't get created only. Clear? Okay. Fifth, settlement of debenture holder. Same entry was there over there. No change. Same entry. Nothing is going to change. Cancellation of mutual owings. Same entry. But unrealized profit, we are not going to write goodwill or capital reserve. We are going to write reserves account debited to stock reserve. Reserves account debited to stock reserve. Reduce it from inventory in balance sheet. We have already discussed this. Okay. Treatment of reserves. Treatment of reserves. One small chart to summarize everything what we have seen. If it is amalgamation in the nature of purchase, reserves and surplus not taken over, statutory reserve to be recorded by purchasing company. Amalgamation adjustment reserve account debited to statutory reserve. That dummy entry you have to pass. If it's amalgamation in the nature of merger, reserves and surplus taken over, no specific entry required for statutory reserves, as all reserves and surplus are taken over. Everything is taken over, again separate entry not required. Here it is not taken over, so separate entry required. Clear? Okay. Oh, pro tip. Go straight home after exams and focus on next exam. Do not discuss with friends. Friends don't correct the paper. Are you getting this? They don't correct, no. So why to trouble them? Okay, straight you go home. Okay, questions and all will not bother. That is it with amalgamation, guys. Concepts. Okay, now questions. See the number of questions which are there in amalgamation. Only 6. Only 6 questions we are going to discuss in amalgamation. And the easy 6 only I have picked. Don't worry about it. Easy 6. Okay. Tough questions and all I have not picked only. We'll take a break at 10:30. Okay, 10:30 we'll take a break. Till then, no break. Now, in detail, we have to discuss. Item by item, we have to discuss. Obviously, we are not going to solve. It's not possible to solve in marathon, but we'll discuss every calculation. We'll discuss. Now, this is the RTP Jan 2025 questions. You won't find it, man. RTP Jan 2025. I don't think it's there in there. Yeah. There are a lot of things. Now, I'll go switch from past examination questions, RTP, everything. So, some of the things, if you don't have the data over there, just observe. I'll share questions anyways later. Now, summarize balance sheet of Gyan Limited and Kiran Limited. See, man, Anaga. Gyan Limited and Kiran Limited together. Yes. As on, this is going on YouTube. Okay. Gyan Limited and Kiran Limited. You won't understand it. We are from the same place. There is some hometown touch to that joke. Huh? What? Priyanka Chopra? No. She is not in YouTube. She is not US. This is a different thing, man. This is like a hometown joke. She's from the same hometown, right? So we know some common person there. So some joke over there. Over. Without telling, we already told everything. Let's continue. Summarize balance sheet of Gyan Limited and Kiran Limited. Okay, as on 31st March 2024 given. Okay, now share capital. Clearly, see ICAI. Question, I will not follow Schedule 3 format at all. Solution, you should follow Schedule 3 format only. Are you getting my point? Some questions they will follow Schedule 3 format. Now, if they follow Schedule 3 format, it becomes easy. No, you can look at the question only, you know the format there. Okay, you should not forget the format. You will not forget thousands of times writing all the format. Okay, by heart it will become. Okay, now share capital. Understand. Equity share capital 10 each fully paid up. Rupees in lakhs. Gyan Limited and Kiran Limited. Till now we don't know who is purchasing company, who is selling company. Preference shares are also there. Fully paid up. Reserves and surplus you have general reserve. P&L. Two things. Okay. Non-current liabilities you have 12% debentures. Both the places. Loan from bank you have. Current liabilities are also there. Bank OD, trade payable, dividend payable. As per Schedule 3, dividend payable cannot come only. Dividend declared will not go to the financials. You ignore it only when dividend paid. But anyways, it's already there. They have made the provision. So we have to follow the question. Assets, non-current assets, you have PPE, investment, current assets, trade receivable, cash at bank. Now, Gyan Limited had acquired the business of Kiran Limited. Clear? Who is the purchasing company? Gyan Limited. Who is the selling company? Kiran Limited. As on 31st March 2024, as per the following scheme of merger. Sir, I saw the merger word 100%. Now it's amalgamation in the nature of merger. Is it true? No. We have to check those conditions. Okay. Bank agreed to waive off 50% loan of Gyan Limited. What are they talking? Sir, this is something that we did not discuss only. Past necessary journal entries in the books of Gyan Limited, they said. Gyan Limited is what? Selling company or purchasing company? Purchasing company. So selling company books they didn't ask in this question, and balance sheet after merger. Now see over here. What happened, sir? Amalgamation question I thought started with internal reconstruction. Can they merge concepts? Yes. They are like, sir, we'll study only internal reconstruction and go to the exam. They will not ask internal reconstruction also. They will not ask amalgamation also. They will ask one merged question. We can't attempt also. We can't leave also. Are you getting my point? Okay. So please do not skip anything. Especially in these major chapters and all. Do not skip anything. Everything can be merged with everything. Okay. Now, banks agreed to waive off 50% loan of Gyan Limited. What is the loan of Gyan Limited? First is, how much is the loan of Gyan Limited? Loan from bank. Okay. Now, we have a dilemma here. What about this OD? What about this OD? They said that is cash credit. Yes. 50% loan they say. OD is not considered as loan usually. It's also borrowing only basically, but not considered. Now, see here what happened. Loan from bank debited. Loan is gone. Loan should be debited. 2. Reconstruction account is nothing but capital reduction account. You know these words can be interchangeably used. Okay, 20. Still till amalgamation can start only. Okay. Now, next they said Gyan Limited will reduce. Okay, who is Gyan Limited? Purchasing company will reduce its shares to 2 rupees per share and then consolidated 5 such shares into one new share of 10. Oh. Before that guy is coming, we are doing all the circus in the world. Okay, before we purchase. Okay, Gyan Limited is, now see, reserves and surplus, if you see, you didn't notice it that time. Sorry, I didn't get you what? Yeah. They said no, Gyan Limited has acquired the business of Kiran Limited. Yes, can you see Gyan Limited? 260 negative. 260 negative. So what we are doing, imagine, we are reducing our loss. Then we are not selling our company to somebody. We are purchasing some other company. Are you getting my point? Possible? Possible. Someone else will tell, we don't want to get associated. We don't want to sell ourselves to some loss-making company. Wait, stand outside. Inside only I will do modification and show no loss at all. Okay, that is internal reconstruction. No. Inside only we are doing some book up and down we will do and then we will remove all the loss. Okay, 260 obviously that's why internal reconstruction is spoken about. And they said equity shares will be reduced to 2 rupees per share. What is the equity share right now? How many are there? 650 means 65 lakhs. 65 lakhs into 2 it should become. That means 8 rupees will get transferred to capital reduction. You can see over here equity share capital account debited to equity share capital. 665 into 10 gone. 65 into 2 is the new thing. Clear? That means 65 into 8 everything went to capital reduction account or reconstruction account. Is this entry clear? Are you getting this? Okay. Now in that same thing they told one more circus. Then consolidate 5 such shares into one share of 10. We want to see 10, 10, 10 only. Nice number. But we will make the profit and show 10. So now what happens? 65 lakhs shares, no? 65 lakh shares. It was 65 into 2 now. Just now we did that. 65 into 2, 130. Correct? Now what they are telling, we are going to consolidate 5 such shares. That means we are going to add the shares into 1. So 65 divided by 5. How many it is? 13 shares. Now you are getting 13 lakh shares. This becomes 13 lakh into 10 is equal to 130. Sir, nothing, sir. Earlier also 130, now also 130. Why to pass entry? Change in face value. Anything changes in books of accounts only if you pass entry. Anything changes in books of accounts only if you pass entry. Just because of 130 value is not changing, don't ignore this entry, you lose marks, that's all. Okay. Equity share capital to equity share capital. 2 rupees, 10 rupees, 130, 130. Is this clear? Are you following the first few transactions? Now, Gyan Limited will issue, finally, will issue 2 equity shares new. New means of what value? 2 rupees or 10 rupees? New. 10 rupees only. It became 2 and came back to 10. Are you getting my point? It became 2, it came back to 10. Okay. For 3 equity shares of Kiran Limited. The new shares are to be issued at 20 each, having a face value of 10. This is your PC point. PC point. Correct. Is that right? Net asset method, net payment method. Net asset or net payment? Net payment, they said 2 equity shares for every 3 shares. Okay, nothing to worry. Preference shareholders of Kiran Limited will be paid off by issuing equivalent number of 10% preference shares of Gyan Limited of 100 each at a price of 105. Net asset or net payment? Net payment. Directly they have told. Equal number we will give, but we will give it at little higher price. Okay. Now, dividend of Kiran Limited will be paid after merger to the shareholders of Kiran Limited. The dividend payable is there, no? That will be paid. When we will pay it? After the merger. Okay. Trade payable of Gyan Limited include 50 lakhs payable to Kiran Limited. This is your mutual owings. Clear? Pass necessary journal entries. Can we jump directly into amalgamation? No. Let's end our internal reconstruction first. Okay, let's end our internal reconstruction. Did you make a profit of 20 here? Did you make a profit of 520 here? That means you made a profit of 540. With this 540, what I will do? One loss was there. I will eliminate this loss. Okay. Is there any goodwill and all in the balance sheet? No. So see the entry over here. Reconstruction account debited 540 gone. 260. Remaining everything goes to capital reserve. This is the internal reconstruction point. Clear? What did you think? I'm in losses. Come and see me now. I'm in 280 profit. Are you getting my point? What did you think? I'm in 260 loss. Where is 260 loss? Now there is 280 in my capital reserve. Are you getting my point? 280 which is there, which I cannot use for anything. Book entry, no, it is. It is just book entry, by the way. Okay, but anyways, you made a better picture of yourself and you're going and purchasing someone else who already had a better picture. Okay, now reconstruction. Here internal reconstruction closes. Internal reconstruction closes. Now what we are supposed to do? Amalgamation. For amalgamation, always we need PC. What did they tell over here? 2 shares for every 3 shares. How many shares are there over here? 600. That means 60. 2 shares for every 3 shares. 60 into 2 by 3. 40 shares you'll issue. 40 shares. Into, we are going to issue the shares at what value? We are going to issue the shares at 20 rupees per share. Into 20. 800. But we are going to issue shares to somebody else also. See over here. Preference shareholders will be paid off by issuing equivalent number of 10% preference shares of Gyan Limited of 100 each at a price of 105. How many shares are there preference? 200. That means 2. That means 2 because it is face value 100. So 2 shares into 105. 210. 800 plus 210. PC will be 1010. Correct? 1010. Did you understand the PC calculation? They said 2 shares for every 3 shares, but not of 10 rupees. It will be issued at 20 rupees. So multiply into 20, you got 800. Clear? So you're going to issue 40 lakh shares, and here equal shares, but shares are going to be issued at 105. Okay, 1010. So we should find what should be the first entry? Business purchase account debited to liquidator of Kiran Limited. Clear? Next, what next? Assets and liabilities are going to be taken over, correct? At what value? Agreed value. Where did they tell us? Where did they tell us? Nowhere. So it is going to be taken at book value. Okay. Now, one by one, all the assets. Okay. Let's see. PPE directly 900. Yes, AS10. We'll see that tomorrow. PPE debited 900. What is the next asset you can find over there? Investment debited 250. Investment debited. After that, what can you find? Trade receivable. Trade receivable debited 135. Trade receivable debited 135. Then what can you find? Bank. Bank account debited 140. We are taking their money only and we are paying their dividend payable later. We are just taking their money only and later we'll pay their dividend payable after merger. 140. Clear? What are the liabilities that are there? Liabilities you can see over here. We have 12% debentures, 100. 12% debentures, 100. Then what do we have? We have trade payable, 105. We have dividend payable, 60. Assets debited, liabilities credited. At agreed value, nothing was mentioned. Book value only, agreed value. Clear? To business purchase, 1010. Now understand this. What is net asset taken over? Net asset is basically this. Assets minus liabilities. How much are you getting? 1160. 1160 is the net asset. Correct? What is the PC? 1010. Are you paying more or are you paying less? Are you paying more or less? You are paying less. So 150 will be actually capital reserve. But guys, all assets and liabilities are taken over. All assets and liabilities are taken over at book value only. Purchase consideration is given in shares only. 90% shareholders are coming this side. Are you getting my point? So what happens automatically? It is amalgamation in the nature of merger. Last condition automatically fulfilled. Business will be continued. Okay. Amalgamation in the nature of merger. That's why I cannot put this to capital reserve. That's why you can see general reserve. General reserve. You're like, sir, wait 1 second, sir. 1 second. See, sir, here Reserves 360 was there, no sir. Reserve 360 was there, sir. They took something else only. Now imagine you put 360 over here. You put 360 over here. What happens that time? Plus minus you do. 900 plus 250 plus 135 plus 140 minus 105 minus 60 minus 100 minus 360. You are writing 2 general reserve. What is the net asset you are getting that time? Calculator 1000. Not possible. 1160 we already got once. You have to minus one more 360. 800. 800. You'll get 800 as net asset. 800 as net asset. If you write 2 general reserve and then calculate 2 general reserve, you have to take all assets and liabilities. No. 2 general reserve, if I write 360, I'll get 800 as net assets. And PC is 1010. That means 210 should be subtracted. So 360 minus 210 is 150. Are you getting my point? Amalgamation nature of merger only. If you take 360, then you have to calculate your net asset will become 800, but what you are paying is 1010. That means you are paying more. You will pay 210 more. 210 more. What did we learn in the concept? Sorry. What did we learn in the concept? Where is that? See over here. If net asset is more, purchase consideration is less, reduce from reserves. So when you reduce the reserves to 10, you will get 150. That's how you got 150 over there. Is this clear? Yeah, you can directly take balancing figure itself. But in case the balancing figure goes that side, then balance sheet itself we can reduce. No. If you pass this journal entry, it will go to balance sheet. You can write 2. You're telling you'll show the 210 over there. No, if you write 2 general reserve here, you don't need to show calculation over there. Because general reserve got credited, you just go and add 150 to your existing general reserve. Is this clear? Are you following this? Did you understand how we got this 150? Clear? Did you understand why it is amalgamation in the nature of merger? Yes. Now, third entry is liquidator. That is a purchasing company. Capital reserve is in purchasing company. Selling company, they didn't do internal reconstruction. Okay. Now, understand this. Liquidator of selling company was 1010. How many shares we issued here? 40 lakh shares. 800 we got. So liquidator account debited to equity share capital 800. No. To equity share capital 400. Why? 40 into 10 only. Then 2 lakh preference shares. 2 into 100 only. 2 into 100 only. And then 40 into the extra 10 and 2 into 5 rupees. Both will go to securities premium. Both will go to securities premium. Is this clear? Face value, don't forget at all. Just don't take the number directly from purchase consideration working note and dump it over here. Remember, it is 10 rupee share issued at 20. Remember, it is 100 rupee share issued at 105. Clear? Yes. Now, what next? After that, actually, realization expense. We don't have any realization expense in this question. Then debenture settlement. Debentures are going to be settled. I don't think they have passed the entry, but in the exam, you don't miss it. There are debentures you are taking over now here. 12% debentures. Pass the entry in the exam. Debentures, 12% debentures debited to 12% debentures. What is the value of 12% debentures here? 100. You're going to write 12% debentures to 12% debentures. Pass the entry. You know why? Because even though value is same and percentage is same, those debentures are gone and new debentures of your company is issued. So no harm. Write this entry to stay on the safer side. Okay. Next. After that, debenture settlement done. Intercompany owings are there. How much is the intercompany owing? They said mutual 50. 50 has to be removed from trade payable also. 50 has to be removed from trade receivable also. So the entry will be what? Trade payable account debited to trade receivable. Okay. Then they told one extra point. Dividend of Kiran Limited will be paid after the merger. So dividend payable was there which you took over. Dividend payable account debited to bank. Clear? Are you following this? Debentures. No adjustment was there. That's what I told. No. If they don't tell anything, that means all assets and liabilities are taken over. Yeah, but that they have to tell us. Otherwise, debenture holders will become debenture holders. That's all. If they would have settled, they should have passed one entry. No, debentures account debited to bank, but that is not there. Yes. Huh? We want to? No. Which one? Bank? Huh? No, you have to pass this one. Don't pass. Unless they tell that it is paid, you can't assume that it is paid. But we know debenture holders are there. Because in entry number 2, we brought them here. Clear? Okay. Now, listen. Next, balance sheet. Balance sheet. How much is the share capital over here? 650. But I can see it as 130. 650, but I can see it as 130. Why? Remember, I reduced it to 130 that time during internal reconstruction. 130 plus, what did we do? Shares issued, 400. So, equity share capital becomes 530. Equity share capital notes. PC calculation, that is okay. Notes to accounts, I think I skipped it. I thought not required. So, we'll just show it over here. Equity share capital, 130 plus 400 becomes 530. Clear? Preference share capital. How much was there? Preference share capital 150. No reduction happened in preference share capital. This is also 200 only. Don't think, sir. 210, sir. 210. Extra went to premium. So, sorry, 150 plus 200 makes it 350. 350 plus 530, 880. Equity share capital. Reserves and surplus. Reserves and surplus, we had 260, which became capital reserve. Capital reserve is how much? 280. And from them, I got general reserve. Entry number 2. Sorry, where is it? Yeah. Entry number 2. Can you see general reserve 150? 150, no? Where is it? Here. 150. So how much was there? 280, right? Capital reserve we got created. So 280 plus 150. Yes. 280 plus 150. How much are you getting? 430. Did we have some reserves? Securities premium got created. Yes. Where is it? 410 rupees securities premium. So plus 410. 840. This is the capital reserve which is there in the purchasing company. This is the general reserve which we took over in assets and liabilities takeover entry. And then we have 410 which is securities premium. Is this clear? Now, after that, long-term borrowings. Okay. Do we have some long-term borrowing over here? Loan from bank. Is it still there? Debentures, loan from bank. This 40 has become 20. 50% is waived off, cancelled. So 75 plus 20 plus 100. 75 plus 20 plus 100. 75 is the debenture over there. 100 is the debenture over here. 40 loan has become 20 because of internal reconstruction. 195. Is this clear? Trade payable. Trade payable, what you are going to do? 95 plus 105. This is actually 200. But there was something mutual. How much was the mutual? 50. So can you see it became 150 over here? So 200 minus 50, 150. Can you see this? Okay. Borrowings. Nothing but this OD. OD 15. Now this OD actually can be settled with the cash and cash equivalent also. If you put it on the liability side also, no harm. Okay, both are right. Now, next, after that, assets, property, plant and equipment, no change in value at all. 700 plus 900, directly you will get 1600. Investments, no change at all. 250, directly 250. Then, current trade receivable, 65 plus 135 minus 50. You should mutual owings. That time you will get 150. Which we removed in trade payable also, we are going to remove in trade receivable also. Next, cash and cash equivalent, 140 minus, we used it to pay somebody. Dividend payable, how much was the dividend payable? 60, 140 minus 60 should be 80, and that is your balance sheet. That's it with balance sheet. Purchase consideration, we already calculated 1010. That is it with that particular question. That is first question of amalgamation done. Question number 2. CA Inter Jan 2025. Okay, we have to see, no? Huh? We don't have any time limit. Okay, we are going to discuss in detail because we are not going to solve it. If I just tell here, then it will be like there. Okay, we don't want that. Okay, we'll discuss. Writing time is obviously not possible, so we'll discuss every amount in detail. Yes, you can take a break for your breakfast, guys. Come back at 11. Now it's 10:26. Come back at 11. We'll continue at 11 o'clock. Okay, we'll go to the next question. Question number 2 from Amalgamation. CA Inter Jan 2025. Okay, recent exam. We'll see what they had asked and slowly we'll proceed in that way only. Okay, following is the summarized balance sheet of Light Limited and Bright Limited as at 31st March 2024. Now, rupees in lakhs, both the places. Share capital is given. Reserves and surplus, long-term provisions, trade payable, property, plant and equipment, inventory, trade receivable and cash equivalents. Now, share capital, 50,000 equity shares of 100 each. Rupees in lakhs, okay, 50,000 shares of 100 each, that makes it 50 lakhs. No preference shares and all. Statutory reserves, no confusion, they only told you it is statutory reserves. General reserve, securities premium and P&L, clear? Property, plant and equipment also, we have 3 of them. Now, other information. A company, Rainbow Limited, Light and Bright becomes Rainbow, is formed to acquire the assets and liability of both the companies. That means this is the purchasing company, clear? Assets were acquired at book value except land and building of Light Limited, which is revalued at 62 lakhs. End of the story. Amalgamation in the nature of purchase. We don't even have to think further. Okay. Other assets of Bright Limited are obsolete. That means not there at all. Useless, 0. And are scrapped and sold for 50,000. By Bright Limited. That means it is useless. But they sold it at scrap value of 50,000. Which will be 0.5 lakhs for you. Okay. By Bright Limited itself. Before acquisition of its assets and liabilities by Rainbow Limited. When are they selling? Before acquisition. Before acquisition. That means it is not taken over. Its asset is sold before acquisition. That means it is not taken over. Are you getting my point? So asset and liability taken over, transfer to realization. Asset and liability not taken over, don't transfer to realization. It is sold before only. Okay, Light Limited and Bright Limited will be issued 80,000 and 64,000 equity shares of 100 each, respectively, of new company Rainbow Limited in lieu of purchase consideration. You cannot get an easier purchase consideration than this one. Directly they told 80,000 equity shares, 64,000 equity shares of 100 each. PC will be 80,000 plus 64,000, which is 1,44,000 into 100 makes it 144 lakhs. Rupees in lakhs anyways 144 lakhs. Okay. You are required, not me, to prepare realization account and equity shareholders account in the books of Light Limited and Bright Limited. Opening balance sheet of Rainbow Limited as at 31st March 2024. Both places, 14 marks. Clear? Now, without journal entries, you should be able to prepare the opening balance sheet. If you write journal entries and prepare opening balance sheet, you might not make mistake, but it will take time. Clear? So without journal entries, you should prepare it. Now, realization account, equity shareholders account. Clear? What are the things that we have? First thing, assets, land and building, plant and machinery. Other assets. Who is the purchasing company? Who is the selling company? Rainbow is the purchasing. This is also selling. This is also selling. Clear? Okay. Now, let's go further. Can you see other assets of Bright Limited? First only they have shown the working note. Other assets of Bright Limited. How much was there? 1.75. 1.75. It is sold at what value? 50,000. That means it is sold at 0.5. That means 1.25 is a loss. Debited to P&L they are telling, not realization account. Why? Why? Before acquisition, not even during acquisition. Before acquisition itself, this is sold. Clear? So debited to P&L. Ultimately, what difference it makes? From realization, impact is on equity shareholder only. P&L also impact is on equity shareholder only. Okay, so this is the situation. And one more thing, what you have to understand, you got 0.5 lakh, no? So your bank balance, it was 2.85 before. Can you see the bank balance? 2.85. You got 50,000, 3.35. So now, when the acquiring company, Rainbow Limited, when I come there over there, I have 3.35 lakhs in bank. When I'm arriving for acquisition, I have 4 minus 1.25, 2.75 in P&L. Is this clear? Are you getting my point? Okay. So basically what you have to remember, other assets not there at all. Other assets not there at all. Cash and cash equivalent has changed. Okay. And P&L also changed because of loss on sale. Clear? Now they have asked realization account. Okay, both the companies. First, what is the first asset? When you transfer assets, what will happen? When you transfer assets, realization account debited to asset account. See the PPE here. One by one, land and building, plant and machinery, and other assets only one place. Or other company, there is no other asset only. It's already sold. So now you can see over here, land and building, plant and machinery, other assets. Here it's not there because it is already sold before acquisition. Before acquisition. Okay. Now after that, you have inventories, trade receivable, cash and cash equivalent. Now some of you are thinking, wait sir, one of the asset, the value was changed. That is not our concern because we are transferring everything at book value. Clear? So 5.75 and 7.1. Can you see 5.75 and 7.1? Yes. 4.3 and 5.8. Can you see 4.3 and 5.8 just transferred? Then cash balance 3.15 and 2.85 is not there. 3.35 because we sold. Correct? Can you see 3.15 and 3.35 there? Where are you getting 3.35 from? See, new cash balance is 3.35. So when we go for acquisition, there is no 2.85. 50 got added in the cash and cash equivalent. Is this clear? So this should be the situation. Now liabilities. Let's look at the liabilities. What do we have? Long-term provisions. Only one company had it. And trade payables. Both the companies had it. There is no concept of, there is no change in the value and all. Book value only we took it. Okay. After that, that is step 1, right? Step 2, sale of assets which are not taken over. It's already sold. It's already sold before acquisition, not during acquisition. See, there are two things. I go there for the meeting. I see all the assets. I'm like, this I don't want. Okay, these I will take. Now this I don't want, so they will sell. This did not happen here. What happened here? Before I reached there only, they already sold it. Before I reached there only, they already sold it. So when I went there, I didn't see other assets at all. When I went there, I saw the cash balance directly at 3.35 only. Are you getting this? Before acquisition, not during acquisition. Okay, next. After that, we know the PC. Did we calculate the PC? What was the PC which we calculated at the time? Where was that? 144 lakhs, right? Okay. Now see this. 144, 80, 64. Okay. Entry, purchasing company account debited to realization account. Did they ask you purchasing company account? No, unnecessarily don't do it. They didn't ask you purchasing company account. Unnecessarily don't do it. Okay. So purchasing company, that's it. After that, the next steps are PC receipt. What are we getting? Equity shares. What are we getting? Equity shares. How do you know that, sir? Here only they told, sir. See here. They are going to issue 80,000 and 64,000 equity shares of 100 each. Face value. Done. Okay. The entry for that will be what? Equity shares in Rainbow Limited to purchasing company Rainbow Limited. We are not preparing either of these ledgers. Done. Okay. Realization expense not there. When means? On which data? 31st March. Maybe starting of the day. They had a meeting. Middle of the day. They finished the amalgamation. Yeah. Before acquisition. Very good question. That's why we never write on. 31st March. We write as at 31st March. That means as at 31st March, opening balance sheet, as at 31st March, closing balance sheet also. At, it can be morning 10 o'clock. This can be evening 5 o'clock. Sale would have been afternoon 2 o'clock. Are you getting my point? Practically not possible. Exams only this will happen. Practically what? For them to think that they have to sell the asset only, it will take 1 day. Just to decide that we have to sell the asset, it will take 1 day. Okay. So, as at 31st March, everything is happening at 31st March only. We'll follow the dates because it's pre-amalgamation event only. We are selling this asset, yes. First is sale. That's why when we prepared realization account, there was no other asset at all. That's why we passed the entry to P&L. We didn't put it to realization. See, simple guys, simple. All these desks and benches are there. I arrive at this place. I want to amalgamate. I see these desks and benches. 2 I don't want. I leave it. That is during amalgamation, not taken over. Before I reached here, they already sold 2. That is before amalgamation only, it is already sold. So when I arrive here, I don't see those 2 benches at all. When I arrive here, I will not see the cash balance before the sale. I will see the cash balance after the sale. Clear? Yes. Now, what we do next? Realization. See, whatever profit or loss is there, it is transferred to equity shareholders. That's the only thing, balancing figure over there. Equity shareholders, what and all they should get? They should get the share capital. They should get all these reserves. But be careful, P&L is not 4. P&L is not 4. Did we have a loss? How much was the loss? 1 point, see over here. First, that's why it was calculated first. What was the loss? 1 point, where are we? Yes, 1.25. Can you see the P&L balance is 2.75 before amalgamation. Now, if you notice, everything else came directly from the question. Everything else directly from the question. Equity share capital to equity shareholders, reserves and surplus to equity shareholders. Only P&L is not what you are seeing in the question because before amalgamation there is a small change. Clear? Now, and we also got this by realization account, that is profit. Transferred, done. There is nothing. If you notice, 80 and 64 only will be the balancing figure. No. No. Huh? That time means previous question. That is just to save time. That is just to save time, that's all. But don't do it because every ledger is individual. No. Don't do it. Okay, now 80 and 64. Shares. You have to pay 80. Remember PC was 80 and 64 only. That's the end of the question from selling company side. Purchasing company side, what will happen? Only one thing changes. What is that one thing? Land. Correct, land, no? Building. What is that? Yeah, land and building will be, which was revalued at 62 lakhs. So if you see, everything will be book value only, but property, plant and equipment will be, see, land and building, one company 62, other company, what is it? Which company is changing? Light Limited. Which is Light Limited? First company. So this will be 62 and this will be 44. That means it will be 106. Can you see 106 over here? Other than that, plant and machinery, 7.5 plus 4.5. That became 12. Then, if you see other assets, 3.2 plus 1.75. No, not there. Only 3.2. Clear? Then, intangible asset. From where did they get this intangible asset? You have to compare. If you would have passed entries, you would automatically get the intangible asset. Clear? But because you didn't pass the entries, you have to do it. So it will be PC and net asset. PC and net assets. Clear? Now, if you notice, okay, PC we already know 80 and 64. Now net assets, everything we have written over here, everything. Only thing that changes is what? Land and building value, which is changing here. This is 62. Other than that, everything is book values. All are. This is the one which changed, land and building. Huh? Yeah, cash at bank will change. Okay, but other than that, other assets are gone. Cash, we have added that whatever value we got 0.5 when we sold that scrap amount. And this is your assets. Minus liabilities. All as per books. Liabilities. Clear? You got the net asset. Okay, you will get the net asset when you subtract this 81 and 62.75. How much you are paying over for the first person? 80. And here it is showing 81. You are paying more or you are paying less? 1. Correct? Capital reserve. Here 64 you are paying, but it is 62.75. That means 1.25. What did they do? They took 1.25 as goodwill and they put 1 into capital reserve. You could have set it off also. Yeah, you could have set it off also. No issues. Okay, they kept it separate and they have done it. If you set it off also, no issues because it is one amalgamation still. Why you kept separate somewhere? Which exam? Hey, it's okay. We need to be strict there. Okay, I just wanted to follow one method. ICAI will follow, say, same thing in some other question, they will set off. Okay, we'll follow one thing so that we don't mess it up there. How much you are supposed to get? Hey, test is option only. I allow you to go home. I allow so many people to go home. Where? That to tell bye to you. When you're going, that's fun. Okay, guys. Let's continue. Now, if you look at the balance sheet, other than that, there is no problem in this balance sheet. Everything is straight away. See, 1,44,000 shares are issued. It is issued at par only. So there is nothing. Only thing is this statutory adjustment is also there. Why? Statutory reserves were there. It is amalgamation in the nature of purchase. How do we know? Because the land and building value changed. Okay, statutory reserve. Can you see? I told you it will have a nil effect, but you still have to show it. Okay, you'll write statutory reserve, you'll write amalgamation adjustment reserve, done. Finished. Okay, this shouldn't be a problem. I don't think there is any issue with this. Simple question it is. This could have been set off, yes. Okay, let's go further. 2 questions done of amalgamation. Let's go to the third one. CA Inter, September 2024. I'm just revising the recent ones only. Okay, before we go further. The following are the summarized balance sheet of Well Limited and Nice Limited. Okay, nice names they are giving. Do you notice something? Huh? No, it is not. It is schedule 3 years, but bigger than that, do you notice something? Oh, when we see that, what do you think? Something merger has happened. Not merger of companies, merger of concepts. Okay, now share capital reserves and surplus, long-term borrowing, trade payable, short-term borrowing, all these things, inventory, trade receivable and all that, cash and cash equivalent. They have given the question. Okay, only equity shares are there. So that thing is little less. Oh, preference shares are also there. And also one is 9%, one is 10%. So we'll see what they have asked. Balance in P&L only, no general reserve and other reserves and all. This is loss. Okay. 9% debentures, 10% debentures, 2 debentures are also there. Details of trade receivable. When they give like this, no details of trade receivable, very common point by ICAI in amalgamation is they will tell you something is common. Otherwise, trade receivable together, they'll tell something is common. Mutual owings. Now they might tell mutual owings debtors. Bills receivable normal. They might, we will see. We don't know. Okay, on 31st of March, Nice Limited absorbs the business of Well Limited on the following terms. Nice Limited is the purchasing company. Well Limited is the selling company. Our first column is Nice Limited, second column is Well Limited. Okay. For every 5 equity shares held by equity shareholders of Well Limited, they receive 3 equity shares issued at a premium of 20 per share. That means it is issued at 30 per share. Issued at a premium of 20. New price is not 20. Premium is 20. Okay, we know this is for PC. Okay. 10% debenture holders of Well Limited were to be allotted such 9% debentures in Nice Limited as would bring the same amount of interest. Wow. This point is a beautiful adjustment. They're like, what you were getting before, that only I will give you, but you should get this, the interest rate will be changed. Okay. Now debenture holders. Check. Debenture holders 900. Okay. 900 into 10%. That means before they were getting 90. And now also they should get 90 only, but we will allot them 9% debentures. So divided by 9%. So now the debenture will be 1000. Debentures will be allotted. Now 1000. New debentures are 1000. See, obviously no. If the rate of interest goes down, to match it, value has to go up. If rate of interest goes up, to match it, value will go down. Clear? So this should be the debenture value 1000. 10% preference shares of Well Limited are to be paid at 10% discount by issue of preference shares at par. We are giving them 10% less. How are we giving them? By issuing our shares at par. Don't think that shares are issued at discount. No, shares are issued at par itself. Are you getting my point? Don't think that shares are issued at discount. Shares are issued at par itself. Clear? But you have to remember one thing. Okay, we are giving them 10% less. How are we giving them? I can give them money also, but I'm giving my shares. My shares will be at par. Clear? So whatever preference shares are there over here, how much is the preference share? 1800. So I will be giving them 1800 minus 10%. 1620. Clear? Yes. Banks agree to waive off loan of 270,000 as well. Did we have this point that time? Internal reconstruction added. Well Limited, now their internal reconstruction was in the purchasing company. Here internal reconstruction is in the selling company. Expenses of liquidation of Well Limited are to be reimbursed by Nice Limited 55,000. Realization expense. Inventory of Well Limited is taken over at 10% more than their book value over. Amalgamation in the nature of purchase. 10% more. Debtors of Nice Limited include 215,000 receivable from Well Limited. That means this is a mutual owings point. See, debtors. Debtors, not trade receivable. Debtors. That's why they gave you debtor information separately, bills receivable separately. Are you following this, guys? See over here. We have debtor information, we have bills receivable information. Only here there is mutual. And here there is mutual. Bills receivable and bills payable, same as per books only we are supposed to take. Okay. Property, plant and equipment of Well Limited are revalued at 20% above their book value. Okay. Remaining assets and liabilities of Well Limited are taken over at book value by Nice Limited. You are required to record journal entries in the books of Nice Limited. Who is doing internal reconstruction? Let them do. Who is doing internal reconstruction? Let them do. We are who? Nice Limited. We will pass only the purchase entries. But what will happen in internal reconstruction? Only one point has happened. No, bank agreed to waive off the loan of 270. Bank agreed to waive off the loan of 270. Other than that, can you find any internal reconstruction point? Inventory taken over. Debtors include property, plant and equipment of Well Limited are revalued at 20% above their book value. All this is about amalgamation. Correct? Now, 270. What is the bank loan? Go and find the bank loan. Can you find the bank loan? Where is it? Yeah, loan from bank. Who? These people. 270 is gone. 270 is waived off. Okay. 4,000. Okay, that will be the new value. 4,255. What will we do with this 270? It will adjust with their loss. Why are we worried? Amalgamation in the nature of purchase. Why are we worried what they are doing with that? Amalgamation in the nature of purchase. Are you getting this? Given but not required. While taking loan will change. You don't worry about what happens to P&L balance. Whatever happens to P&L balance, it will go to shareholder. Did you get this? Okay, now let's go further. Journal entries in the books of Nice Limited. Prepare balance sheet of Nice Limited after absorption. Okay, that is it. They have not asked anything else. Let's go into question number 3. Business purchase account debited to liquidator of Well Limited. Now, if you notice, where is the PC point? Where is the PC point? This one. And one more PC point is sitting over here, 1620. For every 5 shares held, we are going to issue 3 shares. How many shares are there over here? Equity share capital 12,500. That means 125. For every 5 shares we are going to issue 3, or for every 3 shares we are going to issue 5. For every 5 shares we are going to issue 3. Can you see over here? For every 5 shares, 3 shares are going to be issued. That means it is going to be multiplied into 5 by 3, no? Oh, not 5 by 3, huh? Huh? Oh. For every 5 shares, we are going to issue 3 shares. So is it 5 by 3 or 3 by 5? Now you know why you are getting confused, because usually the language was 3 shares are issued for every 5 shares. This is how the language was. Oh, first number will be numerator, second number will be denominator. But here they said for every 5 shares, 3 shares are issued. Means the same. Clear? So into 3 by 5, 75 into, is it issued at 100 rupees? No, it is issued at 120. Okay, that time I think I told you 30 because 20, I thought 10 rupees face value. It is 120. 9,000. Clear? This 9,000 calculation, and preference shares how much we are giving? 1620. 10,620. 9,000 plus 1620. Can you see 10,620? Clear? Okay. Now, journal entries after that. Second, takeover of assets. What property, plant and equipment they have? Where is it? PPE. What do they have? There is a note also for this. Okay, I think. Oh, they wrote note, but no note. Sorry. They wrote note number 4, but it's not there actually. 16,380. But what did they tell about property, plant and equipment? Can you see they said that property, plant and equipment 20% above. Can you see 120% they have taken? After property, plant and equipment. Inventory 10% above. Can you see 10% they have? 110% they have taken. Can you see this 110% here? Trade receivable. Now listen. Trade receivable. Is there something mutual? How much is mutual? 215. Now listen to this trade receivable. 6,200. 1,800 minus 215. Minus 215. How much? 7785. Here 390. And 150 is how much? 540. Please total this. 8325. Wait, what? Did we take some wrong number here? Oh, we took both. Why are we adding both? It's one is selling company, one is purchasing company. No, what is this? 1,800 minus 215. That's what I'm saying. Some huge number we are getting. 1,585. And then there it is only 540. So 1,585 plus 540. Ayo. 1,585 plus 150. Sorry. 1,735. Only here there is intercompany owings or mutual owings. In this 150 there is no intercompany owings or mutual owings. So 1,900. Okay. What they have done is they have not cancelled. They have taken full value. Later they are cancelling it. Okay. Simply we did circus. Okay. Full value. Later I think they have passed one entry. Where is that entry? See over here. The 215 entry is there over there. Mutual owings cancellation separately. Okay. Goodwill is balancing figure, will not get there. Trade payable also, then direct figure. Can you see the trade payable? 4850. Direct figure. Later cancellation we will do. Debenture holders 1,000. How did it change from 900 to 1,000? Because we have already taken over there 900 divided by 10% or something. 9%. That is 1,000. Loan from bank. I told you when we go and check, loan will not be the same amount. It will be minus 270, 4255. Short-term borrowing as it is directly from the question. What is the short-term borrowing? Short-term borrowing directly we are going to take 1975 direct amount. Business purchase we already know. What they did basically, PC. PC is how much? 10,620. What is a net asset? Net asset is these things plus and these things minus. You're getting some net asset. How much is that? Add all the assets. Don't add goodwill, please. Goodwill, we have to get it. 10,483. 10,483. This is your net assets. Okay. 137 is goodwill. You're paying 10,620, but you got net assets worth only 10,483, 187, sorry, 137 is goodwill. Now tell me one thing. Why didn't we adjust this in reserves? 90 divided by 9%. Why are we not taking reserve? Why are we not adjusting in reserves? Because it is amalgamation in the nature of merger. I'm sorry, purchase. What is happening? Okay, business purchase. Next, liquidator. When you're taking, can you see only 100? Why 100? Face value. Okay, and remaining, this is anyways at face value. Sir, no. This was not at face value. It is at discount. It is paid at discount, but we are issuing our shares at par itself. It is paid at discount. Securities premium is the 7,500. Sir, from where you're getting this 75,000 shares? Can you see over here? Okay, we already have share capital. Okay, we already calculated also. Where is this? Yeah, here. Can you see we calculated 125. 125 into 3 by 5. How much you're getting? 75. 75 rupees in thousands. So 75,000 shares. But only 100 should go to share capital and 20 should go to securities premium. That's why we passed that particular entry. Clear? Next. See, debenture holders account debited to debenture. 1,000. But what we are doing? We are cancelling the old people by giving them new debentures of 9%. Then after that, the mutual owings are also cancelled. Then finally, realization expense point was there in the question. Where is that point? Realization expense. It's over here, 55. What got created in entry number 2? What got created in entry number 2? Goodwill. So here the entry will be goodwill account debited to bank account. Now what was the goodwill amount over there? 137. And what is the goodwill over here? 55. 137 plus 55. That should be 192. This should be the intangible asset in the balance sheet. Can we find the intangible asset? 192. Other than that, what we are going to do? Entry number 2, whatever came, we are just going to add that, right? Entry number 2, whatever came, we are just going to add that. Where is the change going to happen? Only change is in, I think, long-term borrowing. Long-term borrowing. 275 will be subtracted. Why? 270, yeah? 270 will be subtracted because it is already waived off. And then trade payable you are going to minus the mutual 215. Then trade receivable you are going to minus the 215 mutual. Other than that, inventory already we have taken higher value, and cash and cash equivalent. What are you going to do? Same. Expense will be subtracted. How much was the good expense over there? 50. Are you sure? 55. Yes, 55 will be subtract. Clear? Rest other than that, we have already journal entries. Old balance sheet plus journal entries, you'll get the new balance sheet. I don't think there was any problem in this question, right? Nothing is there. No issues at all. Nice limited, well limited. They are preparing notes. Yes. That should be it with question number 3. There shouldn't be any issue. Let's go to question number 4. See enter May 2024. 3 more questions are still there in amalgamation. This is one of them. 4, 5, 6. We didn't even finish it. Huh? We didn't even finish it, no? Why are we taking this? Intelligent Limited and Diligent Limited are carrying on their business independently. Okay, guys. Shh. For last 2 years, following financial information is given. Okay, you can see Intelligent Limited, Diligent Limited. They did not follow Schedule 3 this time. They just gave you one list. Okay. Now, on 1st April, both the companies agreed to amalgamate and form a new company called as Genius Limited with an authorized capital of 40 lakh, rupees 40 lakh, divided into 30,000 equity shares of 100 each and 10,000 preference shares of 100 each. Clear? Any doubt with this till now? No. Amalgamation has to be carried out on the basis of the following agreement. Why we took this question is because in study material there is one question, okay, which talks about some Neptune and all that. Okay, there Moon and Neptune or something. There is a different way of calculating the purchase consideration. Same question came in exam. See, same thing. You can see it. Assets of both the companies are to be revalued. They have given what is the new values of assets. Then trade payable of Intelligent Limited includes 1 lakh due to Diligent Limited and trade receivable includes 1 lakh payable to receivable from Intelligent Limited. This is obviously mutual owings. Will not think about it now. Later it will be cancelled. Clear? Purchase consideration to be discharged in the following manner. Issue 22,000 equity shares of 100 each, fully paid up in proportion of sum of their profitability in the preceding 2 financial years. We have these kind of questions too in study material. One place it is sum, another place it is average. Ultimate result will be same. Ultimate result will be same. If you take sum also, you will take average also. Because sum also will be in same ratio, average also will be in same ratio. Because both you are going to divide by 2. Ultimately it will be same. Okay, sum whatever it's there, we are going to give 22,000 shares. Okay, 22,000 shares. How are we going to give? In which ratio? Last 2 years, whatever profit they had, in that ratio will distribute. Okay. Preference shareholders of both the companies are issued equivalent number of 8% preference shares of 100 each of Genius Limited at a price of 125 per share. We are going to give equivalent number of preference shares, no problem. 12% debentures issued in Genius Limited at par to provide an income equivalent to 10% return on capital asset, net assets, respective business. Okay, after revaluation of assets. Oh, this is the circus. This is the circus. Okay, what we have to do? We have to give them some value. How much? We don't know. We have to calculate. Then we will see what is to be given. Compute amount of shares and debentures to be issued to Intelligent Limited and Diligent Limited. Prepare a balance sheet of Genius Limited showing the position immediately after amalgamation. Now, many of you are wondering, sir, when this question was given, no sir, in study material, when they told this 22,000 equity shares, no, immediately after that one table was given, sir. Immediately after that one table was given. Profit, 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 profit. One table was given. Here it is not given. So what you have to do? Go into the information. Can you see they have told P and L? They told P and L, opening balance, profit for the current year. Opening balance means previous year. Profit for the current year is current year. When you total this, you will get 7 lakhs. When you total this, you will get 4 lakhs. That means the ratio is going to be 7:4. So 22,000 shares, you will distribute in the ratio of 7:4. So what is it? 14,000 and 8,000 shares. This is just shares. This is just shares. Is this clear? Now when we know the shares, what is the value? 22,000 shares of 100 each. So 14,000 into 100 makes it 14 lakhs. 8,000 into 100 makes it 8 lakhs. This is one part of your PC. One part of your PC. What else are we giving? Preference shareholders of both the companies are issued equivalent number of 8% preference shares of 100 each at a price of 125. Same number of shares, but we will give them at 125. Okay. What is the preference share? 3 lakh. Here it is 2 lakh. So what we will do? It is going to be basically 3,000 into 125, 3,75,000, and here it is going to be 2,000 into 125. This is the amount what we are going to give as preference share. This is also our next PC thing. Straightforward. Are we getting this? Straightforward, no problem at all. Now what is the main thing over here, over this one? Sir, why should we consider, sir, debentures? Because debentures are issued to whom? Debenture holders, no. They are issued to shareholders only. 12% debentures of 100 each in Genius at par to provide income equivalent to 10% return on the basis of net assets. You have net asset, no. Shareholders should get 10%. On what? The net asset. How should we give the 10%? Every year we'll go and give money here? No. What we will do? We will actually issue debentures which will give equal amount every year. Clear? So understand this. I think our initial calculations, equity shares, can you see 14 lakh and 8 lakh? We already calculated that. Preference shares 375 and 250. Only major thing is this one. Net asset. What is the formula for net asset? Asset minus liabilities at agreed value. At agreed value. So what we will do, there is another working note which has to be prepared obviously. Okay. Ratio of equity shares and all we have seen. Net assets. Okay. Now, can you see one nice table is given which tells us about revaluation? See, this one will take 11 lakh and 8 lakh 50. 11 lakh, 8 lakh 50. Okay. This also got revalued. So 9 lakhs, 4 lakhs. Okay. Then inventories also got revalued. 6 lakhs, 3 lakhs. Those three got revalued. Others did not get revalued. So what we will do? We will go to the question itself. We'll go to the question itself. Land and building, plant and machinery, inventory done. Trade receivable, 6 lakhs, 3 lakhs. Directly, book value. Okay, then cash at bank, 4 lakh, 1 lakh. No payment, no receipt has happened over here. Pre-amalgamation and all, nothing has happened. Okay, trade payable, 12 lakh, 4 lakh. And one fund is the retirement gratuity fund, long-term provision, 3 lakh, 2 lakh. Sir, before this retirement gratuity fund, we should distribute to partners, sir, in partnership. But not yet. Okay, don't worry about that. This is your net asset. This is your liability. This is your net asset. I should get what? 10% of this. 10% of this. Into 10% you will do. That is basically 2 lakh 10 and 1 lakh 35. But we are not issuing debenture at 10%. We are issuing debenture of what value? We are going to issue debenture at 12%. So we have to get 2 lakh 10 and 1 lakh 35 in hand. So what we will do? 2 lakh 10 divided by 12%. If you do, you will get 17 lakh 50, which is 7,500 debentures. Same way, 1 lakh 35,000 divided by 12%. If you do, you will get 11 lakh 25,000, which is nothing but 11,250 debentures. Is this clear? Are you following this? Understand this, very important. They said to shareholder, I should give 10% of net asset. Okay, I have to give 10% of net asset to shareholder. How to give? Am I going to go and give money to them? No, I will not give money. For them to get that 10%, I will issue debenture. Debenture return should be equivalent to the 10%. Debenture is not issued at 10%. Debenture is issued at 12%. So when I issue debenture divided by the return, you will get the actual amount of debentures that has to be issued. This value will also go into your PC calculation. I think we had our PC calculation at the starting. 17 lakh 50, 11 lakh 25. This is our PC. This is our PC. Once our PC is done, actually in this question, there is nothing. Okay, prepare balance sheet. What we are going to do when we prepare balance sheet? What are we going to do? Assets and liabilities which got revalued, we will take new figures. Assets and liabilities which did not get revalued, we will take old figures. But there is a mutual thing which we will cancel. That is what we did, no, but we saw institute is doing later. But well calculating net asset, don't do it. Okay. It will not make much of a difference actually. Ultimate goodwill capital will be same, but still don't do it. They are giving both solutions actually. In suggested answers, if you see, they are telling alternative solution and this solution. Both they are giving. If you are cancelling also fine. If you are not cancelling also fine. Not cancelling is best because when you pass journal entries, you don't cancel first. You cancel later. So if you have to pass journal entries, then you have to first take over everything. Then you will go and cancel it later. Yes. Now, let's go further, guys. Balance sheet. One by one, we will discuss the balance sheet. Shares issued how much? Listen. 14 lakh, 8 lakhs. This is also shares. 3 lakh 75. This is also shares. 2 lakh 50. This is also shares. If you total all that, 22, 24, 27, 28 lakh 25,000. But you are seeing only 27 lakhs. Why? Because there somewhere we have issued at premium. That 125. Do you remember 125? Where you got 3 lakh 75,000 and 2 lakh 50,000. 3 lakh 75,000 was 75,000 premium. 2 lakh 50,000 was 50,000 premium. So totally 1 lakh 25,000 goes into securities premium. Is this clear? Okay. Now after that, long-term borrowing. From where did we get this long-term borrowing? If you look at the question, do you have any borrowing in this entire question? No. From where did you get it? You issued debenture. Can you see the 1750 and 1125? 28 lakh 75,000. Correct? Other current liability. What is this other current liability that you are having? Retirement gratuity fund. Even though they told long term, institute has taken it as short term. Or non-current only. Okay. Institute has taken correctly only. 5 lakhs. Always you should not shout at them. Okay. 5 lakhs. Okay, no changes at all. Book value only, or just adding it. Can you see? I told you minus 1 lakh we have to do. Okay, minus 1 lakh. PPE we already know. We just took for net asset calculation. From the net asset only directly we'll put it over here. Revalued figures. Intangible asset they got. How did they get intangible asset? Because if you see the question, we just did net assets, right? How much is the net assets? 21 lakh and 13 lakh 50. 21 lakh and 13 lakh 50. That is the net asset. What is the PC? Can you see the starting of the thing? 35 lakh 25. Here it was only 21 lakh. And 21 lakh 75. Here it was what? 14 lakh 25,000. Array 35 20. Okay, 21 lakh 75. What was the net asset there? Net asset was only 13 lakh 50,000. 13 lakh 50,000. 8 lakh 25,000. 1425 plus 825. That is your intangible asset. Are you getting my point? Okay, you have to do the working note. See, till net asset, anyways, you have to do the working note to calculate PC itself. Once after that, then you get the total PC. Just put that over here. You'll get goodwill or capital. Clear? Inventories, just add two things. There is no stock reserve or anything revalued and all. Trade receivable, add two things, but remove the 1 lakh. Cash and cash equivalent, no change at all. Add the two things, you'll get the values. That's it. Clear? That Neptune and whatever, Moon and Neptune or something. Sun and Neptune. Even before Sun and Neptune, I think starting of the study material, there is one more. Huh? Ganga and Neel and Gagan. Not Ganga. Neel and Gagan. Okay, Neel and Gagan question also is the same thing. And at the end also we have the same question, and that only they have put into exam also. So basically it's again a data game. That's what I'm trying to tell you. Okay, that is it with that particular question. Question number 4 done. Question number 5. I told you all good things we will not take. Some irritating things also will take. RTP May 2018, once upon a time. But there are some adjustments which we have to discuss. Sir, in mock paper it was capitalization method. Okay, very good. Goodwill, no? Yes. Okay, guys. RTP May 2018 question. We have to discuss this. Why? As we start reading that, you will only realize why we are discussing also. Okay. Now, see, old adjustments. ICAI will search now for twists. Twists where they find, they will take it and put it. Clear? Now, P Limited and Q Limited agree to amalgamate their business. The scheme is envisaged a share capital equal to the combined share capital of P Limited and Q Limited for the purpose of acquiring the assets, liabilities and undertakings of the two companies in exchange for share in PQ Limited. 1 second. Okay, now this part of the question becomes very, very critical. Understand, P Limited and Q Limited agree to amalgamate. The scheme envisaged a share capital equal to combined share capital of P Limited and Q Limited. Whatever capital was there of P Limited and Q Limited, it should be same. It should be same. How it will be same, we will see later. Acquiring assets and liabilities of both the companies in exchange for shares. Summary of P Limited and Q Limited is given. Very, very important question. One of the very, very important questions. Here, now, listen. P Limited, Q Limited. P Limited, Q Limited. Both are selling companies only. Balance sheet is given. Share capital, reserves, bank OD, trade payable, okay, fixed assets, excluding goodwill. There is no goodwill. Okay, that means goodwill also should be there. They said excluding goodwill, that means goodwill also should be there. We have to calculate. Inventories, trade receivable, cash at bank. Okay, small balance sheet, horizontal balance sheet they have given. Old question, no. Now, consideration was to be based on net assets of the companies as shown in the above balance sheet. Oh, net asset method at book value only, but subject to an additional payment to P Limited for its goodwill to be calculated as follows. Sir, somewhere in my life, I had this goodwill calculation, sir. I got rid of that and I became very happy. But again, they are asking, okay, calculated as its weighted average of net profit for the past 3 years ended 31st March 2017. Weights for this purpose will be 1, 2, 3. Oh, what a favor they have done. They have given the weights also. If they would not give the weights, imagine this question comes in the exam without weights. What will we do that time? Yeah, how will we give 1, 2, 3? Profits are in increasing order, so I'll give 1, 2, 3. Profits are in decreasing order, so I'll give 1, 2, 3. 3 to 1. Very good. Profits weightage will always be given highest weightage to the most recent year. No 3 to 1, 1 to 3. Highest weightage to the most recent year. It has nothing to do with increasing or decreasing. Clear? Which is the most recent year here? 16, 17. Weightage 3. 15, 16. Weightage 2. 14, 15. Weightage 1. CA Foundation, guys. You have to know this. Some online students of CA Foundation, you should remember this. Yes. Why? Why weightage like this? Now, doesn't matter. See, I have not even read the profit. Can you see the profit? 3 lakh, 5 lakh 25 and 6 lakh 30. I was asking this only. 3 lakh, 5.25 lakh and 6.3 lakhs. Weightage I have given 1, 2, 3. What if it was 6.3 lakhs, 5.25 lakh and 3 lakh? Will it still be 1, 2, 3? Yes. Yes, yes. It will be 1, 2, 3 only. It is not depending on profit is increasing or decreasing. It is highest weightage to the most recent year. Because what happened in most recent year, the chances of that repeating is more. That's why we are giving highest weightage to the most recent year. Yesterday you studied, today also you studying, chance is more. Are you getting this? 5 days back you studied and you are on a break for 5 days. You studying today, chance is less. Huh? Yeah, latest year, previous year. Just remember, most recent year, highest weightage. That's it. That is 1, 2, 3. Don't think about increasing, decreasing and all. What happened? Hey, what is this? At amalgamation you became not there is a lot for you to go. Okay, fine. Huh? He will open once you go into internal reconstruction. In amalgamation, that is his character. His character will change when we go to other chapters. Okay, Zen mode, yes. He is just absorbing everything. Already you are in tension in life. Don't take tension about amalgamation. Oh, sorry, we didn't mean to tell about you. Yes. Now this is the situation. We have to calculate goodwill. Okay. Now first we will finish this goodwill calculation because goodwill calculation is not taught in Inter, but it is there in your life. Okay. Any science students? Anybody from science background? No. That means at least in 11th and 12th you have learned. Okay. Now let's see. I'll show you the goodwill calculation first. Then we will think about everything else. See over here. 3 lakh, 5 lakh 25, 6 lakh 30. Weightage will be 1, 2, 3. Okay, whenever it is weighted average profit method, total of product divided by total of weight. This is the product. Profit into weightage, you will get the product. Total divided. That time you will get the weighted average profit. 5 lakh 40. They told number of years of purchase you need. Directly you cannot take weighted average profit. But in this question, what they told, they did not tell you number of years of purchase. So you are assuming that it's going to be 1 year. Okay, so your goodwill is 5 lakh 40. They told what? Why did we calculate? We should know why we calculated goodwill. No. Why did we calculate? They said, listen, consideration was to be based on net assets of both the companies. Both the companies net asset only we are going to pay based on book value only, shown in the above balance sheet, but subject to an additional payment to P Limited for its goodwill. For P Limited will give extra for goodwill. Moment you saw that amalgamation in the nature of purchase. Amalgamation in the nature of purchase. You're giving something extra, no? Assets and liabilities taken over at book value, but you're giving something more than book value. Clear? Okay. Now, the shares of, see, actually done, that's it. Goodwill calculation was a major thing. Done. Now a new thing is there here. Okay, see this, very important point. I'm telling you, very important adjustment. Shares of PQ Limited were to be issued to P Limited and Q Limited. We know how many shares already. Clear? What is the number of shares? 6 lakh and 8 lakh 40. We know that share capital has to be 14 lakh 40,000. So how you are coming to the conclusion, sir, First line of the question, they said the scheme envisaged a share capital equal to the combined capital of P and Q. The share capital of the new company will be equal to the combined capital of P and Q. Okay, very good. Now, shares of PQ Limited will be issued to P and Q at a premium. Okay, how much premium? We don't know. And in proportion to the agreed net asset value of these companies. We are going to issue it at premium that we don't know how much and in proportion of net assets. Okay. In order to raise working capital. Working capital, we know day to day we need money. Okay. PQ Limited proceeded to issue 72,000 equity shares of 10 each. We are issuing new shares to public. You would have just passed the entry bank account debited to share capital. Okay. At the same rate of premium as issued to discharge the purchase consideration. So purchase consideration at what premium you are issuing the share, at that same rate we have to issue to the public also. Golden adjustment this is. Can be tuck into the paper. Are you getting my point? Okay, because other than this adjustment there's nothing. Everything is taken over at book value. One goodwill extra, that's all. Calculate the number of shares to be issued. First thing. Prepare required journal entries in the books of PQ Limited. This is purchasing company. Prepare balance sheet of PQ Limited. If you pass journal entries, automatically balance sheet is there, right there. Okay, now listen. PC is the important thing. Again, I'm telling you, what did they tell? Total share capital we know. So, do I know 100% that my shares are 1,44,000 shares? My shares are 1,44,000 shares only. Same, combined. But I'm going to issue them at premium. Now, do I already know what are my net assets? No. What I'm going to do net assets? Everything from books. Everything from books. One extra goodwill, which we just calculated, 5,40,000. All liabilities from books itself. So you're getting per net asset as 21,60,000 and 14,40,000. Shares should be in this ratio. Shares should be in this ratio. Sir, how you are knowing all this? Shares were issued in proportion to the agreed net asset value. Shares what we are going to issue should be in this ratio. How much is the number of shares? 1,44,000 shares. How do we know this? They said combined share capital will continue. 1,44,000 shares. So, in this ratio when we distribute 21,60,000 and 14,40,000, 36 lakhs. 21,60,000 divided by 36 lakhs into 1,44,000 shares. 86,400 shares. 57,600 shares. Did we understand how much shares we are issuing? Now what we need? Per share how much? We know how many shares we are issuing. Per share how much? 21,60,000 divided by 86,400. 25. 14,40,000 divided by 57,600. 25. That means we are issuing it at a premium of 15 rupees. Are you getting this? Again, two crucial areas. One, goodwill. Okay, goodwill is actually not crucial. According to me, you should know the weighted average method and all. The two crucial areas are, first line they said, combined capital will be the capital of the new company. So we know total shares should be 144. Okay. And then we know later, they also told that the shares will be issued in proportion of net assets. Net asset when you are calculating everything book value. Only goodwill for one company extra. Everything book value. Goodwill will be extra. Where did they tell all this? See over here. Consideration to be based on net assets of both the companies shown in the above balance sheet. That means book value. But subject to an additional payment of goodwill for P Limited. Clear? Now, this is your value. So you know that it is issued at 15 rupees premium because face value is 10. The calculation is done by ICAI as well. You can see the calculation here. 14,40,000 is the combined share capital. So you get 86,400 shares and you're getting 57,600 shares. Premium is 15 rupees per share, 15 rupees per share. Is this clear? Are you done? Other than that, there is nothing. Okay. Now we know the PC already. Business purchase account debited 36 lakhs. Just now for the ratio, you saw the 36 lakhs. To liquidator of P Limited 21,60,000. Liquidator of Q Limited 14,40,000. Clear? Are you getting this? Where did we get, sir? 21,60,000 and 14,40,000. Net assets. Net assets. We calculated. Okay. Now, whatever you saw in that net assets, all this book value, okay, goodwill we found. This is for P Limited. They pass the entry again. This is for Q Limited. This is for Q Limited. We could have combined also and passed the entry, no issues. Clear? Now, payment. Liquidator of P Limited debited to 86,400 shares at 10 and extra 15 goes to securities premium, and liquidator of Q Limited 57,600 shares, which we only found out, into 10 extra will go to securities premium. Is this clear? Now, do we have new shares that are issued? Intercompany owings not there, realization expense not there, debenture settlement not there, statutory reserves not there. None of that is there in this question. Okay. Now, realization expense also they have not spoken. Now, one thing you have to understand, they have issued 72,000 shares now here. 72,000 shares is issued at what value? 72,000 into 25. Same premium you add and take this at 25. So this will be 72,000 into 10 and this will be 72,000 into 15. Clear? For the new balance sheet, assets are there in this journal entry itself. Assets are there in the journal entry itself. Where is it already? See over here. All the assets are here. For the new balance sheet. Clear? Can you see all the assets are there over here? Liabilities are also there in these journal entries itself. See, understand this. For here, when you're making a new balance sheet, you shouldn't make mistake. You know why? You passed one journal entry. You passed two journal entries. You passed the third journal entry. You passed fourth journal entry. Fifth journal entry. Sixth journal entry. This company, only 6 journal entries are there. P Limited was the selling company. Q Limited was the selling company. New company is PQ Limited. PQ Limited till now has passed only 6 journal entries. From 6 journal entries, you have to prepare balance sheet. From 6 journal entries, you're going to prepare balance sheet. Cannot go wrong or should not go wrong. All 6 journal entries are matching debit credit double entry system of accounting. Yes. Now you can see the balance sheet here. 21 lakh 60. Okay. 32 lakh 40. How you are getting all these numbers? Okay. 1 lakh. How many shares you issued? 1 lakh 44,000 shares. Plus you gave 72,000 shares to public. That is equal to 2,16,000 shares. And face value is 10. And the same 2,16,000 shares into 15 rupees premium. 32 lakh 40. 15 rupees premium. Okay. Then other than that, you're just going to add trade payable will be added. Fixed assets will be added. You can't call fixed assets anymore. It's a 2018 question. Okay. You have to call it as property, plant and equipment. Okay. Intangible assets, sir. From where we got it? We only calculated 5,40,000 goodwill. Then everything line by line addition. Cash. From where we'll get this 15,60,000 cash? Did we make any payment? Did we make any payment? Did we make any payment? No. Fresh issue. Fresh issue 72,000 shares into 25. Are you getting 15,60,000? No. What did we pay? OD. OD they adjusted. Did they have OD in this question? Okay. See, can you see one question they won't adjust, one question they'll adjust. You follow one uniform methodology. You adjust or don't adjust, decide and do it. Okay. Just now we saw an exam question where they. What? 12,60,000. 3 lakh is there over here. 3 lakh plus 72,000 shares, whatever you issued, minus 5,40,000. Okay. You will get 15,60,000. Okay. But that adjustment thing, it's left to you guys. ICAI, one place they do, one place they don't. Both are fine. Logically, if you think both are fine. Why? How is it not fine? If I have bank OD in SBI and I have bank account in HDFC, these both can't be adjusted. If bank OD and bank account is in the same bank, automatically you'll get it. You can adjust it. Okay, that's it, guys. That's it with that question. No, they are not giving any note. You just ignore. That's it. They are not giving any note. You can adjust only. Best is to adjust. Okay. Whatever you're doing, follow the same methodology for everything. Okay, that's it, guys. That was the 5th question. See, balance of cash and cash equivalent has to be shown after setting off OD. Same question before that, they didn't set off. RTP May 2022. Question number 25. Okay, the last question from amalgamation. Last question from amalgamation. With that, we'll be done with amalgamation. Okay, one small question is waiting for us. Small question, question number 6, RTP May 2022. With that, we'll be done with amalgamation. Clear? It's a very simple question which was asked once upon a time. Okay, when you see the question, you'll understand. So, two of the really irritating and tricky questions of amalgamation, we have considered both of them. Okay, now, following are the balance sheets of Akash Limited and Ganga Limited as at 31st March 2021. Clear? This was not asked for test. No. You told me not to ask this. So I asked question number 21 and you made mistakes in that. And then you cried. Do you remember? Yes. Now, listen guys. Full focus on this question. Full focus on this question. It's a very, very important question. Okay. What I explained to you when I was doing PC, no, that 2 lines, 3-4 times I repeated, that is tested in this question. Okay. Akash Limited, Ganga Limited, no problem. Share capital, reserves and surplus, secured loan, unsecured loan, trade payable, other current liability. Property, plant, equipment, inventory and other current assets. Finished. Now, see the shares. Authorized, issued, subscribed and paid up. 6,000 shares of 10 each, 20,000 preference shares of 100 each, 2 lakh preference shares of 2 lakh equity shares of 10 each. Akash Limited has equity and preference. Ganga Limited has only equity. Till here, no problem. Simply you are just seeing the size of the question and panicking. Nothing is there. Reserves and surplus. General reserve. They told surplus. They told surplus. What does it mean? P&L. It's having negative. P&L is showing negative. Okay, no problem. If they talk about internal reconstruction, we'll do. Otherwise, nothing. Nothing to worry. Secured loans. Secured loans of Akash Limited are secured against pledge of inventory. Okay. They pledged their inventory and took the loan. What is there to worry about that? Unsecured loan. Okay. No pledge at all. Other current liability. Statutory liabilities. Not statutory reserve. Statutory liability. Don't sit and do amalgamation adjustment reserve for this. Statutory liabilities. You maybe have to pay income tax department. That's all. Or GST department. Those are also statutory liabilities. Liability to employees. Okay, employees' salary also pending. What to do? You have to pay them. Both the companies go into liquidation and a new company called Akash Ganga Limited is formed. They didn't think that it was the problem with their capabilities. They thought that it was a problem with the name. So they removed both the companies and they made a new name. Okay, over their business. Sky is also same, water is also same. Akash Ganga, they made the name. Okay, following information is given. From here, the beauty of the question starts. Let's see what they have asked. Nothing. You are required to prepare opening balance sheet of Akash Ganga Limited. That's all. Okay. If you can solve and understand this, any question of amalgamation you will be able to solve. Because all the twists and turns they have put in this question. Okay. And it is from an RTP question which is not asked in exam still. Which is not asked in exam still. Don't worry, Darshan, you are writing in September. He will see May. It's like, okay, they didn't ask this time. That means they'll ask in September. They will not ask the entire question. They will ask one of the adjustments somewhere. Okay. All current assets of 2 companies except pledged inventory are taken over by Akash Ganga Limited. All, not assets, all current assets. All current assets of 2 companies except pledged inventory. Inventory is already pledged. No. How can we take it? Okay. Are taken over by Akash Ganga Limited. Okay. Clear with that? The realizable value of all current assets, including pledged inventory. First they said everything is taken over except pledged inventory. Now they are telling realizable value of everything, including pledged inventory, 80% of the book value in case of Akash Limited, 70% in case of Ganga Limited. Simple, nothing to worry about. Whatever current assets you are seeing now, what are the current assets you have in this question? Inventory and other current assets. Inventory and other current assets. Everything will not be taken over. But realizable value, here it is 80% and here it is 70%. Somewhere we will require it. No. Property, plant and equipment of both the companies are taken over at book value by Aakash Ganga Limited. No change in property, plant and equipment. Book value only we will follow. Where is property, plant and equipment? Here. Clear till here? No twists are there. We didn't find only twist till now. Next, secured loans, and we didn't find PC also, by the way. We didn't find PC also. Everything is spoken about. Secured loans include 32 lakh accrued interest in case of Ganga Limited. How does it make a difference? Secured loan, they are telling 32 lakh is accrued interest. When you're preparing new balance sheet, don't show this 32 lakh as secured loan. Show it as other current liability. Remaining you show it as long-term borrowing. This is a final accounts point which they have put over here. In final accounts, they'll tell no. Loan from state financial corporation includes interest accrued. Are you getting this? Okay. Now, 4 lakh equity shares. Listen guys. 4 lakh equity shares of 10 each are allotted by Aakash Ganga Limited at par against cash payment of entire face value of the shareholders of Aakash Limited and Ganga Limited in the ratio of shares held by them in Aakash Limited and Ganga Limited. Please here guys. Please here. What was the PC definition? What is the PC definition? Payable by the purchasing company to shareholders of selling company. Here what is happening? 4 lakh equity shares of 10 each are allotted by Aakash Ganga Limited, purchasing company, at par against cash payment of entire face value. If I am going to give you money and you are going to give me shares, is it the purchase consideration for the company which I am giving you? No, this is not PC. This is not PC. Are you getting my point? Shares are issued, yes, but not just like that. It is just given for money. You are going to give me 10 rupees and take shares. Clear? And it is going to be given in the ratio of the shares held by Aakash Limited and Ganga Limited. Right now, Aakash Limited and Ganga Limited, how much shares they have? What shares are issued? Equity shares. Okay, they just said shares. So you should take in the ratio of shares itself. Okay. Preference shareholders in Aakash Limited. Ganga Limited, did they have preference shareholders? No preference shares in Ganga Limited. Can you see? Only in Aakash Limited there are preference shareholders. In Ganga Limited there are no preference shareholders. So now listen, preference shareholders in Aakash Limited are issued equity shares in Aakash Ganga Limited worth 4 lakhs in lieu of their present holdings. PC. Purchase consideration. Are you getting this? See, who are preference shareholders? Owners of the selling company. One of the owners of selling company in Aakash Limited. Ganga Limited, they didn't even consider also. Okay, Aakash Limited are issued equity shares. What are we giving them? Equity shares in Aakash Ganga Limited. Worth how much? 4 lakh. For what? The shares that they had over there. Now you are the owner over there. That's why I'm giving you shares over here. This is purchase consideration. You are the owner over there. I am giving you shares over here, but you have to pay money. That is not purchase consideration. Are you getting it? That is not purchase consideration. That is just issue of shares for cash. Purchase consideration will always be issue of shares for consideration other than cash. What is the consideration? Company, not cash. Clear? Now, secured loan agreed to continue the balance amount of their loans to Aakash Ganga Limited after adjusting realizable value of pledged asset in case of Aakash Limited and after waiving 50% of the interest due in case of Ganga Limited. What are they telling? The loan people told, we will continue with you in the new company. But what did they tell? Here, Aakash Limited, already they have pledged inventory. No, we will adjust the inventory. Balance amount, we'll keep it as loan only. And here, Ganga Limited, what did they tell? 50% of the interest due, no, I'll cancel it. Clear? One more very important adjustment. Unsecured loans are taken over by Aakash Ganga Limited at 25% of the loan amount. Nothing. 75% gone. If you want to come, come. I will give you 25%. That's it. Employees are issued fully paid equity shares in Aakash Ganga Limited in full settlement of their dues. Oh, sir, one more PC point, sir. One more PC point, sir. No, Why? Shares are issued to employees. Shares are issued to owners only will be taken as PC. Shares are issued to employees. Now, statutory liabilities are taken over by Akash Ganga Limited at full value and trade payables are taken over at 80% of the book value. That's it. That is it. Nothing else is there in this question. Okay. Nothing else can be there also. PC, you know how much? 4 lakhs. End of story. PC is only 4 lakhs. Only 4 lakh PC. Shares are issued many places. Where and all? Shares are issued for cash, not PC. Shares are issued to employees, not PC. Are you getting this? Okay. Now, we'll go one by one. Balance sheet we will discuss later. First, we'll discuss the working notes. Okay. Value of total liabilities taken over by Akash Ganga Limited. Why did they tell this? We need to know everything we need to know. What are the things that are taken over? Now, see over here. Current liabilities. First, they are starting with current liabilities. See the question over here. Both the companies, okay, Akash Ganga Limited will take over the business. Now, focus fully. Current liability. Statutory liability will be taken over at what value? No, book value. See over here. Statutory liability is taken over by Akash Ganga Limited at full value. 144 lakhs and 20 lakhs. Can you see 144 lakhs and 20 lakhs here? Current liability. Liabilities to employees. Liabilities to employees taken over at that value only, and later we are going to give them shares. We take over the liabilities from employees and we are going to give them shares. 60 and 36. Can you see 60 and 36 over here? Clear? Apart from that, trade payable we have. Okay, we have trade payable over here. Trade payable, what did they tell in the question? It is taken over at 80% of the book value. Can you see trade payable over here at 56 lakhs? So this will be 56 lakh into 80%. Can you see over here 36 lakhs? This will be 36 lakhs into 80%. Did you understand exactly how the current liabilities are taken over? Statutory liability at book value only. Employees liability at book value only. Only trade payable is taken over at 80% of the book value. Is this clear? Yes. Now, after that, what do we have? Secured loan. Can you see the next thing is secured loan? Now, see over here. Secured loan given in the balance sheet 3 crore 20 lakhs. Can you see 3 crore 20 lakhs over here? Given in the balance sheet. Do they have one pledged inventory? Where was it given? Notes to accounts. Can you see? Secured loan of Akash Limited. Both did not have pledged inventory. Secured loan of Akash Limited secured against pledge of inventory. How much is the inventory? 3 crore 20 lakhs. So, sir, set, sir. Yeah, wait. We'll do that. Can you see 3 crore 20 lakh here? Can you see the inventory somewhere in the question? 3 crore 68. Oh, super. 3 crore 68. Everything covered. Nothing is covered. Why? Because it is taken at 80%. I think realizable value is 80% only. Now, understand this. Very important point. How much is the loan? 3 crore 20 lakh. Given in the balance sheet? Clear? How much was the inventory? 3 crore 68. But out of that 80% is 2 crore 94 lakh 40,000. What did they tell? Balance loan, whatever is there after removing the pledged inventory, balance loan will be taken to balance sheet. New company, Akash Ganga Limited. Sir, I don't remember where it was told. It was told here. Secured loan agree to, see this. Secured loan agree to continue the balance amount of their loans to Akash Ganga Limited after adjusting realizable value of pledged asset in case of Akash Limited and after waiving of 50% interest due in case of Ganga Limited. Interest due somewhere they have told. Already they have told that secured loan included 32 lakh of accrued interest in case of Ganga Limited. In Akash Limited's loan, there was no interest included. In Ganga Limited's loan, there was interest included. Out of that interest, 50% that fellow told, okay, don't pay. Akash Limited, what happened? Already pledged inventory was there. They sold the inventory. They got only 80%. So balance amount will still continue as loan in the new company. Balance amount will still continue as loan in the new company. So can you see over here? Akash Limited, we'll focus only on Akash Limited. The loan was 320. Okay, 320 lakhs. Okay, 368 was the inventory. We got 80% of that. So we were able to cover only 2 crore 94 lakh 40,000. That means full loan is not covered. Remaining loan will continue as loan only in the new company. Remaining loan will continue as loan only in the new company. Now, what is the loan which is given of Ganga Limited? Can you see the loan of Ganga Limited? 1 crore 60 lakhs. 1 crore 60 lakhs. Correct? How much was the interest in this? 32 lakhs. In that half, they told no need to give. Remove the 16, you will have 144 still you have to pay. But in this 144, 16 lakhs is interest and 128 lakhs is loan. Are you getting my point? 144 is there. How did we get? See, this is the loan, no? Loan plus interest together they are given for Ganga Limited. Now, 32 lakhs is interest. But out of 32 lakhs, 16 lakhs no need to pay. What is not required to be paid, remove it. Remaining everything is required to be paid. This is the liability that is taken over. So now you have this plus this. This is the liability taken over. This plus this. This is the liability taken over. Is this clear? Imagine how crucial the liability calculation is that ICAI has made a table just for calculating liability taken over. Not only net asset. Usually they do net assets together. No. Just for liability taken over, they have done this. That means that many critical calculations are there over here. Now again, I'm just rushing through this. Statutory liability at book value only. Told in the question. Liability to employee at book value only. Later we'll give them shares and send them. Payable 80% given in the question. Now loan. Loan, it is not the same for both. Akash Limited, Ganga Limited. Akash Limited loan, inventory is pledged. So no need to worry. Ganga Limited loan, in the loan only interest is also added. So we have to separate it. Here they agreed to remove 50% of interest. They said no need to pay 50% of interest. Akash Limited loan, inventory they will sell. Whatever is remaining, that will continue as loan with Akash Ganga Limited. Clear? Now, 320. Interest inventory was 368. We got only 80%. Remaining will continue as loan. Here, 160. Interest was 32. 32 we have to pay. They told 16 don't pay. Remove 16. Balance is still liability only. Clear? This is the liability that is taken over. This is the liability that is taken over. Assets taken over. Separate. They have put property, plant and equipment. Somewhere I remember reading that property, plant and equipment will be taken over at book value. So go to the question. What is the property, plant and equipment? 68 and 136. Happily take it. Okay. Now current assets 80% and 70% respectively. We remember reading that. Akash Limited 80%. Where is it, sir? First point. Okay. Akash Limited 80% and Ganga Limited 70%. Now see current assets. What do we have? Do we still have this inventory? No. They already took that. Just now the loan people took it and went and sold it also. Balance amount of loan is treated as loan. Inventory fully sold. Inventory is not there. This 72 lakh, 80% will be there. This 192 lakh, 70% will be there. 72 lakhs into 80%. Verify it. 72 lakh into 80%. Are you getting 57 lakh 60,000? Then this 192 lakh into 70%. 134.40. Clear? When you see what mistake you can make, already you calculated liability with full focus. Then when you're coming to this asset calculation, no, again you take inventory. Gone, no inventory. Inventory is already adjusted by the loan person. No. Inventory cannot be taken over. No. To take over, there is no inventory. No, that fellow has already taken it. Okay. Okay. Other than that, you don't have anything on the asset side. That is it. Assets taken over. When you do that, now you will get goodwill or capital reserve and amalgamation. How? Liabilities taken over. Okay. Actually, net assets we will do. Simply they have done some ulta calculation over here. What is the net assets? Net assets taken over. Now take your calculator. What is the assets taken over? 125.60. Take 125.60 in your calculator. Minus. What is the liability taken over? What is the liability taken over? 317.40. 190. Why did you ignore the negative symbol? Isn't it negative? Then like that only you're telling the number. Minus, yes. Asset is 125.60. Liability is 317.40. Net asset is negative 191.80. Liability that you're taking is more. Asset that you're taking is less. Are you getting this? Take the negative, otherwise you'll get the wrong answer. Okay, just because negative came, no, ICAI changed their approach only. They started from liability side. They don't want to show negative in life. They will show only on the marks card. Okay. So what they did, they just because of that negative thing, no, like how gain ratio, sacrificing ratio, they change it when it is negative. Okay, now listen. What about here? Asset 270.40 minus 228.80. 41,60,000. Is this the net asset taken over? PC. We issued shares only to one person. That is to whom? We issued to which company shareholders? Shareholders of Akash Limited, 4 lakh rupees. Purchase consideration, 4 lakh. Do you understand why they didn't issue shares? Boss, I'm taking your negative net worth and going. Why I should issue shares again? Clear? PC is 4 lakhs. Now, PC is 4 lakhs. Net asset is 191.80. What is it? Goodwill. Goodwill. Already you are in negative. See, in school, once upon a time, we learned maths. Okay, in maths, minus, when you are minusing, one more minus. Okay, here the symbol changes. Symbol changes and it becomes plus. Are you getting my point? 195, 80,000 is goodwill. 195, 80,000 is goodwill. That is based on maths. We don't like maths. That's why we are in commerce. Right? Now, I'll tell you, based on commerce, already net asset is negative. He should not be paying you anything, but still he is paying you 4 lakhs. That means negative, and again he is giving you 4 lakhs. So from his pocket, 195.80 is the loss. No, he is taking your net asset negative and is again giving you 4 lakh. What used to happen before? I am taking 100 from you and I am giving you 120. Extra 20 is debit, goodwill. Correct? I am taking negative liability. I am taking negative assets from you and I am again paying you 4 lakh. Already I am taking loss plus I am giving you 4 lakh and increasing my loss. This becomes goodwill. Is this clear? Here there is nothing. We are not giving them only PC. We are not giving them PC only. That means full net asset over net asset, whatever I get. Okay, 41,60,000 will be capital reserve. Clear? Nothing was on your plate in this question. Nothing was there in the kitchen also. We had to buy from the market and solve this. Are you getting this? Every point is important. This question will not come in the exam. But just that loan point they can put in any question, no? Just your loan point, how loan is taken over, they can put that into any point. Any question. PC they can put it into any question. Just any question. It might not be this huge. It might not be this huge, but they can frame any question where net asset taken over liability is more than asset. Now you should know, if net asset taken over liability is more than asset, you have negative net asset, and if you are paying something, negative it will become, and it will become goodwill. You are already taking negative and you are paying again to him. Are you getting my point? Is this clear? It is like me going to the saloon, okay, asking him to do head massage, okay, and taking money from him and coming. Are you getting my point? That is what is happening over here. Not giving him money, taking money and coming. For them, for that guy, time also gone, money also gone. For that guy, time also gone, money also gone. No, that is why it is goodwill over here. 2 negatives basically for that person. Now, you know goodwill, you know capital reserve. Okay, just today only we solved a question where they did not adjust goodwill and capital reserve. Here they are adjusting. Today only we solved a question, no, where goodwill they kept separate 1.25 something, and here they are adjusting it. You can do anything. Okay, you can do both. Whatever method, just keep one in your head so that you just follow that always. Now, equity shares issued by Akash Ganga Limited. I am not even showing you the solution. Tell me to whom and all equity shares were issued. We issued equity shares as PC, and we issued equity shares for cash, and we issued equity shares to employees. See over here, for cash. Okay. for consideration other than cash is also there. For cash, 40 lakhs. How did we get that 40 lakhs? 4 lakh equity shares are issued at the rate of 10 rupees. Okay, allotted. Okay, in what ratio? Ratio of the shares held by them. Okay, they just took the total here, 40 lakhs. And we are issuing to liability holders. Did we just see what is my liability here? Employees 60 lakhs plus 36 lakhs. 96 lakhs I have to pay to my employees. For that also I am issuing share only. Then to preference shareholders, PC. This is your small PC which is there over here, 4 lakhs. So total amount that I am issuing is 140 lakhs. 10 rupees is the face value they only have told. That means 14 lakh shares are issued. 14 lakh shares are issued. Why did we do this calculation? Because we are actually supposed to prepare balance sheet. That we didn't start on still. Our main thing is preparing balance sheet. We didn't start that. Okay. Now that is it. Now balance sheet shouldn't be a problem. You know why? Net assets taken over. Assets taken over all are over here. One extra asset you have to put in the balance sheet. That is goodwill. Adjusted. Goodwill and capital reserve. Goodwill you have to take in the balance sheet. Liabilities taken over. All liabilities are sitting over here. All liabilities are sitting over here. End of the story, no? Only thing that was missing in the balance sheet was shares. For that they did that extra working note. Now, see the balance sheet. 140 lakhs. Just now did we see that 140 lakhs over there? No reserves and surplus. Nothing was issued at premium and all. Long-term borrowing. See your working note. How much is your long-term borrowing? See your working note. How much is your loan? 25 lakh? 60,000 plus 144 lakhs. How much you're getting? 25 lakh 60 plus 144 lakhs. How much you're getting? 2 loans. What? Yeah. We'll show it. What do you thought? Chocolate. Yes, see this. Liability over here 25 lakh 60. Correct? Plus 144 lakhs. Plus 43 lakhs. 21260. Correct? 21260. Now going into that, can you see over here 21260? Actually interest should have been separated. After doing all that, they have made one small mistake over here. You don't do it. It's a old question, right? You don't do it. 21260 is not the long-term borrowing here. Actually, that 16 lakhs of interest should be shown as other current liability. We don't know what you're talking about, sir. 21260 is there, no? 2 crore 12 lakh 60,000. Okay. Minus 12 lakhs. Sorry. 16 lakhs. 1 crore 96 lakh 60,000. This should be the long-term borrowing. And that interest should be 16 lakhs of interest should be current liability, which will be other current liability. Is this clear? Any doubts? No. Okay, then. Anyways, your balance sheet will still tally because instead of showing little here and little here, they have shown everything there on top itself. But you follow schedule 3. Interest outstanding is always other current liability. Now, trade payable. Trade payable, liability taken over. Do we have trade payable given there? 4480, this one, and 2880. 4480 plus 2880 gives you 73 lakh 60,000. Can you see trade payable as 73 lakh 60? Sorry. Yes. What is this other current liability? What is this other current liability? Statutory liability. 144 plus 20 becomes 164. Can you see 164? Basically from our working note, but doing that working note is the main challenge. Clear? Okay. Assets. Property, plant and equipment. Book value only. Don't even bother. Book value already we have seen. Intangible asset. Goodwill. We only calculated that goodwill. Okay. Cash and cash equivalent. From where it came? We gave them shares and took money. Remember 40 lakhs. We issued 4 lakh shares to them and took 10 rupees each. Okay, 40 lakhs. This is the cash. Other current assets are those other current assets which are at 80% and 70% except inventory because it's already settled against the loan. This is also there in our working note. It should be done. Yes, Sharmi, what's the doubt? Nothing. Yes, that is it. We have spent enough time on this particular question. That should be it. With that, we are done with amalgamation. Trust me, if you solve these questions also for last minute revision, everything will be covered in this itself. Okay, you don't have to solve everything on the previous day. Just see these questions at least. Here on track, no? Two chapters done. Jairaj gone. Internal reconstruction, consolidation, financial statement, cash flow statement. Four things are remaining for the day. That's it. At whatever time. If you finish at 5 o'clock, we'll go at 5 o'clock itself. If you finish at 6 o'clock, we'll go at 6 o'clock itself. These 4 chapters, that is the target. Time-based target we used to keep only in regular class. Now it's like exams are near, we only keep chapter-based targets. Tomorrow we can finish, again, chapter-based targets only we are going to keep. Yeah, I'm not solving problems of AS. It's not possible in Monday to solve problems. We'll discuss the concepts of AS. Maybe one problem somewhere unique, something we will see. Yes, that should be it, guys. Let's go further. Internal reconstruction. Say, I thought after amalgamation we should do consolidation, but I knew your halat will be like this only. Okay, that's why I kept internal reconstruction, just to like neutralize the effect. Okay, internal reconstruction, you know, it is manageable. Okay, but time consuming. I am telling you, internal reconstruction you feel easy. Actually, you can finish consolidation faster than internal reconstruction. Every point you'll read, go and pass the journal entry, come back again, every point, again you'll pass journal entry. After that, they'll tell prepare balance sheet also. Luckily, sometimes in internal reconstruction, they'll tell ignore narrations. Otherwise, narration also you have to pass. If they don't tell that, you have to write narrations also. Yes, Anaga, correct, no? Let's continue. How is the Josh? Josh got amalgamated. Yes, treatment of reserves, all that done. Let's go into internal reconstruction. Yes, Jairaj. Marathon starts now for you. Till now, marathon did not start. Now, marathon starts for you. Yes, internal reconstruction. Let's focus. Simple chapter. Weightage is huge. 14 marks. Okay, 14 mark weightage is there in the exam. Okay, now, what is internal reconstruction? Becoming good even when you are bad. What is becoming good even when you are bad? Outsider things you saw, no. 260 loss was there. We did internal. Then it became 280 profit. Okay, that is basically internal reconstruction. Reconstruction of financial statement after company has incurred continuous losses. Continued losses they were having. Reconstructing the full financial statement. Main goal of internal reconstruction is what? Writing of the losses that are incurred. Accumulated losses, whatever are there, you have to write off that accumulated loss. That is the main goal of internal reconstruction. Is this clear? No. Actually, according to me, only 4 things can happen in internal reconstruction. 1, increase in assets, decrease in assets, increase in liability, decrease in liability. That's it. Entire internal reconstruction game is this much only. Assets increase, asset decrease, asset liability increase, liability decrease. If asset increases, you think from asset angle. If asset increases, asset should be debited or credited? Asset should be debited. So capital reduction will be credited. If asset decreases, asset should be credited. So capital reduction will be debited. I am thinking from what? The asset angle. If liability increases, liability should be credited. So capital reduction will be. Oh, I think interchange, right? Oh. Copy paste. This is all written. What is copy paste? Oh, no. It's okay. We'll correct it. Decrease in liabilities. Decrease in liability. Liability has to be debited to capital reduction. Increase in liability. Liability has to be credited. Capital reduction will be debited. I am thinking from asset liability angle over here. Now, imagine I think from the other angle. Asset increases. Good or bad? Good. Capital reduction credited. Profit. Asset decreases. Good or bad? Bad. Capital reduction debited. Loss. Now a few minutes. Now after that we'll go for lunch. A few minutes will sit, like 12, 13 minutes, that's it. Okay, decrease in liabilities, good or bad? Good. So capital reduction will be credited. You are seeing from the other angle now. First we saw from modern approach. Now, increase in liabilities, good or bad? Bad. So capital reduction will be debited. Is this clear? Now, journals. We'll focus on journals. Okay, journal. Let's see what is happening. Now, equity share. Already the asset increase, decrease and all, I already told you the journals. Now some different things. Equity shares subdivided means what? Piece or join. Piece. Correct? Okay. Entry is equity share capital. Why? We had, for example, what is this? Pizza. You had a pizza, right? Now, piece also is one only. All if you join and eat together also one only. Correct? What? This doesn't look like pizza. Cycle tire. You thought what? How does that look like? Orange. Wow, next level. Okay, listen. Shh. Hey, that was discouraging. Orange itself. So what is that? Nowhere close. In what? Hey, wait. In what? Max? I started studying only after I came to CA. Okay, I don't know. Before that, what happened in my life, I don't know. Yes, now, equity shares subdivided. Now, imagine, I have 1 lakh shares. Subdivided means this, imagine 1 lakh shares of 100. I am subdividing it. Now, what will happen? I am subdividing it into 10 shares. What will happen now? It will become 10 lakh shares. Okay, into 10. When quantity increases, value per share decreases. Overall value same. Quantity, okay, when it is increasing, value per share has to decrease, but the overall quantity will be same. So the entry is equity share capital to equity share capital. Old face value, new face value. Total will be same. Note, total value of share capital will remain same. Next, number of equity shares will increase because it is subdivided. Equity shares consolidated. Ulta. Okay, see, I told you marathon begins now. Okay, equity shares consolidated. Okay, what does it mean? We had 2 pizzas together, eat. Okay, 2 pizzas together you are going to eat. Equity share capital debited to equity share capital, old face value, new face value. Old face value, new face value. Clear? Now, total value has to remain same even now. Imagine I tell you 1 lakh shares. Okay, guys, 1 lakh shares of rupees 100 are there. Okay, we are going to consolidate into what? Consolidate means number of shares should increase or decrease. Increase or decrease. Imagine I make it 10,000 shares into 1,000. 1 crore. It will be same. 1 crore. Clear? Now, understand this. Total value of shares remain same. Number of equity shares will decrease. If you are subdividing, number of equity shares will increase. Okay, value will decrease. If you are consolidating, number of equity shares will decrease, but value will increase. Clear? But total value will be same. So, should we pass entry always? Yes. If reserves exist, very rare case, if there is reserves, what will you do? Take it and put it to capital reduction. There also some questions are there where reserves are there and they are telling that 50,000 in the reserve should be maintained. Don't put it to capital reduction. Are you getting my point? But practically you think you had reserves. Why are you not utilizing that and doing all this circus? Okay. Now, if liabilities are settled, liabilities account debited to capital reduction. Okay. In case there was provision is removed. Provision debited to bank, amount paid. Now, for example, what I'm trying to tell you is, if I tell you that there is provision for tax. We have provision for tax. This I should pay now. Okay, if I pay more, what will happen if I pay more? More will be going, no extra, no, it is loss, no. If I pay less, it is profit. Okay. Now, amount waived off. Can you see what I wrote to capital deduction? Amount waived off. Now understand this. Liability account debited, whatever amount is settled, liability is gone. Provision account debited, if provision is there, provision will be debited. Then capital deduction credited, if at all they tell don't pay, then capital deduction will be credited. Then bank account will be credited only if you pay the amount. Is this clear? This full cycle? All will not happen, but one of them will happen always. Now, preference share dividend. Every question always they will, or something they will always tell preference dividend, preference dividend. Now, preference dividend, you have to understand one thing. If it is to be waived off, no entry. Why? Preference dividend not paid will be always outside the balance sheet, which is outside the balance sheet. If they tell don't want, it's already outside. Don't want, what entry will you pass? If a liability is there inside the balance sheet, one liability is there sitting in the balance sheet, they tell don't want, that means we should remove it, we have to pass entry. One liability is there outside the balance sheet, that means we have not recorded the liability, but they are telling you have to pay, then you have to pass entry. Understand this. What is there, if you have to remove, you have to pass entry. What is there, if you have to pay, you have to pass entry. What is not there, if you have to remove, no entry. What is not there, if you have to remove, no entry. What is not there, if you have to pay, then you have to pass entries here. If preference dividend is to be settled, then you will pass the entry capital reduction account debited because it is loss. Capital reduction debited. To bank account because money goes. To equity share capital. Why equity share capital? There are questions where they tell you 3/4 of the preference dividend is settled by issue of equity shares. 3/4 of the preference dividend is settled by issue of equity shares. So this goes, this is a loss, and then instead of money going, new shares are issued. Clear? Are you following this? All questions of internal reconstruction you take and see. Always in the balance sheet, you will have only preference share capital. Maybe max to max in the balance sheet, in bracket they will tell preference dividend arrears for last 4 years. That means last 4 years preference dividend is pending, they will tell. If it is pending, what will happen? If it is pending, either you will leave it as pending forever or you will pay it. For that pending, did you pass any liability entry? Is there any liability in the balance sheet? No. Only the share capital is there in the balance sheet. They are telling you that is pending. If you are not going to pay, no entry. If it is not going to be paid, no entry. Okay, if it is going to be paid, then there is entry. Now understand this. Again, I am telling you, this is my balance sheet. This is my balance sheet. There is a liability over here. If I want to keep it, should I pass entry? If I want to keep it, should I pass entry? No, it's already there in the balance sheet. I don't have to pass entry. If I want to remove it, should I pass entry? Yes. Clear? Okay. Now, this is my balance sheet. Liability is not there. Liability is outside the balance sheet, not recorded. Let me ask the question. Okay, liability is outside the balance sheet. Okay. If I want to pay it, should I pass the entry? Yes. If I don't want to pay it, should I pass entry? No, because it's already outside. I don't want to pay it. I'll just ignore it. That is what I was trying to tell you with this particular chart. Clear? Preference dividend, just remember, if it is to be waived off, ignore it and move forward to the next point. If it is to be settled, then pass the entry. If you are going to pay something, it's a loss. Loss should be debited to capital deduction account. Capital deduction debited. If you are giving money, bank account credited. If you are giving shares, equity share capital credited. Is this clear? Okay. Now, reduction of liability. Reduction of liability. That means liability is going to be reduced. Now, very important part here. Okay, they play with the language only in this area. In question, if they tell liability to be reduced in consideration of reduction, they tell liability to be reduced and then they will tell in consideration of reduction. That means balance portion remains as liability only. Very important. Now imagine I have liability 100. They are telling it is to be reduced by 70%. Okay, so now I'm going to reduce 70% and this becomes 30. And they're going to tell in the question, in consideration of reduction, we are going to pay something. That means because you agree to reduce, I'm going to pay you. That means balance will still be there. Balance will still be there. Now, in question, if they tell you, liability to be reduced, it is to be settled. If they tell you 100 and you're going to remove 70, now you have 30, no? You reduce 70, 70 gone, 30 you are going to settle it now. That means balance portion to be settled. Is this clear? There is one question in the study material where you have surrender of shares and all. There, they have played with the language. In the same question, both the types are shown. Debentures one type, creditors another type. Clear? Now again I am telling you, reduction of liability, if they tell in the question, liability to be reduced in consideration of reduction. That means what are you paying for? Because they are reducing, they are paying for the reduced amount. Balance will still be there. Because they agree to reduce it, I am going to pay them some money. Here, liability to be reduced, it is to be settled. That means you are going to reduce the liability and balance amount you are going to settle. You are going to pay the balance amount. Is this clear? Okay, that means balance portion will be settled here and balance portion will still remain as liability when you are preparing a balance sheet after internal reconstruction. Next, share surrender. What is share surrender? Company going and giving the shares. See now, for example, you are in trouble. Okay, and you ask me, please help me. I will give you money to save you. That is different. I am telling you, I don't have money. I have shares. I will give you that shares back. Take. You do whatever you want with that. Now what you did, you have to pay somebody else. My share which I gave you back, you gave it to that guy and close the matter. Are you getting this? Share surrender is very, very important. Imagine this is the company. Okay, imagine this is the company. Clear? Now you are the shareholder. Kiki standing over there. You are the shareholder. Now, as a shareholder, you are supposed to support your company, no, because your company will be closed otherwise. So what you will do? You will give your shares to the companies. You will give your shares back to the company and tell the company, take it and use it. What company will do? Company has to pay other people no money. Instead of giving money, they will give shares. Now tell me one thing. Did anything go from company's pocket? Nothing. But liability went from company's pocket. So that is a benefit for the company. Liability went from company's pocket. That is a benefit for the company. Are you getting this? When shares are surrendered, understand this. Shares are surrendered. Shareholder gives the share back to the company. Company will use that share and give it to the liability holders. Liability is gone without spending 1 rupee from the pocket. So basically, if you see the indirect angle, Kiki is the person who paid the liability. Shareholder paid the liability. You're like, sir, shareholder and company same? No, entity concept. Okay, it's not the same. Did you understand this? Okay, so when shares are surrendered, what should be the entry? Shares are surrendered. What should be the entry? Share capital reduces. Equity share capital debited to share surrender account. Equity share capital account debited to share surrender account. Clear? When shares are issued to settle liabilities, shares are issued to settle the liability. What should you do? Share surrender account debited to equity share capital or preference share capital. Shares are given not to somebody. So share surrender account debited to equity share capital or preference share capital. Basically, I am the company. I took the share from you and I gave it to the other person. You lost the share. You lost the share. I just gave from your hand to that fellow's hand. That's all. Okay. Shares surrendered and not reissued. Shares are surrendered and not reissued. What will happen that time? Share surrender account debited to capital reduction account. I took the share back from you telling that I will give it to somebody else, but then I tore it and threw it in the dustbin. Now, for the company it is profit. No, I don't have to give the money to anybody. So, share surrender account debited to capital reduction. Is this clear? Are you following this? Now, listen. There is a 10 rupee share. You have one share. I took it back. That time I will write equity share capital debited to share surrender. If I took it back, that means my liability went. As a company, I don't have to give 10 rupees to anybody. My shareholder gave the share back. I don't have to pay money. If I gave that same share to somebody, again liability got created. No. Again liability got created. So see over here, when share is surrendered, equity share capital debited, gone. When share is issued, again equity share capital. Again equity share capital, so liability created again. But if I took the share back from you and I'm not going to give it to anybody, then it's a profit. That profit is sitting in capital reduction. Is this clear? So share surrendered and issued, liability reduces, liability increases. Share surrendered and not reissued, liability decreases, and it will go to capital reduction as profit. Who is she? Okay, okay. If she is giving me share and I pay the amount back, then we have to go to 8 o'clock. If she is giving me share and I'm giving the amount back, I have to go to 8 o'clock. Buyback. Clear? Are you getting my point? We have already finished that. Why will anyone surrender their shares? Company. Correct. Key. Entity concept. Company belongs to. Key. If she wants the company to survive, she has to surrender her shares today. She'll surrender her shares today to save the company. Because now company has to pay you. Company has to pay you. You will file a case. Now it's saved, no? And if company survives, in future Kiki only will benefit, no, when the valuation goes up. Yes. Now, realization expenses unrecorded or unrecorded liability settled. There was one liability which was not there in the books. You are going to pay it. What should be the entry? Capital reduction account debited to bank. Realization expense. What's the entry? Same thing. Clear? Understand this. This same realization expense was there even in amalgamation. There what was the entry? Either you'll pass the entry realization account debited to bank account if the selling company pays it. Otherwise you're going to pass the entry goodwill or capital reserve account debited to bank account if the purchasing company pays it, or reserves account debited to bank account if purchasing company pays it in amalgamation in the nature of merger. Clear? Same concepts can appear many places. Now these questions and all we will see, don't worry about it. There is one person going to the exam. Okay. No, he's actually looking at this question. Oh, these questions I should finish. Okay, that's it. Actually, again we have to go into my handwriting notes only. That we will see later. Internal reconstruction, we have only five questions. Internal reconstruction, we have only 5 questions to solve. And internal reconstruction, basically, it's like every transaction we read, we should tell the entry and there only we should close the situation. Okay, guys, you can take a break for lunch. Come back in 1 hour. We'll start around 2:05. 2:05 we'll start. Okay, let's continue. And we learned about internal reconstruction, the concepts. Now we'll go into problem solving, internal reconstruction. Question number 1. I think we saw that how many questions are there in internal reconstruction which you have to finish? How many? 5. CA Inter Jan 2025, recent. Okay. Internal reconstruction, you don't have to worry. Okay, you have to go in the order of the question. As in how you see the question, when you see the transactions, record it. That's all. Okay, now you can see summarized balance sheet is given. Share capital reserves and surplus, long-term borrowing, trade payable, short-term borrowing, bank OD, other current liabilities, interest payable on debentures, short-term provision is provision for income tax. And in asset side, you have PPE, intangible asset, non-current investment, inventory, trade receivable. Cash and cash equivalent is not there because we have bank OD situation over there. Share capital, equity share capital, 50,000 equity shares of 10 each, fully paid up. 25,000 equity shares of 10 each, 8 paid up. Preference shares, 30,000 preference shares, cumulative preference shares of 10 each. Can you see in bracket they said preference dividend has been in arrears for 3 years. That means last 3 years preference dividend is pending. If you are not going to pay it, no entry. But if you're going to pay it, you have to pass entry. Clear? Reserves and surplus, P&L as a debit balance. You can see the loss over here. Obviously, that's why we are in internal reconstruction. Okay, 10% debentures, freehold property, machinery, goodwill, non-trade investment at cost. Entire balance sheet is there. Wherever relevant, we will go there. Now, subsequent to approval by court, all interested parties, the following scheme of reconstruction was agreed. Okay. Uncalled capital is to be called up in full, and such shares and other fully paid up shares to be reduced to 5 per share. How much is the uncalled capital? 25,000 shares into 2. So you have to make the final call. So actually you should have passed the entry equity share final call to equity share capital, because they said it should be called up, and then bank to equity share final call. They directly pass the entry bank account debited to equity share capital. But go in the normal route. Make the final call due entry and then make the final call receipt entry. This is basically 25,000 shares into 2. Is this clear? Then what did they tell? That it is going to be reduced to. Now language, internal reconstruction becomes a huge language game. What did they tell? Called up in full and such shares, that means what you just called up, and other fully paid up shares. Those which you did fully paid up and the others which were already fully paid up, everything is reduced to 5 rupees per share. How many shares we have? Totally you have 75,000 shares. They are going to become 5 rupees. So first 75,000 into 10. Debit. Remove the old ones. Then you create the new one. 75,000 into 5. 3,75,000. Profit goes into capital reduction account. Is this clear? Yes. Next. Preference shareholders will accept a reduction of 2.5 per share. Okay. In exchange, the rate of dividend is to be increased to 9%. So we are going to reduce them, and now the preference shares were how much? 8%. We will increase it to 9%. We are going to reduce it by 2.5, or we are going to reduce to 2.5. Reduce by 2.5. Can you see over here? We'll accept a reduction of 2.5. So 2.5 is going to be reduced. So now old 10 rupee shares are going to be removed. This is 30,000 into 10. So what you will do? 30,000 into 10. Can you see over here? Debited. New one will be 30,000 into 7.5, and then remaining goes to capital reduction. That is 30,000 into 2.5. Clear? Next. After that. And when you are writing, remember 8% is gone and the new share capital is 9%. Okay. Next. Okay. Internal reconstruction is not heavy on the mind. It's light only. Don't worry. Preference shareholders will forego their claim of dividend for 1 year, and 1 equity share of 5 each is to be issued for the remaining years. How many years was pending? 3 years was pending. Correct? Can you see over here? 3 years. So 3 lakhs into 8%. 1 year they are going to let go into 24,000. This is into 2 years. 48,000. Why 2 years? 1 year they are going to leave. So out of 3 years, 1 year they are going to leave. 2 years they are going to take. And for this 2 years, we are going to issue shares. We are not giving money. We are going to issue shares. Can you see? 5 each to be issued for the remaining years of dividend. Okay, so 48,000 divided by 5 is equal to 9,600 shares you have to issue. Clear? Entry, capital reduction account debited to preference dividend payable. They are taking the lengthy route, which is not required. Capital reduction account debited to preference dividend payable, then preference dividend payable to equity share capital. You can directly pass the entry, capital reduction to equity share capital. Clear? 48,000. Next, after that, Mr. X. Remember, we have one question in the study material where Mr. X and Mr. Y are there. We have to create them first in the books. Mr. X holds 10% debenture of 2,50,000. He also is a creditor for 50,000. He agreed to cancel 50% of his total debt, including interest on debentures, paid 20,000 to the company, and to receive a new 12% debenture for the balance amount. Important one. They have merged that particular question, important concept, into a different question. First, you have to go to the question and see how much is the debenture here. 4,50,000. How much is the outstanding interest here? 45,000. Can you see interest payable? That means 1 year's interest is pending. How much is the interest rate? 10%. Can you see interest rate is 10%? So that means 1 year's interest is pending. So for this person also that much interest will be pending. Mr. X, he has debenture of 2,50,000. So what we will do? Debenture account debited. Remove the debenture, create X in the books first. Debenture account debited. 1 year's interest means for him interest outstanding will be 25,000. Trade payable, they told he has trade payable, he is a creditor for 50,000. So trade payable also debited to Mr. X account. You just created Mr. X in the books. Are you getting my point? You remove debentures, you remove outstanding interest, you remove creditor, and you make X one person whom you are supposed to make payment to, that is Mr. X. Is this clear? Now after that, they said including interest, pay 20,000 to the company. That guy is giving 20,000 to the company again. Bank account debited to X. Bank account debited to X 20,000. Okay. Then he is going to cancel. What is he going to do? He is going to receive new 12% debentures for the balance amount. 50% is going to cancel and he is going to get 12% debentures for the balance amount. Now here it was 325 and 20, 345. 50%, 50%. I feel this is wrong. ICAI has done this. I feel it is wrong. You know why it is wrong? Because 325 was his debt. Correct? Now imagine he is just giving 20,000 today and immediately as soon as I give it, then 50% cancelled. Are you getting my point? Doesn't make sense, right? He is giving more money so that his old thing gets cancelled and for old thing he'll get new debentures. Well, actually it should be 50% of this and 50% will go into new debentures. New debentures are of 12%. So what ICAI has done, 3,25,000 took again money. Now the total amount became 3,45,000. Half they have put into capital deduction and half they have put into debentures. 50%. Yes, that should be the right way to do it. Okay, but logically that is the right way to do it. Imagine I have to pay. You have to give me 325. And you are telling I am cancelling 50%. Imagine that time I will give you 20,000 more and tell this also 10,000 you cancel. Doesn't make sense, right? Already my old debt is getting cancelled. That time I'll give money and immediately I'll tell cancel this also. I could have just waited, right? So actually the money which comes shouldn't get cancelled. Money which comes should be remaining in full. Okay. Next. No? What? Oh, they are not cancelling. I saw this. Okay, correct. Then they're doing correct only. Okay, they are not splitting it. How much they're cancelling is only 1,62,500. Okay, correct. Okay, just that they passed a completely compound entry over here. Okay, see, they are not cancelling. They are doing the right way only, what we thought. So 325 in this 50% is getting cancelled, 162,500. And 162,500 plus the 20,000 which is given, both everything is going and becoming 1,82,500. Yes, it's perfect. Okay, so now this is just 12% new debentures. Remember we had Y also. In the study material there is one Y also. Here there is no Y. Doesn't make sense. No, making the same thing for two people. They introduced that concept with one person in the exam. Clear? No Y. In study material it was X had so much debentures, first debenture, second debenture, creditor. Y had first debenture, second debenture and creditor. So both you are going to pass the same routine entry, right? But they just introduced X in the question. Next, after that, remaining claim of the debenture holders. Remaining claim of the debenture holders including outstanding interest to be reduced to 60%. In consideration of the reduction, the debenture holders are to receive 9% preference shares at the face value. What are they going to get? Preference shares. Now, tell me how much debentures were held by X? 250. What was the total debenture? 450. So can you see 4,50,000 minus 2,50,000. 2,50,000 was held by X. No, that is gone. No. So 2 lakh is the remaining debenture. 2 lakh is the remaining debenture. If 2 lakh is the remaining debenture, then 20,000 is the remaining interest. 10% gone. These both are cancelled. What are you giving them? What are you going to give them? See over here. remaining claim of the debenture holders, including outstanding interest, is reduced to 60%. In consideration of the reduction, debenture holders are to receive new preference shares. So what they have done, 100% they removed. 100% they removed. For 60% they gave this, and for capital reduction, remaining they put into capital reduction. Is this clear? Okay, settled. Now what next? Tax liability is to be settled at 120. We already had tax liability in the question. How much is the tax liability? Provision for tax 1 lakh. How much are we paying? 120. That means extra 20,000 will go from where? Capital reduction. So it will be provision for tax debited, capital reduction debited to bank. Clear? Next, after that, the next thing is market value of non-current investment is 2,50,000. Investment should be brought to their market value. Go to and see what is the investment value in the question. 2,80,000. They want to bring it down to 2,50,000. Is it a loss or a profit? Asset reducing, loss. So what you will do again? Capital reduction account debited to compound entry is there. Capital reduction account debited to investment. One thing we have seen. Okay, we'll go in order of the question itself. Then inventory equal to 1 lakh at book value will be taken over by remaining creditors in full settlement of their claim. First you go and see how many creditors were, how much was the creditor value. Can you see creditors here? 1,30,000. Okay, 1,30,000. Out of that, how much was X? We had X, no? X was only 50,000. So 1,30,000 minus X. We have 80,000. These are the balance creditors. Balance creditors. What are they going to take? They are going to take the inventory. How much is the inventory? 1,20,000. Loss for whom? Us. So now the entry for that should be, okay, I think they have passed separate entry for that. Capital reduction account debited to inventory 20,000. It should be, wait. Just the compounding, see here. Trade payable account debited to inventory 1 lakh. How it became 1 lakh? How it became 1 lakh? See over here. Inventory equal to 1 lakh is only taken over. 120 is not taken over. Only 1 lakh is taken over. Remaining, we'll see what will happen to that. But 1 lakh inventory is taken when we were supposed to pay them how much? 80,000. 80,000 liability went. 1 lakh asset went. Good or bad? Bad. 20,000 will go to capital reduction. Okay, so see over here. Trade payable to inventory. Just ICAI things. Okay, trade payable to inventory. I think when I merge the question, I must have lost it. It cannot be possible that ICAI will pass one, what do you say, single entry system entry over here. Capital reduction account debited 20,000. Loss, right? Capital reduction account debited 20,000. Next, after that, a bad debt provision of 2% is to be created on trade receivable. How much is the trade receivable in the question? Trade receivable in the question. Okay. 2,30,000. How much provision we are going to create? 2%. What is the provision for doubtful debt entry? Normal. P&L to provision. But here we are in internal reconstruction. So capital reduction to provision. Can you see provision for doubtful debts? 4,600. Compound entry. I'm just explaining from the compound entry. Next, after that. Next they said plant and machinery is to be written down by 20%. How much is the plant and machinery? 7,50,000. 7,50,000 into 20% will make it 1,50,000. So again, capital reduction account debited to plant and machinery. One compound entry is passed. Clear? Next, after that, company will further issue 12% debentures for such amount which is sufficient to pay off bank overdraft and other outstanding liabilities and maintain its cash and bank balance at 85,000. Obviously, we need a working note for this. Okay, they are going to issue debenture. How much is required? What is required to pay the OD and whatever is required to pay the other outstanding liability and to maintain cash balance of 85,000. When the question started, there was no cash balance. When the question started, we actually had OD. We want to get rid of that. We want to pay other outstanding liabilities which are there, and then we have to have balance in the bank. Clear? Now, understand this. See, we have cash, bank OD. We have bank OD. They say that we want balance carried on of 85,000. They prepared ledger. There is starting point. This is the opening balance. This is the closing balance. So what's the opening balance, closing balance on the same side? Here it was liability. Ending they want it to be asset. Okay. First it was liability. So you wrote by balance brought down actually. Here ending they're telling by balance carried down. This is given. This is given 85,000. Now what we are going to do? Uncalled capital. Remember we made the final call, got money. 50,000 we got money. Then X also gave us 20,000 rupees. Remember X gave us 20,000 rupees. Then remember we paid 1,20,000 tax. 1,20,000 tax. Balance everything has to be raised by debentures. This is the balancing figure. Okay. 65,000 negative was there. We got 50,000. So the negative became 15,000. Then we got 20,000. So we came into positive of 5,000. Then we paid tax of 1,20,000. That means we are in a negative of 1,15,000 negative. And we want balance to be there at 85,000. That means total we need 2 lakh rupees from where debentures. Clear? You can just do a statement also, or you can prepare ledger also. Both will give you the same answer, 2 lakhs. What should be the entry for this? Bank account debited to debentures, 12% debentures. Is this clear? Now, sir, what about that liability, sir? There was one liability, no outstanding interest. That is already gone. See what and all liabilities were there. Okay. Trade payable, settled. They took inventory. Correct. Some trade payable was X, some other trade payable, we gave them inventory. Short-term borrowing, that now we are paying. Other current liability, interest is already gone. Interest, something was payable to X and something is payable to others. Both are settled. Then provision for tax, that is also settled. That means only thing that was pending was to pay the OD. When you pay OD, all the liabilities are gone. Okay. Now, what did they tell after that? Still there are more things in this question. Amount available by the scheme shall be utilized in writing of goodwill. Usually you use it for what? First thing? For P&L debit balance. And debit balance of P&L and balance of inventory. What is this balance of inventory again? 1,20,000 was the inventory. In that, how much was given? 1 lakh. That means still there is 20,000 of inventory. That is the last preference. First remove goodwill, remove the P&L debit balance. If you still have balance, then you will get the value. Now, what is the P&L debit balance? 2,50,000. What is the goodwill? 60,000. These two have to be taken care first. Now, final entry. Okay, you can see bank OD to bank. They have passed the entry because you are going to make the payment. We saw it in the ledger. Now, capital deduction account debited. Sir, from where did I get 4,27,900? You have to use your calculator. From the first entry onwards, you have to see wherever capital deduction has credit, you have to add it. Wherever capital deduction has debit, you have to subtract it. That time you will get 427,900. First, you are going to write off goodwill. Then you are going to write off P&L. Then you are going to remove inventory. Still you have balance that will go to capital reserve. Clear? Whatever balance is there in capital deduction after removing the losses and all, then it has to go to capital reserve. Remember the amalgamation question, 260, we got extra, went into capital reserve 280. Clear? Which one? Inventory equal to 1 lakh at book value will be taken over by the remaining creditors in full settlement. Balance of inventory, yes. 120 was my total inventory. 1 lakh is taken. So 20,000 remaining. That also they told write off. Clear? Done. Prepare a note to show the revised share capital structure, they said. Only share capital they have asked you to show. They have not asked you to prepare entire balance sheet and all because so many journal entries are anyways there. Correct? Now tell me what happened to the 75,000 shares. What happened to the 75,000 shares? They are into 5, right? 75,000 into 5. Did you issue more shares? Yes. To whom? To whom? For this dividend. 9,600 shares you have issued. No, for dividend. For repaying that dividend. Now, see over here. 84,600. 75,000 plus the 9,600 which we have issued to pay the arrears of dividends. Arrears of dividends not 3 years, only 2 years. This gives you the value. 5 rupee shares there. Each. Of 5 each. Okay. Now, 47,600 preference shares. How did we get this? 30,000 was already there. Where did they issue 17,600 preference shares? Where did they issue 17,600 preference shares? Debenture holders, old debenture holders, we gave them new preference shares. They agreed to cancel and then we gave them preference shares. So 17,600 preference shares, and this is your share capital. Obviously, they can't ask you balance sheet because already journal entry only will take so much time. Clear? Provision for tax journal entry. Here. OD. We have OD, right? What's the confusion? That's why it's called OD, no? What is OD? When balance is not there, you have the facility to take money. Yeah, when you go on crediting bank, when bank becomes credit, that is OD only, no? Once upon a time, we had a chapter called as Bank Reconciliation Statement. When there is credit balance in bank, that means it's unfavorable. That is called as OD. Clear? You'll go on crediting. Okay, later we saw the balancing figure, no, 2 lakh. We issued debenture and got money. Huh. But better to write as bank only to avoid confusion. Yes, that's it. That's it, guys. That's it. That's it. That is the only thing that we have to remember. Let's go into question number 2. May 24. Did they ask one question in May 24? Yes. Did they ask one question in September 24? No. There was no question in September 24 from internal reconstruction. At least the big one was not there. One small question was there. Okay. But 14 mark question only twice they have asked in new scheme. That is Jan and that is in May. Okay. Question number 2. Yes. Following is the summarized balance sheet of Z Limited as on 31st March 2024. Now you can see equity and liabilities. Share capital, equity shares of 100 each, 8% preference shares of 100 each, 10% debentures of 100 each. Nothing in schedule 3. Randomly they have given information. Okay. Goodwill, property, plant and equipment, trade receivable, inventory, cash at bank, owned debentures. Oh. What is this? Investment in owned debenture. Remember, debenture cancellation. Okay. Nominal value 6 lakh, owned debenture 5,76,000. In case I cancel, I will get 24,000 profit. If I cancel it, I'll get 24,000 profit. Let's see what they have asked. P&L 12,35,000. Sir, in this P&L doesn't have debit balance only, sir. Where is P&L sitting? Under asset side, sir. It is debit balance only. To show this debit balance, if you take it to liability side, it would have been negative. It is sitting in asset side only. Are you getting this? It is still debit balance. Okay. Now, on 1st April, court approved the following reconstruction scheme of Z Limited. Now, each equity share shall be subdivided into 10 equity shares of 10 each fully paid up. After subdivision, each equity share shall be reduced by 40%. How much is the equity share capital right now? 60,000 shares. 60,000 shares. It is subdivided into what? 10 equity shares. First, you are going to pass the entry equity share capital to equity share capital. Equity share capital to equity share capital. 60,000 shares with that. When it is subdivided, it will become 6 lakh shares. It will become 6 lakh shares. Clear? So 60,000 into 100 is equivalent to 6 lakh into 10. Clear? Now, after that, what they are doing? They are going to, it will be reduced by 40%. So, equity share capital account debited to capital reduction. Here also, it would have been more better if they pass the entry like this. Equity share capital debited 60 lakhs to equity share capital 36 lakhs to capital reduction 24 lakhs. Because you are reducing the value, no? Remove the old one fully, issue the new one. Clear? Next, after that, preference share dividend are in arrears for last 4 years. Okay, very good. Okay. Preference shareholders agree to waive off 75% of the dividend claim and accept payment for the balance. 75% gone. So you don't focus only on that 75%. You focus only on 25%. Preference share capital is 21 lakhs. So 21 lakhs into 8% into 4 years into 25%. 1,68,000 you are going to pay or you are going to issue equity shares. You are going to pay or you are going to issue equity shares. What did they tell? They said that it is going to be payment for the balance. So you will pass the entry capital reduction account debited to bank account. Is this clear? If it was equity shares, you would have written capital reduction account debited to equity share capital. Now next, own debentures of 2,40,000 were sold at 98 cum interest and remaining own debentures were cancelled. Ayo, what are they talking? Own debentures are going to be sold at 98. Now, listen. Luckily, we are on 1st April. Okay. So, no interest has accumulated yet. Otherwise, we have to go into AS 13 investment accounting and apply those principles also. Luckily, that problem is not there. So, first what we will do? Bank account debited. Bank account debited. 2,35,200. From where they are getting this number? See over here. Here they said what? Own debentures of 2,40,000 nominal value were sold at 98. 2,40,000 nominal value. See over here. How much is my own debenture? 5,76,000. 5,76,000 and of this, okay, this is the investment and this is the face value. How much is the face value? 6 lakh. How much they said is cancelled? 2,40,000 face value. So 2,40,000 if it is the face value, nominal value is face value only. Gube. Okay. Okay. How much is the investment? Now do the cross multiplication. 2,40,000 into 5,76,000 divided by 6 lakhs. Are you getting 2,30,400? Very, very crucial point. You know why? First of all, that debenture cancellation only is a different thing for us. Another thing is 90% of the students what they will do. Oh, old debenture 2,40,000 were sold at 98. Okay, directly we'll take 2,40,000 only. No, 2,40,000 is the face value. Investment was how much? Investment was not at face value. We took it at lesser value. Again, understand this. The investment is showing 5,76,000. Face value was 6 lakhs. Face value was 6 lakhs. That means if the face value is 2,40,000, how much is the investment value? 2,34,400. 2,34,400. Clear? That is why can you see over here? Own debentures is credited for 2,34,400. 2,34,400. Now, what was the face value? 2,40,000 divided by 100. That means how many debentures? 2,400 debentures. It is sold at what value? 2,400 debentures. It is sold at 98. 2,35,200. Sir, we already studied this, but something else only was there. We studied this today morning in buyback, where own debentures are cancelled. Here what they are doing? They are taking the own debenture and selling it back in the market. Own debenture back in the market. How many debentures? 2,400 debentures. At what value? 98. You got 2,35,200. What was your investment? 2,30,400. That means you sold it at a higher value. That means you are getting profit. Profit goes to capital reduction. Very, very important point. Did you understand this? Very, very important point. First, multiple mistakes you can make over here. First mistake is not understanding only. What are you trying to tell? Okay, obviously, right? Then second mistake is taking 2,40,000 and passing the entry. First of all, why did they tell 2,40,000? For you to understand how many debentures are sold. Okay, 2,400 debentures are sold. At what value? 98. If it is sold at 98, bank account debited. Bank account debited. Now, usually what we do, bank account debited for whatever we got. To investment for whatever was the value. Value, how will we find out? We know the total investment value. So we know 5,76,000 and 6 lakhs are parallel to each other. How much is 2,40,000? Now I know the value of the investment. I know 2,34,100 was sold for 2,35,200. Remaining everything is profit. Is this clear? Are you following this? Yes. Okay. Now next. Okay. Next. Debenture holders of 6 lakh agree to accept one machinery of book value of 9 lakh in full settlement. Shouldn't be a problem. Debenture gone 6 lakhs. Machinery gone 9 lakh. Good or bad? Bad, oh bad. How can it be good? 1 minute. There is also some cancellation, no? Remaining owned debentures were cancelled. How much is the remaining owned debentures? Understand this. Face value out of 6 lakhs, 2 lakh 40 went. So understand this. Investment 5 lakh 76,000 is 6 lakhs. How much is remaining? 3 lakh 60,000. Or you can just do 5 lakh 76,000 minus 2 lakh 30,400 is equal to 3 lakh 45,600. This investment is there or gone? Cancelled. Okay. Tell me one thing. What is the investment value? 3 lakh 45,600. What is the face value of debentures? 3 lakh 60,000. 3 lakh 60,000. How? Out of 6 lakhs. Understand this. Out of 6 lakhs. 6 lakh was the face value. 2 lakh 40,000 was again sold in the market. Clear? 3 lakh 60,000. 3 lakh 60,000 face value is cancelled. 3 lakh 60,000 face value is cancelled. So what entry will you pass now? Debenture gone 3 lakh 60. Investment gone 345. Capital reduction 14,400. Are you following this? So what happened over here? Now see. Understand this. Little debentures sold back in the market at 98 rupees. Remaining debentures are cancelled forever. Clear? When we sold back in the market, we sold at higher value. So there also I got profit. When I cancelled, obviously I am going to get profit anyways because it was at a lower value. Investment was purchased at lower value. Clear? Yes. After this, what happens? Remaining property, plant, equipment were valued at 60 lakhs. First we will pass the entry for this one. Debenture gone. Machinery gone. Capital reduction debited. Why debited? What is happening? You are feeling colder. Then? I am actually feeling hot. What is the temperature? 20? Why do we have AC? For 26. Yes. Now 10% debentures. Listen. Debentures of 6 lakh took machinery of 9 lakh. Liability went 6 lakhs. Asset went 9 lakh. That means it is a loss. Loss is debited to capital reduction. And then they said balance, whatever balance property, plant and equipment, it is valued at 60 lakhs. Now, tell me one thing. Okay, what was the property, plant and equipment in the question? 72 lakhs. From that, what went? Till now, what went? From 72 lakh, what did you remove? 9 lakh, not investment. Plant and machinery, 9 lakhs. That is 63 lakhs. 63 lakh, if you have to make it 60 lakhs, what will happen? Capital reduction account debited to property, plant and equipment. Okay, from 72, you removed 9 over here. Okay, this became 63. Now the 63 also you want to make it 60. That means 3 lakh is loss. Clear? Next, after that, trade payables, trade receivable, inventory were valued at 15 lakh, 13 lakh, 9 lakh 44,000 respectively. How much is trade payable in the question? Trade payable is 16 lakh 80. They want to make it 15 lakhs. That means 1 lakh 80 reduction. Good or bad? Very good. Trade payable account debited 1 lakh 80. They passed one ultra compound entry for this. Okay, otherwise you would have done trade payable to capital reduction and so on. They passed one ultra compound entry. Trade payable debited. You have to debit it. Okay. Trade receivable is becoming 13 lakhs. What is the trade receivable value? 13 lakh 75. That means trade receivable is going down. Asset going down is not good. Credited to asset. Then what did they tell? Inventory 944. How much is the inventory right now? 9 lakh 80. That means inventory is also going down by 36,000. Net, they have put 69,000 profit. Net. Otherwise, you would have done entry by entry. Okay, you would have written trade payable to capital reduction to trade receivable, capital reduction to inventory, which should have given the same net effect ultimately. Okay. Next, company paid 60,000 as penalty to avoid capital commitment of 12 lakhs. What should I do for 12 lakhs? What should I do for 12 lakhs? Nothing. What should I do for 60,000? Pass the entry. You are paying penalty of 60,000 to cancel a contract of 12 lakh. Are you getting my point? You had a contract of 12 lakh. Maybe they asked you to construct a building like this for 12 lakhs. Okay, but you could not. So you have to pay a penalty of 60,000. So penalty is a loss. Capital reduction account debited to bank account. Okay. Next they said interest on 10% debentures is paid on 31st March. That's why I told you we are on 1st April. Even though they told come interest and all, we don't have to bother only because we are at the year end, they paid the interest. Okay. Now, whatever is there in capital reduction, it will be used to write off the goodwill and the P&L balance. Okay. P&L balance was how much in the question? Negative 12,35,000. How much was the goodwill in the question? Goodwill is 81,000. That means we don't have enough money to, oh, it is exact match. Exact match. That means if you miss one entry that side, this side, you will end up getting capital reserve. Are you getting my point? Exactly how much is required to remove goodwill and P&L, they have kept it over there. Now finally, oh, not exact match. They are just lazy. Where required, they will not pass entry. One more entry at the end they pass. Capital reduction account debited to capital reserve. Are you getting my point? Where it was not required to be compounded, one ultra compound entry. Trade payable debited to trade receivable, everything. Where you could have compounded and written there only, separately they have put into capital reserve. Is this clear? I hope you know it, and I hope you know how to get the capital reduction balance. You have to see every journal entry from starting, plus minus you have to do. Which plus minus? All the credits should be added, all the debits will be subtracted. You will get some profit that profit will be utilized. Clear? That should be it. Capital reduction account, at your free time you go and see whatever journal entries we have done, just you are going to do the posting of that. Bank account also you see on your own. I am not going to worry about that. We'll go into the next question now. Study material question. Question number 3. Sir, what's the study material question? Why you have put? Because we have shares surrendered. We have shares surrendered. Question number 7, I think, in your study material. Tala for a reason. Should wear, today also I was thinking of wearing RCB cap. Because yesterday RCB won. Last marathon I wore RCB cap for 2 hours. First, what after 18 years? We play to entertain. We don't play to win. What? At least, where are you in the table this time? Huh? When you come up, we will knock you out. Like last season. Last season we were here. You were here. Always qualifying, always qualifying. Slowly. We came up. Huh? We don't like cup at all. We drink from bottle only directly. We don't like cup at all. Huh? Is it? CSK. I'll tell you this year 100% CSK will not win. They have such a stupid team. No way. I don't know whether RCB will win or not, but CSK will not win. SRH might also win, who is in the last position right now. They also can win. But other day, someone was like one of my friend who is a CSK fan. He's sending me a message. He's like, bro, how do you drink tea and coffee? You guys don't even have a cup. I'm like, Gube, that is a trophy. You think what Dhoni is pouring the tea in that trophy and is drinking every day? Like any level they'll go. And the fun part is what you know. CSK has 5 trophies. Mumbai Indians have 5 trophies. They both should fight with each other. They are fighting with someone who has no trophies at all. So imagine who is bigger. With no trophies, they are coming and fighting with us. Yesterday in the CMA batch which I was taking up, no, the CSK fans and Mumbai Indians fans both united. They're like, today RCB should lose. Yes, let's continue. Question number 3. Sir, can we write compound entries? Yes, we can. Wherever they want to, they are writing. You follow one methodology. Okay, now, important question. I think in the study material only one question is there, which is on share surrender, which we have to understand properly. Okay. Shh. Is it? It's because of the questions that I have picked. Wait for the next few. Okay, guys. No tricky question is left. Doesn't matter. Easy question, you solve. Okay, balance sheet of Revise Limited. Balance sheet of Revise Limited as at 31st March 2021 was as follows. Yes, you can see the share capital, reserves and surplus, long-term borrowing, trade payable, other current liability, short-term provisions. Then you have property, plant and equipment, inventory, trade receivable, cash and cash equivalent. Clear? Share capital, luckily you have only equity shares, less work. Debit balance of P&L, you can see a huge loss. 12% debenture, interest payable on debenture, their outstanding interest is also there. Provision for taxation, machinery. Now, whenever in internal reconstruction they tell you, debenture holders to be settled. Debenture holders means these two. If they tell debentures to be cancelled, then you will cancel only debentures. If they tell debenture holders to be settled, then what you will do? You will merge both of this. Whatever is payable to debenture holders. Now, it was decided to reconstruct the company, for which necessary resolution was passed and sanctions were obtained from appropriate authorities. Accordingly, it was decided that one by one, we'll focus now. Question number 3. Okay. Each share is subdivided into 10 fully paid up shares of 10 each. One by one transaction we have to see. Okay, how many shares we have right now? 10,000 shares. Subdivided means it will become 1 lakh shares. It will become 1 lakh shares into 10 rupees. So the entry will be equity share capital to equity share capital. Okay. They have done next one also together only. Equity share capital to equity share capital should have happened. Then after subdivision, each shareholder shall surrender to the company 50% of his holding for the purpose of reissue to debenture holders and trade payable. What company told? See, we have to pay debenture holder and trade payable. They're eating my head for money. Okay, now I don't know how to pay them. You give your share. Okay, I will give that only to them. That was the deal that they made with the shareholder. Clear? Now what will happen? Share capital debited. New share capital is only 5 lakh, 50%. 50% is sitting in one account called as share surrender. Clear? Okay. Now, out of the share surrendered, 10,000 shares of 10 each shall be converted into 12% preference shares of 10 each fully paid up. Shares surrendered were there. We converted that into preference share. What should be the entry? No entry. No entry. Why no entry? There was Sanjit over here. Okay. Sanjit over here. Okay. He was standing with one lollipop kid, no. Okay. So what happened? Sanjit, this is the company. Sanjit gave his shares back. Sanjit gave 50% of his shares back. Company got share certificates. In the share certificate, it is written equity share. Clear? Now, what did they do? They said that we are going to, wait, where is the question? 10,000 shares shall be converted into 12% preference shares. Now, tell me one thing. In your pocket, equity share was there. They removed this and they wrote preference share. What entry will you pass? Yeah, but the share is not issued yet. I had issued share to you. Now your 10 rupees share, I am making it 100 rupees. I have to pass an entry because I have a liability holder. I took it back from you. I passed the entry. Now I am giving new form to it. In the new form, if I give it to somebody, I have to pass an entry. But it's still with me over here. Are you getting my point? Imagine I go to shop and buy one Cadbury dairy milk. I go to shop and I bought one dairy milk. Clear? Huh? Okay, I bought one dairy milk. Now when I bought the dairy milk, I passed an entry. If I give the dairy milk to somebody, I have to pass an entry. Now I thought, this is not dairy milk at all. This is Ferrero Rocher for me. It is full, there is no space to write. And I have to think of spelling also. So I wrote F. Who will think of Ferrero-Rocher spelling? So many things are there already. Yes, FV. Don't think of periodic table and all. I know your thought went there. Yes, bring it back. So, that I don't know anyways. What is FV in periodic table? Oh, you also don't know. Good, we are on the same table. It is not silver at all. It cannot be silver because silver I learned from CA Foundation. What is the periodic element for silver? I learned in CA Foundation. When I was teaching CA Foundation, there's one question. AU, AG and something in partnership. AU, AG. No, in that silver is there. Later, new partner is silver in that. I forgot the element, but AG is silver. See. AU is gold. There I learned. Otherwise, I knew only one thing in the periodic table. K. Potassium. How I learned that? When I was sending K, someone sent a meme. Potassium. I was sending K in text. When I was irritated. Direct entry. No, but periodic table doesn't come in CA Foundation. It comes in science school. Direct entry has nothing to do with it. No, you didn't study school properly. Even I didn't study, no problem. Okay, now. Okay, FE, Ferrero-Rocher. Now I made this Ferrero-Rocher in my own head. Clear? Is there any entry? No. But if I go and give it to somebody, there is a transaction, I'll pass an entry. Same way, understand this. This fellow, listen, very important point. If you go and pass entry for this in the exam, no, gone. Entire thing will go after this. This fellow gave the shares back. Did I pass an entry for that? Equity share capital account debited to share surrender. Entry is there. Now, after he gave the share, I want to give it to somebody. No entry. I give it to somebody, entry. I want to give it to somebody, there is no entry. When I give it, now I have changed. I told next time when I am giving it to somebody, I don't want equity share. This will become permanent person. Some people I'll give preference shares, temporary. Okay, that time I just changed the name of that. There is no entry for that. When I issue it, I will issue it. Very soon I'll issue it. That time there is an entry. Is this clear? While issuing preference shares, there is an entry. That's what. Next, there is an issue. No. All the shares are here called share surrender. From this I take and I give it to you as preference share. Then I'll write share surrender to preference share capital. For this person I'll give equity share surrender to equity share capital. Yes. Now the claims, this one and this one are very, very important. Okay. After that there is nothing in this question. These two. Yes, Bala, get up. The claims of the debenture holders shall be reduced by 75%. Claims of the debenture holders shall be reduced by 75%. Now, see the question here. How much is the debenture? 2 lakh. How much is the interest? 24,000. Debenture is 2 lakhs and outstanding interest is 24,000. So 2,24,000 into 75%. 1,68,000 we are going to reduce. Correct? See over here. They said claims of the debenture holder shall be reduced by 75%. In consideration of the reduction, because they agreed to reduce, debenture holder shall receive preference shares of 1 lakh which are converted out of shares surrendered. See the ultimate deal I am making. See the deal. Went to the equity shareholder and told, hey, please give me share. I have to pay so many people over there. Then going to that so many people and telling, I will pay you less, adjust. There also profit, here also profit. Clear? Now see over here. Debentures debited 150. Outstanding interest debited 18. This was the 168 which we were talking about. Okay. To reconstruction, which is capital reduction account. Profit. Sir, what profit, sir? We are giving equity shares. No. How can full thing be profit? For this, I am going to give 1 lakh, sorry, not equity share. I am going to give 1 lakh of preference share. No. How can it be profit? Profit, oh, profit it is. Profit, oh, profit. How? I took share back from you. Okay. And I am giving that. Nothing went from my pocket. Nothing went from my pocket. So whatever I am paying over there is 100% benefit for me. Even after? Yes. Afterwards we will be repaying. We will not be repaying. Why? I just cancelled my debenture holder. What will I repay? Are you getting my point? See, listen, Kiki had to, I had to pay Kiki some money. Okay. I had to pay Jairaj some money. Okay. So I told Jairaj, you cancel your payment. Okay. You give that money to me. Okay. Whatever was there. Jairaj gave that share. I told what to do with this. I'll give it to Kiki, and I told Kiki, settled. Who lost money here? Jairaj lost money. From Jairaj's pocket, which is not money actually, share. Jairaj share we removed and we gave it to Kiki. For company, what is extra thing over here? Nothing. I had to pay Jairaj money before. Now I'll pay Kiki money. That's all. Is this clear? Are you following this? Okay, now understand this. Debenture account debited, interest payable debited to reconstruction. Fully 75% which reduced. No, fully it is profit. Sir, earlier it was not profit. You know why? If I reduce, I'll pay money. If I reduce, I'll issue new equity shares. Here I'm not issuing any new equity shares. Took from the old people and giving it to the new person. Okay, now see over here. Share surrendered account debited to preference share capital. Can you see we are issuing preference share capital to those people? Okay. Now, will the 25% still remain in the books? 75% reduced. Will the 25% still remain in the books? Yes. Why? They told here, in consideration of the reduction, you agreed to reduce. For that, I'll give you shares. Balance 25%, you did not agree. It is still there as outstanding. Now, trade payables claim shall be reduced to 50%. Trade payables claim shall be reduced to 50%. It is to be settled by issue of equity shares. It is to be settled. First I am reducing and then balance I am settling. For me, how much is profit? 50% or 100%? Or 0? How much is profit? Trade payable is 72,000, right? Trade payable is 72,000. Where is it? Yes, trade payable is 72,000. Understand this question here. Trade payable claim shall be reduced to 50%. It is to be settled by issue of equity shares of 10 each out of share surrender. Reduced to 50% is profit. Remaining 50%? Everything is profit. Everything is profit. Why? First I made the deal. I made the deal with the creditor telling that we'll reduce 50%. There I got 50% profit. Then I told I'll give you 50%. How I will give you? By taking from share surrendered. So again 100% profit only, no. Nothing went from my pocket, no. See the entry. Capital trade payable account debited to capital reduction 72,000. Full 72,000 went. Clear? Full 72,000 went. Sir, here why sir 75% and here why sir 100%. Here it is reduced to 75% and for reducing we are giving shares. Here it is reduced to 50% and balance we are going to settle. That means 100% gone from the books. 50% reduced and balance we are going to settle, so that 50% also went. But balance how we are settling? By not giving money, we are taking from share surrender. Is this clear? Now, share surrender account debited, 36,000 we are going to give now 50%. 3,64,000 goes to capital reduction. Share surrendered but not issued to anybody. See over here. Balance, the share surrendered and not issued will be cancelled. What a deal I made. I took 5 lakh back from the shareholders. Did not give it fully also to these people. From here also I made profit. There remaining I did not give it back to the shareholders. There also I made profit. This is internal reconstruction. Somehow you have to make profit, that's all. In the book you have to see one positive figure, that's all. Okay, yes. Now balance of P&L to be written off. How much is the P&L balance? 6 lakh negative. You have to calculate and see what is there in reconstruction account. I think you are getting 6 lakh 4,000. This is balancing figure. 6 lakh you will cancel. 4,000 will go to capital reserve. From 6 lakh we came to 4,000 positive. Wow. Now balance sheet. Share capital 6 lakh 36,000. How? First I had 10 lakhs. 5 lakh was surrendered. That means right now I have 5 lakhs. I issued 1 lakh of preference shares. That time it became 6 lakhs. Then I issued 36,000 of equity shares. That time it became 6 lakh 36,000. Is this clear? From 10 lakh it became 5 lakh when shares were surrendered. Out of the shares surrendered, 1 lakh of preference share was issued. It became 6 lakh again. After that 36,000 of equity share was issued. It became 6,36,000. Is this clear? Are you following this? Yes. Now, reserves and surplus, 4,000 is the capital reserve which we saw. Okay, long-term borrowing, what is this 50,000? 12% debenture. Remember, we had 2 lakh of debentures. Out of 2 lakh debentures, 75% gone, 25% is remaining. Remember, we had outstanding interest of 24,000. Out of 24,000, 75% is gone, so 25% is remaining. Where are we getting all these numbers from? See here, 2 lakh, 75% gone, 24,000, 75% gone, 25,000 remaining. Short-term provisions, as it is, we did not pay anything. And sir, one more thing is missing, sir. In the question, no, there was one more thing. What is that? Trade payable, not there at all. Gone, fully gone. 50% cancelled, 50% settled. Okay, assets, I don't think we have made any modification to asset. Asset is as it is. Okay, inventory also we have not done anything. Trade receivable also we have not done anything. Cash and cash equivalent, have you made payment to anybody? I don't think there is any change. All the things are same in the asset side. Done. This is your share surrender concept. Don't expect it to come just like this, only share surrender. It will be merged with something else. Share surrender also will happen. X and Y concept also may come into picture. Anything can happen in life with ICAI. Fourth question. Any doubts with this, guys? No. Let's go further. RTP May 2020. When we go into 2020 and 2018 category and all, it becomes very, very interesting. Okay. Third sum. Just now we did know. 2 exam questions and 1 study material question we finish. And now we are going to RTP May 20. Beautiful question. Beautiful question we have. Have you seen these people? Bombay work, Chennai work. Bombay work and Chennai work. CSK and Mumbai Indians. Hello, madam. Chennai work. Yes, go first. The following is the balance sheet of Star Limited as on 31st March 2019. Okay, this is the balance sheet. Given what next? What next? Here, read the question. What profit? Profit and loss, small loss. Okay. We will see. We have seen bigger losses and come. No, 6 lakhs and all. 9,000 7% preference shares of 100 each fully paid up. 10,000 equity shares of 100 each fully paid up. Please pay attention to this question. Very, very beautiful. Okay, something out of ordinary has happened in this internal reconstruction question. It is not very difficult for ICAI to pick this adjustment and put into one question. I see. You see, no, all the tough questions that are ICAI. See, you should actually be happy if tough questions come in the exam. You know why? If you have seen all the tough questions, you will be able to solve. Many people won't be able to solve. Are you getting my point? You will be able to solve because you should see all the tough questions and many people won't be able to solve. That time, continuously, person correcting. Oh, wrong. Next paper, wrong. Next paper, wrong. Suddenly, one person has done it correctly. Impression is gone way high. 1, 2 narrations, if you miss also, they might not cut marks. Only narrations if you miss. Not that balance sheet total is not tallying. Okay, narrations if you miss only, they might be lenient. You're like, sir, this if I do well. Next balance sheet not tallying at all. Full 14 marks he'll give. No, that will not happen. Okay. Hey, Karthik Raja, what? Luckily, Darshan didn't drink. He was about to drink. Otherwise, he would have full sprayed like Triple H. You know Triple H? He'll put water in the mouth and he'll spray it near the ring. Huh? It's not water. Huh? What is it? Hey, that you're telling different person. That is Stone Cold Steve Austin. Beer. Huh? I saw him drinking water bottle. Bisleri. Triple H. Huh? Okay. Now, non-current liability. A. 6% debenture secured on Bombay work. B. 6% debenture secured on Chennai work. What is this? What is this A and B? Secured even I can see. What is this A and B? What is this A and B? Shabash. I am still here. You have gone ahead. What is this A and B? First debenture, second debenture. Instead of telling first and second, it is A category debenture, B category debenture. In case of liquidation, we are going to pay the money back. First, when the money comes, you will pay the A category debenture, then you will pay the B category debenture. Clear? Workmen compensation fund is there. Bombay work, Chennai work, 10-5. Trade payable, 1,25,000. We'll see. All this also will come into our question. Don't worry. PPE. Bombay work, Chennai work. Investments. Investment for workmen compensation fund. Can you see the workmen compensation fund was 15,000? That they have gone and invested. Basically, what is it? Took from profit, kept it aside, went and invested it somewhere so that it is growing. Inventory, trade receivable, cash and cash equivalents or cash at bank. Reconstruction scheme was prepared and duly approved. Salient features of the scheme were as follows. Already I can see that some batteries are dying. I want to see which battery will be there till the end. I am going to stay till I finish cash flow statement. Okay. It is not regular class that when you are tired, I am just going to leave you. I am going to continue till cash flow statement ends. Come, whatever time it might be. Okay. Yes. So, 8th April. It's 8th April only. Few days left for exam. When does the exam start? Huh? May 3rd. Hey, not even 1 month. Now battery will get recharged. Yes. Paid up value of 7% preference share are to be reduced to 80. But the rate of dividend being raised to 9%. This is a very, very common adjustment. Paid up value we are going to reduce to 80. The dividend rate we are going to change to 9%. Right now, what is the preference share? 9 lakh. Okay, 9 lakh. 9,000 into 100 will become 9,000 into 80. 9 lakh. 9,000 into 80 is 7 lakh 20,000. When you reduce 20 rupees, automatically it goes into capital reduction. Can you see 7% gone? New preference shares are 9%. Okay, simple one it was. I told you, simple question only it is. Okay, paid up value of equity shares are to be reduced to 10. How much was it before? 100. No respect at all to equity shareholder. Preference shareholder from 100 to 80 we made him. Equity shareholder straight from 100 to 10. 1 0 only we removed. Okay, very good. Now, you're like, sir, it is injustice, no, sir, for equity shareholder. Who is passing this decision? You know, he only. Who is taking this decision? Equity shareholder only, because they want to save their company. Now, equity share capital 100 rupees gone. Equity share capital 10 rupees will be 10%. Can you see 1 lakh over here? Full 9 lakh goes into capital reduction. Shouldn't be a problem at all, this particular entry. Next, let's go further. Directors to refund 50,000 of the fees previously received by them. Whoa, what beautiful people we have even in our company. They are not cancelling their old fees which we had paid them. They are coming and giving it back. Take. Are you getting my point? Earlier and all what happened? Creditor, we had to pay 72,000, 36,000 cancel. Okay. He will be like, okay, at least half I am getting, I'll take the money. This is not even that. Earlier I had paid the money, I gave him salary and I told, very good job. Actually I shouldn't have given salary only. Why? Because of director only I am sitting in this internal reconstruction situation. Management is whom? In director only, no. I used to come to AGM, eat Mari biscuit and tea and go. Thinking that director is doing great job. Then I got to know, oh, director has led to a situation of this 2 lakh negative. Okay, now director is going to refund 50,000 of the fees. Can you tell me the entry for this? We are getting money or we are giving money? We are getting money. Bank account debited to capital reduction. Bank account debited to capital reduction. Next, debenture holders forego their interest of 26,000 which is included among the trade payable. Not only I don't know about business, I don't know about accounting also. Business was bad, we are sitting in loss. No. Outstanding interest I have put into trade payable. Okay, and I am not going to pay also. Okay, they agreed to cancel. So trade payable should be debited because we are removing 26,000 to capital reduction. Is this clear? Next. Preference shareholders agreed to waive their claim for preference share dividend which is in arrears for the last 3 years. Last 3 years dividend was pending. They told don't give. I told okay I won't give. What should be the entry for this? No entry. We can, but after they told specifically that it is included in trade payable, it is better to debit trade payable only, no? See, basically, what is the entry for interest? Outstanding interest. Interest account debited to outstanding interest. They pass the entry, interest account debited to trade payable. So now when I remove, I should remove from trade payable. It's better to remove from trade payable. Okay, next. B. B means B category. 6% debenture holders agree to take over the Chennai work at 4,25,000 and to accept an allotment of 1,500 equity shares of 10 each at par, and upon them forming a company called as ZIA Limited to take over the Chennai work, they allotted 9,000 equity shares of 10 each fully paid to Star Limited. I didn't understand anything, sir. I only am going to stars now. Okay, ZIA Limited. What and all is happening in this point? Actually, many things happen in this point only. Okay. Now understand this. We'll break down the sentence and try to understand. 6% debenture holders agreed to take over the Chennai work at 4,25,000. Okay. How much is the 6% B category debentures? 3,50,000. Now see this entry. 6% debentures account debited to debenture holders. Chennai work and all is not coming into picture only. They took a round trip. That's all. Okay. Debenture holders account debited 4,40,000. Oh. What are they doing, guys? Nothing is going into our head, sir. Only the food is rotating in the stomach. After, yes, see over here. Chennai work they took and to accept an allotment of 1,500 equity shares of 10 each at par. Who is issuing equity shares to whom? Who is issuing? Star. Oh, Star Limited is the name of the company. Okay. Who is issuing equity shares to whom? Imagine, I am cancelling the debenture holder and what I am giving him? What I am giving them? Chennai works and I am going to issue equity shares. Chennai works at what value I am giving? 4,25,000. 4,25,000. How much was Chennai work? We don't know what's going to happen after that. We'll wait. Okay. And upon them forming a company called ZIA Limited to take over Chennai work. What they are doing? They are going to take your Chennai work. Chennai work, basically you can think as building in Chennai and building in Bombay. That's all. Chennai work, you can consider like that. Now, they allotted 9,000 equity shares of 10 each fully paid to Star Limited. They are giving shares to you. Are you getting my point? They are giving shares to you. How much you had to pay them? 3,50,000. Debentures were how much? 3,50,000. How do we get this? Straight away from the question. Can you see in the question, you can see 3,50,000 over here? Okay. Now 3,50,000 we are transferring to debenture holder because this I am supposed to pay to the debenture holder. Now what is happening after that? Debenture holder is taking my Chennai work and is taking my share. 4,40,000. Can you see the difference over here? Okay. I am supposed to pay 3,50,000. He took my asset 4,40,000. 90,000 is the difference. For this 90,000, he is giving me shares in his company. Wow. Negotiation at top level. I had to pay him money, told him take little more and give me shares in your new company. Startup, there also I invested. Are you getting this? So, understand this again. Debenture holders were 3,50,000. So, debenture I had to pay 3,50,000. What did I give them? I gave them Chennai work of 4,25,000. And I gave them 1,500 shares of 10 rupees. So this is the amount that I gave them. And in the question they had told, okay, and upon them forming a company. See, first what I did, I gave them Chennai work and I gave them shares. And after they formed the company, okay, to take over the Chennai work, they allotted 9,000 shares at par to Star Limited. What did I do? I gave them the Chennai work. I gave them the shares and then they formed the company with that. After they formed the company, they allotted shares to me, 9,000 shares of 10 each. Okay, can you see the 9,000 is nothing but for the differential amount. Differential amount. You went to the, remember, imagine you went to the showroom. You have one showroom like this. Okay, and you had one bike. Okay. You had one bike. You went and gave this bike. Okay, you gave this bike and you told you want new bike. This bike in your books, the value of this bike was 5 lakhs. Okay, new bike, the value was only 3 lakhs. Now, the showroom person will pay you or you will pay the showroom person. Showroom person will pay you, no. He is taking 5 lakh bike and giving 3 lakh bike. Same way here. He is taking asset of so much value, but his liability was only so much value. So for difference, what he did not give us money. He gave us shares in his company. Now it became like cross holding. What is cross holding? He has shares in my company because I gave him 1500 shares, and I have shares in his company because he gave me 9000 shares. Is this clear? If somebody gives me shares, for me it is investment. Are you following this? Huh? No. Zia Limited, if you put Zia Limited, will come and become a creditor in your books. How will you get rid of that creditor? Your creditor is already there. Your creditor is debenture holder. Not yet. Debenture holder just got created. And then now debenture holder got settled here only. See, debenture holder credited 350. Debenture holder debited 440. Now it got settled. 90,000 differential amount got settled now. I had to pay him 350. Simple. I had to pay him 350. I gave him 440. So for the extra what I gave, he gave me 90,000 shares. That's it. Why debenture holder? See, actually what happens is, should have been an entry like this. Debenture holder or debentures account debited 3,50,000. 2. Chennai work 4,25,000. 2. Equity share capital 15,000. Correct. 2 equity share capital 15,000. Correct. Now for differential, what will I do? They'll give me money. Investment account debited 90,000. This is the compound entry. I gave this, my asset went, I issued shares, they gave me investment. They gave me shares. They gave it in 3 different entries, compound entry. Okay, let's go further. Chennai Workmen's Compensation Fund disclosed that there were actual liabilities of 1,000 only. Okay, now understand this. I think we missed the entry, no? Have they shown any calculation? No. See, Chennai workmen compensation. Can you see the workmen compensation Chennai? How much is there? 5,000 is there. See over here. Disclose that there was actual liability of 1,000 only. So, as a consequence, the investment of the fund were realized to the extent of the balance. And entire investment was sold at a profit of 10% on book value, and the proceeds were utilized for part payment of creditors. Actually, that entry got eliminated, I think. Correct, no? And one entry is missing. What is the attempt? RTP May 2020. Yes. We'll just check one entry there. It got star limited. This one only, no? Okay, we'll just see from here. Listen, Chennai work compensation. The 2 entries are missing there. Okay. Chennai works workmen compensation fund 4,000 debited to capital reduction. Why? Because in the question they said, okay, you can see the question. Chennai workmen compensation fund disclosed that there were actual liabilities of 1,000 only. Only 1,000 is the liability. How much fund we had created and kept? 5,000. We had created and kept a fund of 5,000. They said we don't need fund of 5,000. We need fund of only 1,000. So what we do? Fund is a liability. Remove the liability, transfer it to capital reduction. Remove the liability and transfer it to capital reduction. Is this clear? Now, what we are going to do? Then they said that we are going to sell the investment. Entire investment was sold at a profit of 10% on book value. How much is the investment? How much is the investment? 15,000. Correct? How much is the investment? 15,000. But see over here, they also told investment of the fund were realized to the extent of the balance. And then they said entire investment were sold at a value of 10%. 10% profit. Can you see over here? Being investment for workmen compensation. Okay, sold at a profit of 10%. How much is the investment? 14,000. How did we get 14,000? Because 1,000 we are keeping. Why 1,000 we are keeping? Because 1,000 is the liability there. They told no, 1,000 is still the liability. So for 1,000 we are not going to sell that. We'll keep that 1,000 investment like that. If I have 15,000 investment, out of that 1,000 investment goes, I will sell it for 14,000. But 14,000 I'm going to sell it with the profit of 10%. So bank account debited 15,400. Investment went 14,000. That time what happens? 1,400 will go to your capital reduction. Normally it would have gone to your P&L. Is this clear? Are you following this? If I have liability, I'll keep the investment. If liability is not there, I'll sell the investment. 1,000 is the liability. I'm keeping it. Remaining everything, I'm selling it. Clear? Bombay Works will come to that. We didn't reach no till there. We only finished Chennai Works. Entire. They said entire investments were sold. All investments. They didn't tell one, two and all. They said entire investments are sold. All. Only 1,000 you keep, everything they say, you sell. Language could have been framed better by ICAI. Okay. There is confusion or ambiguity is there. But if they ask an exam, they'll make it very clear. Now, inventory was to be written off by 1,90,000. Written off by 1,90,000. So what should be the entry for this one? Capital reduction account debited to inventory 1,90,000. They have passed the entry for that. Provision for doubtful debt is to be made at 20,000. What is the entry? Capital reduction account debited to provision for doubtful debt. Clear? Done. Sorted. Then Chennai work completely written off. Chennai work completely written off. Do we have some Chennai work still? I think that time some 7,75,000 we saw, no, Chennai work. Out of 7,75,000, how much is taken? 4,25,000. 7,75,000 was there. Out of that, 4,25,000 was taken by that Zia Limited. Now you have 3,50,000 to be written off. Asset, when it is written off, what should we do? Capital reduction account debited to asset account. Can you see here? To PP Chennai works. Clear? Then after that, what do we have? Any balance of capital reduction is to be applied as 2/3 to write off the Bombay work and 1/3 to capital reserve. Any balance, they said. Balance, not now. First you have to eliminate what? First you have to write off now everything. Where is Bombay works? Bombay, where are you? See over here. Bombay work is 9,50,000. But before that, first what we have to do? We have to remove the P&L. P&L we have a debit balance. How much is that? 2 lakh loss. Now when you remove 2 lakh loss, that time you will get some balance in your capital reduction account. 4,01,400. This is nothing but balancing figure. This balancing figure, they have specifically told this balancing figure what you are going to do. Okay, any balance, 2/3 will be to write off the Bombay work and 1/3 you will transfer it to capital reserve. Now what mistake you can do in the exam? You got balancing figure in capital reduction. You forgot that 2 lakh loss is there. 2/3, 1/3 you are doing first only. No. First you have to remove the loss. See over here. First you have to remove the loss. P&L. After removing the loss, balancing figure what you are getting from your journal entries. 2/3 you will write off the Bombay work and 1/3 you will transfer it to capital reserve. 2/3 Bombay work and 1/3 you will transfer it to capital reserve. Is this clear? Yes. That should be it. Pass necessary journal entries. Okay, luckily they didn't ask balance sheet. Otherwise, balance sheet shouldn't be a problem. You have journals in front of you. Nice question, no? Yes. They can ask in the exam, by the way. Everything tough you should expect and go. If it comes easy, good. By the way, someone is telling FE is iron, it seems. Yes. Question number 5. Question number 5. After this, do we have one more question? No. This is the last question from internal reconstruction. Let's buckle up. CA Inter November 2022. Small question. Only this much. Actually, nothing is there in this question, but something is there. Okay. Nothing is there in this question, but something is there. For that only I kept it. Otherwise, if you see no starting of the question, you'll feel there. This is like total bakwas. What happened? Yes. Let's go further, guys. Morning, guys. Are you there? Ananya Goel. She's there from morning. Some new Sharmi is there online. Who is this Sharmi? Double acting. Oh, there was a Sharmi before. Online, we are not finding one person who was there in regular class. Karthik Raja. Because Karthik Raja is there in face to face. Ananya is there. She is telling yes, yes. It is not her, it seems. It's you only. Why did you keep changing your name? Now what are you? Gube Raja. Yes, let's continue. But how she got debunked? We found out who she is. Yeah, one day there was no message. I was like, oh, that means. Yes, we have to catch the person. And so much hard work we did. We saw the list. Attendance register. Yes, let's go further. You know what was the mistake she made? She told what her original name was. But I didn't know who it was. I asked one day after class. Zoom was on. I'm like, what's your name? She told the name. That helped us. Like, that was the missing thing. No, she messaged so many people. She messaged her also and told, I'm only Karthik Rajan. What is this? Okay, guys. Question number 5. Following is a balance sheet of Purple Limited. Purple Limited. Now, can you notice something bad? Yes. 3 lakh rupees loss. Okay. Then short-term borrowing, all that. We have regular balance sheet only. There should not be any problem with the balance sheet. Notes to accounts, you have equity shares as well as preference share capital. Reserves and surplus. Reserves and surplus, you have P&L. Land and building, plant and machinery, intangible asset, goodwill and patent. Clear? Yes. Yes. Dividend on preference shares are in arrears for 3 years. What entry should we pass? No entry as of now. They didn't tell anything. Now, on the above date, the company adopted the following scheme of reconstruction. Preference shares are to be converted from 6% to 8%, but revalued in a manner in which total return on them remains unaffected. Oh, same thing what we used to do for debenture holders. Same thing. Preference shares, how much? 6 lakhs. What is the value? 6 lakhs into 6% is 36,000. They should get the same thing, but we have to issue preference shares of 8%. So divided by 8% gives you 4,50,000. That means preference shares right now we don't know if they are 100 rupees. If they are 100 rupees, they will become 75 rupees shares. If they are 10 rupees, they will become 7.5 rupees shares. Clear? Yes. Now entry. Preference share capital debited to preference share capital to capital deduction. Is this clear? That was not the tricky point. That you should have managed. Okay, so many questions you have seen that. Next, after that, value of equity share to be brought down to 8 rupees per share. This also I am not explaining in detail. Equity share capital to equity share capital, difference will go to capital deduction. Clear? Next, arrears of dividends on preference share to be cancelled. Very good, no entry. Only if you are giving, we'll pass the entry, no entry. Debit balance of goodwill account to be written off entirely. How much is goodwill account? 84,600, fully written off. Capital deduction account debited to goodwill. Compound entry, capital deduction account debited to goodwill. Then land and building and plant and machinery to revalued at 85% and 80% respectively. How much is the land and building? 5,40,000. That means we have to reduce 20%. Sorry, 85, no? We have to reduce 15%. 81,000. How much I have to reduce? That much only I want to know. How much should remain? That will remain if I reduce. Okay. This will be 20%, 96,000. Clear? That much I have reduced. Can you see 81 and 96? They told it should become 85. Remove 15, it will become 85. They told it should become 80. Remove 20, it will become 80. Clear? Next. After that, they said book debts amounting to 14,400 are treated as bad and hence written off. So, to what? Capital reduction, yes. To what? To bad debtor. To debtors. To debtors. What is the entry for bad debt? Bad debt account debited to debtors. Now we are in internal reconstruction. So directly capital reduction account debited to debtors. Trade receivable or debtors. Clear? Next. See this one. This is the point for which I chose the question. Otherwise, this point is not there in any other question. Company expects to earn a profit at the rate of 90,000 per annum. Till now they didn't make profit. They are sitting in loss, but future expectation is high. Okay, 90,000 per annum. From the current year, which will be utilized entirely for reducing the debit balance in P&L account for 3 years. They're telling, don't worry, you're doing internal reconstruction, but don't worry, from this year onwards, every year I will make 90,000 profit and next 3 years I will use the profit to write off the loss. How much loss is there? 3 lakhs. They are telling, we will make 90,000 profit, 90,000 profit, 90,000 profit. That means how much profit I'll make? 2,70,000 profit. 2,70,000 profit. Now this 2,70,000 profit, what is there? No. Don't worry. I will only adjust. You don't do internal reconstruction and all. What you're doing, don't use for this. The remaining balance of the said account would be written off at the time of capital reduction process. That means only 30,000 you quietly write off. Enough. Thank you for your favors. They said 30,000 you write off. Remaining loss you keep like that only. Let it be in the balance sheet itself. Clear? To P&L 30,000. Did you get that point? It's not there anywhere else. Did you get that point? They said again, company expects to earn a profit of 90,000. They are telling we will make profit of 90,000. Next 3 years, whatever profit we make, we will use it to write off the loss. 3 years, 90, 90, 90. If you make profit, you will get only 270 profit. Balance what is that? That you write off today. That is only 30,000. So the entry will be capital reduction account debited to P&L 30,000. Balance of the total capital reduction is to be utilized in writing down the patent. After doing all that, if you have balancing figure, don't transfer it to capital reserve. Write off the patent. How much was the patent value? The patent value was 36,000. I think when you are doing this, you will get a difference of only 24,000. That means in the balance sheet, patent should still be there at 12,000. $36,000 minus 24,000 is 12,000 in my calculator. Clear? Yes. Now after that, done no. Secured loan of 4,80,000 bearing interest of 12% per annum is obtained by mortgaging tangible fixed asset. Nothing. They are telling we will keep the asset and we'll take one loan. How much is the loan? 4,80,000. Okay. For repayment of bank OD and for providing additional funds for working capital. So we are taking loan. Bank account debited to loan account. Then what will we do with that money? Loan account debited. Okay, bank OD account debited to bank. Sir, something is missing. They told you have to keep the money for working capital. Balance is working capital. Working capital means what? Money for day-to-day expenses. If you don't spend 4,80,000 fully, remaining money will be there for expenses only. No. Are you getting this? That is it. Capital reduction account, when you are free, you just have a look at it. Nothing. You're just going to post the entries. Balance sheet, I just want to focus on only this loss. Can you see your real loss? 2,70,000 because only 30,000 we removed. This 2,70,000 we have hope that we will only write off. No need of internal reconstruction. Okay, rest of the things we have already done many times. You should be able to handle it. How to do the balance sheet? See the old balance sheet. See your journal entries. You should get the new balance sheet. That should be it. Done. Okay, old preferential capital notes. This calculation also we have done. 4,50,000. How we got? Consolidation. Let's get ourselves prepared. Okay, we'll see how many questions are there in consolidation. Okay, just so that we are mentally prepared when consolidation will get over. 1, 2, 3, 4, 5, 6, 7, 8, 9 only. Just 9. Everything has something different which can trouble you in exam. So obviously we are not going to skip anything. We start with Jan 2025 and go slowly and steady. You can take a small break for like 5 minutes. 5 minutes you can take a break. Okay, students, we'll go forward to consolidation. Okay. One more accounting standard completed. That means for tomorrow we will have only 25 accounting standards to go. Okay. That is why it became 25. 27 minus 1 is equal to 25. AS3 also will be completed today, so it will become 24 standards remaining for tomorrow. Okay, guys. Consolidation, very, very important. Some of you have traveled for consolidation only from Kerala. Okay, so let's focus on consolidation. Yes. Okay, guys. Shh. Full focus. We are going to take the break only when we finish consolidation. Okay. Now, AS21, consolidation of financial statements. Two things will be asked in this: consolidated balance sheet, consolidated P&L. One more type of question can appear. We will discuss that when we go further. In our 9 questions, it is covered. Don't worry. 9. Yeah, only 9 questions. You know that question. Yes. Who is going to prepare consolidated financial statement? Holding company. Subsidiary company does not know about this concept of consolidation and all. Subsidiary company will prepare their financial statement, take it and give it to holding company. Do whatever you want with this. Clear? Who is holding company? Any company that holds more than 50% of the shareholding in another company. This is called as subsidiary company. So one company controls the other company. This company becomes holding company. Clear? Therefore, CFS is equal to holding company financial statement plus subsidiary company financial. That's it. 2 financial statement you are going to add and write. That's all. That is consolidation. So easy it is. Clear? Okay. Now, imagine example. Some new characters. Okay. 2 companies are there. Kamya Limited and Vishal Limited. Kamya Limited with a beautiful hairstyle. Okay. Has 60% shares in Vishal Limited. Now Kamya Limited becomes holding company and Vishal Limited becomes subsidiary company. Now understand this. Why consolidation is the question that we are addressing. Why consolidation? Now this holding companies, holding company people, shareholders, they'll get the financial statement. No? Okay. In this, who is the shareholder? These are the shareholders of Kamya Limited who are sitting over here. Correct. They have invested in one more company called as Vishal Limited. So now here it is shown as investment and here it is shown as share capital. That means these people who put money over here, their money only was invested in one more company. So obviously they want to know how this money is also performing. What they invested in this company, that got invested again in one more company. So they want to know the result of this company as well. They're like, okay, sir, simple. You give one financial statement, you give one more financial, see both and decide. Imagine there are 200 subsidiaries like that. 200 subsidiaries. That time, you'll give 200 financial statement and tell, read it. When he finishes reading, it will be time for next tea biscuit. That is next AGM. Are you getting my point? So, you want to see everything at one place. Consolidated financial statement. Clear? Actually, I only don't know what this example was. So, let's ignore this. Some bakery 70% all, I don't remember only. Some doubt someone must have asked. Okay. Steps. We'll go to steps straight away. Steps to prepare consolidated balance sheet. First, we'll focus on consolidated balance sheet. Consolidated P&L, there are no steps at all. There are no steps at all in consolidated P&L. You're just going to add 2 and we are going to remove some small things. That's it. Okay. First step. First, we'll take one example. Okay, guys. Shh. This is our example question. With this, we are going to study all the steps. Okay. Balance sheet of S Limited as at 31st March 2024. We have equity and liabilities. Under that, you have shareholders fund, share capital 10 lakhs. Share capital 10 lakhs. Can you see 1 lakh shares of 10 each? Balance sheet is given on 31st of March 2024, but share capital is on 1/4/2023. That means starting of the year, share capital balance. General reserve, you have 2 things. General reserve and P&L. Sorry, reserves and surplus, you have 2 things. General reserve and P&L. Tell me one thing. This balance is on what day? 31st March 2024. Correct? H Limited acquired 60,000 shares in S Limited on 1/4/2023. Clear? At 30 rupees per share. When did they acquire? On 1/4/2023. At what rate? 30 rupees per share. Okay. On that day, the balance was 5 lakh and 3 lakhs. Clear? This is our example. From here we start. Step 1. Date of acquisition. Only 8 steps are there. Rapa will finish. Okay. Step 1. Date of acquisition. First, date of acquisition is what day? When your relationship started. What relationship we are talking about? Holding subsidiary relationship is formed. Clear? Now, date of acquisition is the date on which holding subsidiary relationship is formed. H Limited, S Limited. On 1/4/2020, I purchased 20%. Oh, sir, 1/4/2020 is the date of acquisition. No. Why? 1/4/2020, no holding subsidiary relationship. Then you purchase again 15%. Do you have holding subsidiary relationship? No, it has become only 35%. Then you purchased again 25%. So it becomes 20 plus 25 plus 15. That means now you have 60%. Now are you having holding subsidiary relationship? Yes. 1/4/2022 is the date of acquisition. 1/4/2022 is the date of acquisition. After that you purchased 10% again, no problem, but 1/4/2022 is the date of acquisition, the day when holding subsidiary relationship was formed. Next step is called as shareholding pattern. Now you know that is the date, right? You became the holding company. Now you want to know what is the shareholding pattern. On the date of consolidated balance sheet, when you're preparing consolidated balance sheet, how much you are holding in the subsidiary company, that is called as shareholding pattern. Clear? Today I'm going to prepare consolidated balance sheet. I need to know today how much is my shareholding. That is shareholding pattern. Now understand this. If I prepare consolidated balance sheet on 1/4/2020, there is no consolidated balance sheet only, because that day there is no holding subsidiary. When did the date of acquisition come into picture? 1/4/2022. Here I have 60%, correct? See, 31st of March 2021, no CFS. 31st of March 2022, no CFS. 31st of March 2023, CFS, because you are now a holding company. 31st of March 2024, also you will have CFS. Is this clear? So once you become holding company, when did you become holding company? On the date of acquisition. Now immediately you became holding company on 1/4/2022. Will you prepare consolidated balance sheet? No. You will prepare consolidated balance sheet at the year end. Clear? You became holding company here. Next time your year end is 31st of March 2023, you will prepare consolidated balance sheet. Clear? Yes. Now, shareholding pattern. 31st of March 2023. H Limited has 60%. You only told me. So if you are having 60%, you are having majority holding. Majority you have. If you have majority, somebody else has minority. They are called as minority interest 40%. Minority interest 40%. Clear? When you go to 31st of March 2024, your shareholding has increased to 70%. So minority interest is 30%. Minority interest is nothing but outsiders. And outsiders. Holding subsidiary other than us, somebody is there who is having little control, they are called as outsiders. Minority interest in consolidated balance sheet, you will show it between shareholders funds and non-current liability. Point number 1 will be shareholders funds. Point number 2 will be minority interest only in consolidation. In other chapters we are not going to write minority interest. Only in consolidation, point number 2 will be minority interest. Is this clear? Now, step 3, very small and important step it is. Okay. Step 3, I tell you, step 1 and step 2, nothing. No. Date is given in the question. See the percentage. Over. Finished. Step 3, if you get it wrong, you can go to next question. Step 3, if you get it wrong, you can actually go to next question, because step 3 decides everything else. How you analyze the profit, based on that all the future things are going to happen. 90% of future is dependent on step 3. Clear? Understand step 3 properly. Now, listen. Analysis of profits of subsidiary company. Simple. Okay. Profits of subsidiary company has to be analyzed. Has to be analyzed. Who is analyzing? Holding company, because subsidiary company is not even preparing consolidation. No, these steps are for whom? Who is preparing consolidated balance sheet? Who is preparing? Holding company. So analyzed by holding company and separated. Analyze and separate them into pre-acquisition profits and post-acquisition profits based on date of acquisition. Based on date of acquisition. On the date of acquisition, what was there? That is pre. After that, what came? That is post. Clear? On the date of acquisition, what was there? That is pre. When you are entering the house, already 5 dosas are kept over there. That is pre. Because it was already prepared before you came. But when you entered, you are there at the right time, at the right place. You will also eat it. You will also eat it. But for you, it is pre-acquisition profit. After you enter, you only made 2 more dosas. That is post. That was earned after you entered. Clear? This is the concept of pre and post. Why are we even dividing, sir? Pre also mine only, post also mine only. But pre, capital profit, post, revenue profit. Once upon a time, somewhere you have studied one chapter called as capital and revenue expenditure. Somewhere it was there. Okay. Now, steps to prepare consolidated balance sheet. Example problem we will take. Okay. See that same example problem. I think same thing. I have just pasted it over here again. That time what we wrote as example. First, now see, when am I preparing? Very important part. When am I preparing consolidated balance sheet? 31st of March 2024. I'm going to prepare consolidated balance sheet on 31st of March 2024. Okay. Now, listen. Shh. Analysis of profits. You have to understand properly. When are you preparing consolidated balance sheet? 31st of March 2024. Clear? 31st of March 2024, you are preparing consolidated balance sheet. On that day, how much was there? When are you going to analyze? That day or some other day? That day you are going to analyze. On that day, how much was there in general reserve? 8 lakhs. But when you acquired the shares, how much was there in general reserve? 5 lakhs. 8 lakhs. 5 lakh was there. That is pre. If 5 lakh was there at the starting of the year, then if it has grown and if it has become 8 lakhs, that means 3 lakh is post. That means 3 lakh is post. Is this clear? Are you following this? Okay. On that day when you are preparing, how much is there in P&L? 5 lakhs. 5 lakhs. When you acquired the share, how much was there in P&L? 3 lakh. 5 lakh is there. Starting there was 3 lakh. That is pre. From 3 lakh, if it has gone to 5 lakh, that means 2 lakh is post. Simple. That's it you are supposed to do. What happened, geeky? You are becoming geeky. Okay, now that is it. That's it. You are supposed to divide it into pre and post. Now, first we'll go slowly. We will go little further in step 3. What and all can happen? What if? Okay, H Limited acquired shares on 1/7. In the first base question, when did they acquire share? On 1/4. That means what if you acquire the share in the middle of the year? On 1/7 if you acquire the shares. General reserve is 8 lakh. Clear? Starting of the year, sir. 1/7 you acquired share, no? I want to know the general reserve balance also on 1/7 only. Not possible. Not possible because they had prepared the balance sheet at the end of the year. Just because I went and purchased shares, I cannot tell them to do finalization of accounts on that day. Again, clear? I know only at the starting of the year. Starting of the year it was 5 lakhs. If starting of the year it is 5 lakhs and ending of the year if it is 8 lakh, that means it has grown and become 8 lakhs. That means how much is earned during the year? 3 lakhs. But whatever is earned during the year 3 lakhs, it is not post for me. Why it is not post for me? Because I was not there at the starting of the year. I came on 1/7 only. So 3 months pre, 9 months post. Is this clear? Same thing for P&L. How much is there at the end of the year? 5 lakhs. What was there at the starting of the year? 3 lakhs. If it was 3 lakh at the starting and it became 5 lakhs, that means 2 lakhs is earned during the year. But during the year, I became the shareholder only on 1/7, April, May, June. I was not the shareholder. That is pre. After that, everything is post. Is this clear? Did you understand what will happen if shares are acquired during the year? Clear? Now, what if? S Limited on 1/9/2023. 1/9. Every time we see a what if question, we go back to the original question only. Issued bonus shares in the ratio of 1:4. 1:4. If bonus shares are issued, We saw no. First we will utilize CRR. In this question, no CRR only. Second, we will utilize securities premium. No securities premium. Then we will utilize general reserve. Then we will utilize P&L. What is my share capital? 1 lakh shares. 1 lakh into 1 by 4. That means I am going to issue 25,000 shares into 10 rupees. That means I require 2,50,000. I require 2,50,000 for bonus. Now listen. When did we issue the bonus? On 1/9/2023. We are issuing bonus on 1/9/2023. Now understand this. What is the general reserve balance? 8 lakhs. Starting, how much was there? 5 lakhs. How much bonus I am going to issue? 2,50,000. Now, when I am on 1/9, now see, this is starting, this is ending, correct? Somewhere during the year, I am giving bonus. When I am giving bonus, what will I do? I will take the opening balance, whatever is there, and I'll utilize it. When I take, the opening balance came down to 2,50,000. When did it come down to 2,50,000? During the year. During the year, I removed bonus and it has reached 2,50,000. After that also, end of the year, it has reached 8 lakhs. That means 5,50,000 is earned during the year. That is post. Is this clear? So simple. If you are having bonus, remove it from pre. Then you calculate what is earned during the year. Now, did it have any impact on my P&L? No. P&L will be 5 lakh, starting 3 lakh, and during the year 2 lakh. Pre-post. Clear? If the general reserve was not enough, what I would do? I would take the amount from P&L. Now, what if S Limited issued a bonus at the ratio of 3:4? How much was my share capital? 1 lakh shares. Correct? 3 by 4 means 75,000 shares into 10 rupees. That means 7,50,000 bonus. 7,50,000 I need for bonus, but I have only 5 lakh here. I will utilize 5 lakh. Okay, remaining 2,50,000, what I'll do? I'll go and take it from P&L. That time P&L will still have 50,000 remaining. This is pre, but closing balance is 5 lakh. That means everything else is post. Everything else becomes post. Here, 5 lakh minus 5 lakh, this is 0. From 0, it has gone and become 8 lakhs at the end of the year. That means 8 lakh is post. Is this clear? Are you following this? Sir, what if this general reserve and P&L both are not enough for bonus? That is not going to happen only. That is not possible only. That amount is not enough for bonus is not possible. Why? Bonus is what? You saw profit there. You saw the profit. Then you decided what to do with it. You saw profit. Then you decided, okay, I can give bonus. I can give dividend. That is the thought that came to your mind. So after seeing the profit, you're deciding what to do with the profit. So there is no chance that after you see the profit, the amount is not sufficient at all. Is it not? It is not possible only. You saw the profit, you give little as bonus, you give little as dividend, you keep little here only. Clear? But if it is not enough in general reserve, then you will take it from P&L. Is this clear? Yes. What if S Limited declared dividend at the rate of 20%? Dividend, usually we don't take from general reserve first, we take from P&L. See, general reserve, 8 lakh was there. Starting of the year, it is 5 lakh. During the year, we made 3 lakhs. Pre-post, done, finished. Pre-post is done. Now, 5 lakhs. What was my share capital? 10 lakhs. Share capital is 10 lakhs. How much is the rate of dividend we spoke about? 20%. 10 lakh into 20%, that means I require 2 lakh for dividend. If I give 2 lakh dividend, what is remaining in my P&L? 1 lakh. During the year, I removed dividend, still 1 lakh is remaining. But end of the year, my balance is not 1 lakh, it is 5 lakh. Straight from 1 lakh, it has become 5 lakh. That means 4 lakh is post. Is this clear? Any doubt with this? Okay. What if it was not enough here? I will use general reserve. Remember dividend declaration rules. If amount is not sufficient, you can take from reserves as well. Okay, some conditions are there, but anyways, you can take it. What if S Limited declared dividend at the rate of 40%? 10 lakh share capital. If you declare dividend at 40%, that means you require how much? 4 lakhs. You require 4 lakhs. Now, if you see P&L, starting P&L had only 3 lakhs. Not enough. Do I require little more for dividend? What will I do? Go and take it from general reserve. Now, general reserve has come down to 4. 4 became 8. That means 4 lakh is post. 0 became 5. That means 5 lakh is post. Do you understand how to analyze? Are you getting it how to analyze? Okay, bonus, take from pre, something remains, balancing figure post. Dividend, take from pre, something remains, balancing figure is post. Bonus, amount is not sufficient, you take from P&L. Pre only, pre, you cannot take from post. Only when interim dividend comes, it is from post. Otherwise, everything is pre only. Last year's dividend you are giving this year, no? Last year's dividend, last year got over, year got over. Now in the AGM, you are giving the dividend, no? So you are going to take from pre only. But understand this, okay? General reserve is not enough for bonus, then you will take the money from P&L. P&L is not enough for dividend, then you will take the money from general reserve. Is this clear? Yes. Now, what if H Limited acquired shares in S Limited on 1/7/2023 and S Limited issued bonus shares in the ratio of 1:4 on 1/9/2023 and declared dividend at the rate of 22% on 30/9/2023. Everything what we saw till now is happening at once. That means shares are shares are acquired during the year, bonus is happening, and then also dividend is happening. When are you acquiring shares? 1/7. When is the bonus? 1/9. When is the dividend? 39. Is this clear? Okay. Now general reserve, 8 lakhs. Do you remember general reserve as 8 lakhs? Starting of the year it was 5 lakhs. Now tell me, bonus is what? 1:4. So 10 lakh into 1/4 is basically 2,50,000. Therefore, you remove 2,50,000 from general reserve. Okay. Then dividend rate is 22%. How much is share capital? 10 lakh into 22% is equal to 2,20,000 you need for dividend. Remove 2,20,000 from your P&L. Now you are like, sir, wait, sir. We gave bonus when, sir? 1/9. We are giving dividend when, sir? 39. So, bonus when we gave, no, 2,50,000 shares were bonus. Already we had 10 lakh share capital. So now, when you are giving dividend, you should give on 12,50,000. No. No. We are giving dividend for last year. Bonus came this year. Investment account revision. We are giving dividend for last year. Bonus came just now, this year. Last year and there was no bonus. Last year and share capital was 10 lakh. On this only we are supposed to give dividend. Are you getting this? Okay. Now, after removing the bonus, we still have 2,50,000. This is pre anyways. This 2,50,000 has become 8 lakhs. That means 5,50,000 is not post. 5,50,000 is during the year. During the year, when did I arrive? In July, right? I arrived in July. 3 months pre, 9 months post. 3 months pre, 9 months post. Is this clear? Now, P&L 5 lakh. I removed dividend, right? How much is remaining? 80,000. How much is remaining? 80,000. Now, 80,000 if it is remaining, 4,20,000 is earned during the year. From 80,000 if it has to go to 5 lakhs, 4,20,000 is earned during the year. But during the year, April, May, June, I was not there. So again, 3 months pre, 9 months post. Are you getting this? Okay. When you're practicing at home, all these what if questions, guys, online guys, offline guys, all these what if questions, if you solve, okay, all the cases are covered. Whatever can be asked in the exam question, everything is covered. Bonus, dividend, revaluation, everything we are covering here. Now, next, what if on the date of acquisition, very important point, revaluation. What if on the date of acquisition, plant and machinery was revalued 2 lakh upwards for the purpose of fixing the price per share? Today only, we finish amalgamation. Today only we finish amalgamation. PC, to calculate PC, what did I do? I will take asset minus liability. Assets will be taken at what value? Agreed value. Agreed value is something higher or lower? Correct. So asset got revalued, but did you pass the revaluation entry in the books? No. You just changed the value to find the price, correct price. You found the correct price. Then you paid that price. Now the books are getting consolidated. Don't you think your shareholder will ask, what did you pay for? These assets. But these assets are not showing the price that you paid. These assets are not showing the price that you paid. These assets are showing lower value. So that time the revaluation was done just to fix the price. Now you are going to give that effect in the books. When you are consolidating, see over here. Holding company books, subsidiary company books. Subsidiary company books are at original value only. But we change the value to find the purchase consideration. Now, if they are separate, no problem. But if they are going to be in one balance sheet, that time my shareholder will ask, no, you told you are paying for plant and machinery of 7 lakhs, but plant and machinery is showing 5 lakhs over here. That means the revaluation which is done upwards or downwards, that has to be given effect. So revaluation information will be given in the question. So revalue 2 lakh upwards. If you do revaluation, no, you'll either get profit or loss. Simple. The profit or loss which you're getting, no, it's always pre. It's always pre. When are you doing the revaluation? On the date of acquisition. Revaluation in consolidation is always done on the date of acquisition, because revaluation is done for fixing the price only. It is done on the date of acquisition. Today I am entering and land value has increased. Today it did not increase, no. It has increased before. I am giving the effect today. Are you getting my point? Today if I come to Chennai and I tell, oh, value has gone from 10 lakh to 1 crore. Did it go from 10 lakh to 1 crore today? No, it went before. I am just seeing it today. Clear? So revaluation profit or loss will always be pre. See, general reserve, no impact. If you do revaluation, no impact on general reserve. Okay. Before P&L, between general reserve and P&L analysis, you have to bring in revaluation. Here revaluation was upwards or downwards? Upwards. So 2 lakh is profit, which is pre. 2 lakh is profit, which is pre. Clear? Now P&L was 5 lakhs. So 3 lakh is pre. 2 lakh is post. This we know from starting. 5 lakh P&L. 3 lakh was already there on 1/4. That means 2 lakh is post. If I increase the asset value, then depreciation also will increase. Depreciation will reduce your profit. Sir, injustice. Everything till now, sir, from pre we removed. This one we are removing from post. First doubt I have. Why? Asset got revalued on the date of acquisition. That is pre-acquisition profit. Why? Today I change the value, but the value has changed before this. But if I change the value today, depreciation will start from tomorrow. That means depreciation will be in the post-acquisition period only. Are you getting this? You change the asset value today, but the asset value increased before today. So I gave the effect today, but depreciation will be from tomorrow. So depreciation will be removed from post-acquisition period. Now when you remove depreciation, 1,80,000 post. Sir, one more doubt I have, sir. Always no. This pre and post, when I used to add, no, I used to get the total. But here I am not getting. Why? Here also see, sir, general reserve and all I subtracted, no. I removed bonus issue. Still 250 plus 137,500 plus 412,500 if I do, no, I'll get 8 lakhs. I removed dividend, but 80,000 plus 1,05,000 plus 3,50,000 if I do, I'll get 5 lakh. It is matching. Pre-post total will be matching to the total. But here it's not matching, sir. Why? This is your adjustment. Remember in final account, some things are there in the trial balance. Some things are there in additional information. If something is there in additional information, that means you are passing the entry now. Revaluation entry you are passing now. So when you are doing the revaluation entry now, see, this revaluation, was it there in the balance sheet which you saw reserves and surplus? It was not there, no? You gave this entry now, no? You passed the journal entry now and brought it now. So now depreciation entry also you have to pass now. So the profit will reduce. The overall profit only will reduce because one entry was missing. Now, simple. From examination point of view, revaluation upwards means extra depreciation. Extra depreciation means profit will go down. Profit will go down. Okay. Now see the next one. Revaluation downwards by 1,50,000. General reserve no change. It will remain like that only. Revaluation downwards means profit or loss. Loss. Can you see that is also pre? That is also pre. It cannot be post. That is also pre. Now, if asset value goes down, that means depreciation also will go down. If depreciation goes down, profit will go up. Can you see 15,000 is added to the profit here? Clear? Are you getting this? Asset value went down. Depreciation also should go down. Depreciation, if it goes down, depreciation is an expense. That time profit will increase. Clear? Simple. Just remember from examination perspective, asset decreases, depreciation asset decreases, depreciation also decreases, profit increases. Asset increases, depreciation increases, profit decreases. Is this clear? Yes. What if? Oh, plant and machinery revalued upwards and land and building revalued downwards. That means upwards, downwards, both are there. So on this 1 lakh, what I will do? Extra depreciation. 1 lakh into 10% extra depreciation. So here, can you see what's happening? 10,000 minus. Here, revaluation downwards. So 80,000 into 5%. Depreciation not required. Depreciation not required. What will you do? You will add it back. You will get 1,94,000 post. Is this clear? You will get 1,94,000 post. Any doubts with this till now? Okay. What if? Okay, what if? X Limited acquired shares in S Limited on 1/8. That means during the year. Okay. On which date plant and machinery was revalued from 5 lakh to 6 lakhs and land and building was revalued from 2 lakh to 1.5 lakh. Okay. Revaluation also we did. Very good. And on 1/9 issued bonus shares in the ratio of 1:5. Oh, that also complete. On 1/10 S Limited declared dividend at the rate of 32%. Nothing is left. Nothing is left. With this, we are done with step 3. I mean, when we finish this. Now we just read the question. Okay, we'll be done with step 3. Now, understand this. First only I will analyze. When did I acquire shares? 1/8. That means 4 months will be pre, 8 months will be post. April, May, June, July. 4 months will be pre and 8 months will be post. Okay. Asset value has gone up, asset value has gone down also. First we will be analyzing general reserve, 8 lakhs. General reserve 8 lakh, 5 lakh was there. Did we issue bonus in this question? Yes, bonus in the ratio 1:5. So 10 lakh into 1/5. Our bonus will be 2 lakh. So 2 lakh, when I do 2 lakh, I removed. Enough was there in general reserve only. I don't have to worry. I think dividend was at the rate of 32%. 32%. So now I will remove 32%. I will remove 3 lakh from here. It became 0. The extra 20,000 is there. No, I will remove it from general reserve. Now my general reserve has reached 280. From 280, if it has to go to 5 lakhs, 520 is earned during the year. But what is earned during the year? Everything is not mine. Okay, I came after 4 months. 4 months pre, 8 months post. Is this clear? 4 months pre, 8 months post. Next. Listen. Revaluation. What did we do? One asset revalued upwards, another asset revalued downwards. Net we have a profit. Clear? Now P&L. Pre became fully 0, no, starting of the year. But from 0, if I have to go to 5 lakhs, that means 5 lakh is earned during the year. Out of that, 4 months is pre, 8 months is post. But revaluation is there. So asset value went up. So extra depreciation. But don't forget 8/12. Don't forget 8/12. Why? Asset is revalued on what day? Not at the starting of the year, on the date of acquisition. When is the date of acquisition? 1/8. 1/8 if you do the revaluation, when will the depreciation happen? From next day. After 1/8, how many months are remaining in this year? 8 months. Depreciation only for 8 months. Either it is minus or it is plus. It will be only for 8 months. Is this clear? Yes, that is your step 3, guys. Done. Step 3 done. Okay, you have to go and practice. Everything is covered in step 3. Just see all those steps. You will be done. Step 4, apportionment. Nothing. Step 3 you did no. Put it into a table. Step 3 you did. You put it into a table. Profits analyzed in step 3 must be apportioned between holding company and minority interest based on shareholding pattern which we saw in step 2. Are you getting my point? In step 3, what I did, okay, whatever profit is given to me, okay, give. Pre-post. I went on analyzing it, correct? Now this pre-post, whatever is there, I will put it into a table. I'm like, okay, this belongs to me, not fully, little to minority interest. Clear? Now, can you see? I picked these numbers from the last example only. What do? I make one column called as capital profit, one column called as revenue reserve, and one column called as revenue profit. Clear? General reserve, we had all these numbers. I picked from the analysis only what we did. Now I just total it. Everything I total. 60% to holding company, 40% to minority interest. That's it. 60% to holding company and 40% to minority interest. Is this clear? Apportionment will go wrong if analysis is wrong. There if you miss a number, you're getting wrong number, you'll get wrong total, wrong apportionment. And this will get carried forward also. Is this clear? Yes. Now step 5. Minority interest. Outsider. Now what and all we have to give to minority interest? I have to give him his share of equity share capital. I have to give him his share of preference share capital, if it is there. I have to give him his capital profit share from here. Capital profit share. I have to give him his revenue reserve share. I have to give him his revenue profit share. Basically, I have to give him all reserves and surplus, and I have to give him the share capital share. Clear? Next, if bonus is issued, I have to give them bonus shares. Then minus unrealized profit upstream. What is this unrealized profit upstream? We will discuss it now itself. Okay. Somewhere later I would have written that. Unrealized profit upstream. Okay. I think examples directly we will discuss. See, holding company has unrealized profit means, understand this sentence, unrealized profit means either holding company has sold to subsidiary company or subsidiary company has sold to holding company. One of this should happen, and that much if it happens, nothing. And receiving company still has these goods in inventory. Did we see the same thing in amalgamation? One company transfers to another company and whoever got it, they are still keeping it in closing stock. Same thing is happening over here also. Unrealized profit downstream means what? Holding company sold to subsidiary company. Holding company to subsidiary company. This is called as downstream. If it is downstream, profits. Okay, one thing I'll tell you. If it is downstream, who made profit? Holding company made profit. Just subtract it from profit of holding company. Profit of holding company is in step 8. Remove from their profit and then minus from inventory. Minus from inventory. Clear? Stock reserve should be subtracted from inventory. If it is upstream, upstream means what? Who sold to whom? Subsidiary company sold to holding company. So who made the profit? Subsidiary company made the profit. Whatever profit subsidiary company made, understand this, whatever profit subsidiary company made, it is already analyzed and distributed to holding company and minority interest. So remove from holding company also and remove from minority interest also. Then obviously you are going to remove from inventory. Clear? Imagine again, holding company sold to subsidiary company. Who made profit? Holding company made profit. So remove it from holding company's profit and remove it from the inventory. Inventory in consolidated balance sheet. Okay. Subsidiary company sold to holding company. Who made profit? Subsidiary company. Subsidiary company's profit belongs to whom? Holding company and minority interest. Remove from both the places and then obviously you have to subtract from inventory as well. Is this clear? Imagine, wait, unrealized profit is 100. Unrealized profit is 100. Now tell me one thing. What will happen if it is upstream? Sorry, if it is downstream. Who made this 100 rupees profit? Holding company. There is no selling company. We have come out of amalgamation long back. Okay. Holding company made the profit. Holding company we will remove 100. We will remove 100. And from inventory we will remove 100. Double entry system of accounting. Can you see? Okay. Now, if at all the unrealized profit is 100. Clear? 60% we have already given to holding company. So remove 60. 40% we have given to minority interest. So remove 40 and 100 you remove from inventory. Can you see same effect is happening? Is this clear? Yes. That is why in step 5 you saw something like where is that? Yeah. Minus unrealized profit upstream. If it is upstream only it will come here. If it is downstream it will not come here only. What happened? You're feeling hot? Huh? Anaga, are you feeling hot? Then cold. What are you talking? Where is the air? Huh? Still sweating. It's so nice. Let's continue. We'll think about it after we finish steps. Before we start problems, we'll change the temperature. No need. I want it like this. It's nice. I kept only in 20. 20 is good, no? Okay, now see minority interest. What did we do? Equity share capital, capital profit, revenue reserve, revenue profit. What is all this from? Where I'm getting these numbers? In step 4, already I distributed and kept this for you, this for you. Clear? Now, bonus shares also you have to give them. This is your minority interest step. Clear? Again, I'm telling you, what and all you should give to minority interest. Equity share, capital share, preference share, capital share, capital profit share, revenue reserve share, revenue profit share, bonus if it is there, give that share also. Then remove. What will you remove? Unrealized profit if it is upstream. Clear? No. Let's go further. Step 6, cost of control. Very, very important step here. See, amalgamation only. Amalgamation only. What we should do over there? Purchase consideration is more than net assets, sir. Goodwill. Purchase consideration is less than net assets, sir. Capital reserve. Clear? Here, cost of investment is what? Nothing but purchase consideration only. Minus pre-acquisition dividend. What on earth is this, sir? Pre-acquisition dividend. Today I purchased the shares. Okay. Tomorrow they gave me dividend. This is pre-acquisition or post-acquisition? Correct. Pre. Just because I made the action, it doesn't become post. It is pre. Today I acquired shares. They are giving me dividend tomorrow, but they are giving me dividend for the previous year. It is pre. Is this clear? Now, see over here. First, we will address that issue. Dividend received from subsidiary company. Dividend received from subsidiary company. Who is receiving? Holding company. Who is receiving? Holding company. Pre-acquisition dividend means what? Dividend received in current year, but related to previous year when we were not the shareholder. Sir, you put wrong number here. AS13. No, this is AS13. This is AS there in AS21 because AS13 is there. AS13 has told how to account for pre-acquisition dividend. Pre-acquisition dividend is something not related to you. It is like basically like I always call this as cash back. Cash back. What is cash back? Imagine you're doing some payment. Okay. Two people were there. Kid. Darshan. Okay. I didn't tell anything. You guys only told. Okay. You are height shaming people. Okay. Now, kid is there and Darshan is there. Now, kid sent 100 rupees to Darshan on Google Pay. On Google Pay. How much got debited to kid's account? 100 rupees. As soon as he paid, he got one card. Scratch card. When he scratched that card, usually nothing will be there, but that day he was very lucky. It is showing 20 rupees cash back. Immediately 20 rupees came credited to his account. Now, how much went from kid's pocket? Net only 80, no? So, pre-acquisition dividend is just like that. Actually, dividend means what? I should invest money. That money should be used for business. Then they should earn money from that. Then they should give me returns. That is dividend. I invested money this year. They are distributing dividend for last year. That means this is pre-acquisition dividend for me. Where are you going? Where are you going? This is pre-acquisition dividend for me. Correct? Okay. Now you are like, sir, wait. You invested in the shares this year. No. Why is the company giving you dividend? They should go and give the shareholder of last year only. It is not possible. Morning someone is buying the share. Evening they are selling the share. If company has to keep track of all this, they'll go mad. Are you getting my point? Imagine if you are actually trading in stock market, right? Company is going to give dividend. You just got some news. Company is going to give dividend. You bought the shares. You will also get dividend. After company gave you dividend, sell the shares. Okay. Stock market is more smarter than this. It will do some auto correction and all. That we will not discuss now. Okay. But this is how it works. So company, on the day they are giving, you are there, you will also get it. Okay. Did you understand? What is pre-acquisition dividend? Again, one more example. You went to one function. Kid is organizing one function. Kid is organizing one function. Okay. What happened? Huh? Kid, no. Okay. Kid is organizing one function. You went to that function. Okay. Anaga, you will relate to it. It happens more in our hometown. Okay. You go to the function. In the function, no. Function is happening. There is too much crowd. Everybody is standing outside and they are talking and all that. Then it's time for food. It's time for food. So you will have the steel tables. When there is food, you are standing here like this. People are arranging for food. They opened those steel tables right in front of you. All that you had to do was sit and start eating. Are you getting my point? Now, this is pre-acquisition dividend. You are just there at the right time, at the right place, got the dividend, ate it. Clear? This is pre-acquisition dividend. What is post-acquisition dividend? You went previous day to kid's house. You only cut the vegetables, worked hard. Next day when the food is made, you are eating it. That is post-acquisition dividend. Is this clear? Are you following this? Yes. Now, tell me one thing again. Pre-acquisition dividend means dividend received in the current year related to previous year, okay, when we were not even the shareholder. What is post-acquisition dividend? Dividend received in current year related to current year only. I purchase shares at the starting of the year. If they give dividend at the end of the year, that is called as post-acquisition dividend. Pre-acquisition dividend is a capital receipt. Capital receipt. It is not recurring in nature. It is capital receipt. That's why what happens, okay, even the timeline if you want to see. Date of acquisition is 1/4/2023. Okay, subsidiary company declared dividend for 22-23. When did I purchase? 1/4/2023. That means I am there in the year 23-24. But they are giving dividend for the year 22-23. This is called as pre-acquisition dividend. Clear? Now, pre-acquisition dividend should be subtracted from cost of investment. How you told? Kita gave 100 rupees, got 20 rupees cash back. He subtracted and told 80 rupees. No. Same way, it should subtract the cost of the investment. I paid money and purchased the shares. Immediately, I got some dividend. Good. My cost, what I have spent on that investment went down. Post-acquisition dividend. Add to P&L of holding company. You got the money, add it to the P&L. Now, if I have to ask you entries, pre-acquisition dividend, what should be the entry? Bank account debited to investment account, because you have to reduce the cost of the investment. Post-acquisition dividend, what should be the entry? Bank account debited to dividend income, and dividend income will automatically go to P&L as other income. Is this clear? Now, go back to step 6. Cost of control. Very important step, cost of control. You paid something that is called as cost of investment. Clear? Minus pre-acquisition dividend. Minus pre-acquisition dividend. That time you will get net cost of investment. How much you spend? Net. Clear? Now, share of net assets. Sir, what is this, sir? Net assets. That time you were telling asset minus liability. Here you are telling equity share capital plus capital profit. Same thing. If you have a balance sheet, asset, liability, capital. Either you can do asset minus liability or you can directly take the capital. Clear? Equity share capital plus capital profit. Capital profit is one time, no, it will not come again and again. And you will add the bonus shares. This is what you are getting. This is what you have spent and this is what you are getting. You got a share in the capital profit. You got some capital profit. Luckily you were there at the right time and you got some bonus shares. This is your amount that you are receiving or the benefit that you are receiving. If you paid more, that is called as, if you paid more, it is called as goodwill. A is greater than B, goodwill, intangible asset. If you paid less, then it is capital reserve. It will go to reserves and surplus. Is this clear? This is one more very important step which will impact your consolidated balance sheet. If you paid more, goodwill. If you paid less, capital reserve. If you paid more, it's a loss for you. Why are you paying? For the reputation of that person, goodwill. If you paid less, be very happy. It's a profit. Don't put to P&L because this profit won't happen every time. Okay, it will go to capital reserve. Is this clear? Now, dividend received we have already discussed. Now you can see cost of investment. Okay, minus pre-acquisition dividend. You will get this value. Equity share capital. Don't take full equity share capital. Only your share 60%. Capital profit already from step 4 we are taking the number. We have divided and kept over there. Bonus shares also we have calculated. Clear? If you paid 16 lakh 8 but it's only 11 lakh 22 you are getting. So 4 lakh 86,000 is goodwill. Cancellation of intercompany owings shouldn't be a problem at all. Cancellation of intercompany owings. What is there? Debtor, creditor. Cancel. Bills receivable, bills payable. Cancel. Loan given, loan advanced. Cancel. Unrealized profit. Cancel. Unrealized profit we already discussed. Okay. When will you call it as unrealized profit? holding company sold to subsidiary companies or subsidiary company sold to holding company. Is that it? And it is still in the inventory. How much is in the inventory? That much portion is called as unrealized profit. If holding company sold to subsidiary company, it is called as downstream. Who made profit? Holding company minus from profit. Then minus from stock. If subsidiary company sold to holding company, who made profit? Holding company and minority interest, remove from both the places. Then remove from stock. Is this clear? Yes. Step 8, final step. We don't have any more steps. Final step. Reserves and surplus in consolidated balance sheet. See, 90% of the amounts in consolidated balance sheet will be there. No, it is just one plus another. That's all. One plus another. Okay. Main thing is reserves and surplus. Now, tell me one thing. When you're doing consolidation, don't you think holding company has their own reserves and surplus? Yes, that is your starting point. Holding company has their own reserves and surplus. Now you add what came from subsidiary. Revenue reserve, revenue profit. Sir, what about capital profit, sir? It already got adjusted in step 6. It already got adjusted in step 6. Only revenue reserve, revenue profit. Clear? Now, minus pre-acquisition dividend if wrongly credited to P&L. Pre-acquisition dividend should be going where? It should reduce the investment, right? By mistake, if I have put it into P&L, remove from P&L and show it there. If they have correctly accounted, don't do anything. Correctly accounted means don't do anything. They have removed from investment. Okay. Now, unrealized profit. Remember, I told you have to subtract the unrealized profit. And if there is capital reserve which got created in step 6. How can we get capital reserve in step 6? You paid less or you paid more? You paid less. That is capital reserve. Add it over here. That is end of the reserves and surplus. This total will be shown as reserves and surplus in the balance sheet. Clear? Consolidated P&L. Quickly we'll discuss consolidated P&L. Trust me, nothing is there. Nothing is there in consolidated P&L. Holding company P&L plus subsidiary company P&L plus or minus intercompany transactions. Plus or minus intercompany transactions. What are these intercompany transactions? Holding company sold to subsidiary company. Holding company sold to subsidiary company. Holding company will show it as sales. Remove it. Subsidiary company will show it as purchase. Remove it. It's intercompany now. I cannot show it as sale and purchase. Am I selling to myself? No. Fees paid by holding company to subsidiary company. Holding company will show it as, subsidiary company will show it as income. Remove it. And holding company will show it as expense. Remove it. That's it. That is the consolidated P&L. Clear? Now, P&L format. We will not discuss the P&L format again when we go to financial statement. We'll discuss it here itself. P&L format. First we have income. Under that you have revenue from operations. You know what will come in revenue from operations? Your direct incomes. Okay. Sales basically, and direct incomes. Indirect things will go into other income. Then we go into expenses. First you have cost of material consumed. This is opening stock plus purchases. This is cost of material consumed. If direct expenses are there, also you will add it over there. Next, purchase of stock in trade. Purchase of stock in trade. What is this? Purchase of finished goods. If you are doing trading, you will not have anything consumed. If you are doing trading, you won't have any material consumed. You are buying, selling. That time purchase only. Changes in inventory. Which inventory changes? WIP and finished goods. Because raw material is already covered over here. Now, if you are doing manufacture, will this be there? Will this be there? No. You will not have purchase of stock in trade. But will this changes in inventory be there? Changes in inventory, yes, because finished goods will be there. Finished goods will be there. WIP also will be there. But if I am doing manufacturing and trading, will this be there? Yes. Will this be there? Yes. Will this also be there? Yes. If I am doing only trading, will this be there? No. Will this be there? Yes. Will this be there? Changes in inventory? Yes. Changes in inventory will always be there as long as you have opening stock, closing stock of finished goods or WIP. Now, employee benefit expense, salary, wages, whatever it is. Finance cost, interest that you are paying on debentures and all. Depreciation, amortization, you know this. Other expenses, etc. All the other things you dump it over there. Okay. Profit before tax. Now, explanation notes you understand. Revenue from operations. revenue from operations. This actually, I'm covering even financial statement here only. I'm not discussing the P&L in financial statement. Revenue from operations. If you're doing furniture business, then sale of furniture is revenue from operation. But profit on sale of computer is other income. Interest received on investment, other income. Dividend received is other income. If you are doing investment business only, then this dividend received would have been revenue from operation. If you are doing computer business, sale of computer would be revenue from operation. Is this clear? Now, cost of material consumed, opening stock of raw material plus purchase of raw material minus closing stock of raw material. Now, purchase of stock in trade is purchase of finished goods only. Changes in inventory is opening stock minus closing stock. Opening stock of WIP and finished goods, closing stock of WIP and finished goods. Is this clear? Next, that's it. Done. That is it with the consolidation steps. Next is actually preparation of financial statement, which I don't want to discuss now. Okay, all these steps we have to discuss. Only 9 problems are there which we have to discuss. Okay. What AC? When did I tell? Let's go into problems. Yes. Shh. Question number 1, CA enter Jan 2025. Question number 1, CA enter Jan 2025. We'll start with that order only and go backwards. Okay. Summarize balance sheet of Super Limited and Clear Limited. 2 companies are there, Super Limited and Clear Limited. You can see share capital reserves and surplus, long-term borrowing, short-term borrowing, trade payable. Then property, plant and equipment, current and non-current investment, inventories, trade receivable, cash and cash equivalent. All these things are there, regular balance sheet only. Notes to accounts, you can see one company has shares of 80 lakhs, other company has shares of 15 lakhs. One company also has preference shares. We don't know which company is what here. We only know 2 companies are there, Super Limited and Clear Limited. General reserve, P&L. Long-term borrowings, you have debentures. One is 10%, one is 9%. No problem. PP and investment in Clear Limited. So we know clearly that who is the holding company here? Super Limited is the holding company. Clear Limited is the subsidiary company. Clear? Okay. Now, additional information. Super Limited holds 75% of equity shares. Already shareholding pattern is done. 75%. In Clear Limited, since the incorporation of Clear Limited, that means in this question there cannot be pre-acquisition. Everything is post-acquisition. Do you remember Virat? Do you remember Anushka? Yes. Virat Limited holds some percentage since the incorporation of the company. Clear? So 75% since the incorporation of Clear Limited. Can you see? Just copy paste directly from study material in the exam, the adjustment. Okay. Now 75%. So you have to remember, since its incorporation means pre. No pre, sorry. Everything is post. Opposite to this question is also there. You know what they tell? Balance sheet date in this question is what? 31st March. No. If they tell you that Super Limited acquired shares in Clear Limited on 31st March. That means on the last day of the year you have acquired the shares. That means everything is pre. There is no post. 2 things. If the shares were acquired on the date of incorporation, everything is post, no pre. If the shares are acquired on the balance sheet date, that means last day of the year, everything is pre, no post. Post will happen next year, but this year nothing. Clear? Now, 25% of trade receivable of Super Limited is due from Clear Limited. This is what? Intercompany owings. 25% is due from Clear Limited, they said. During the year, Super Limited sold inventory costing 2 lakh to Clear Limited. Who is Super Limited? Huh? Holding company. Super Limited sold to Clear Limited. This is called as upstream or downstream. Downstream. This is called as downstream. The goods costing 2 lakh to Clear at a price of 15% above cost. That means 2 lakh into 15% is equal to 30,000. Not unrealized profit. They should tell that it is there in inventory. The entire inventory remains unsold. Now it is unrealized profit. Okay, unrealized profit. We will subtract from whom? Holding company. And in the balance sheet minus from inventory. Clear? Only that adjustment you are required to prepare consolidated balance sheet of Super Limited and Clear Limited. That's it. That is it. Now, I'm showing you the balance sheet. Share capital should be only holding company. Who is preparing consolidated balance sheet? Holding company. For whom? Their shareholders. What is the share capital? 80 lakhs. You can see the what? Oh, wait. Sorry, preference I missed. Preference is there. Sorry, 95 lakhs. I'm like, what has happened suddenly? 95 lakhs. Clear? Now the entire challenge is reserves and surplus. So we'll focus on reserves and surplus only. Now tell me one thing. How much is the profit over here? 50 lakhs. Correct? Sorry. How much is the profit over here? 6 lakh 50 and 5 lakh 75,000. 12 lakh 25,000. 12 lakh 25,000. Tell me one thing. Can there be anything pre? No, since incorporation, right? 12 lakh 25,000 into how much we are holding? 75%. 12 lakh 25,000 into 75% is 9 lakh 18,750. This is your post. This is for holding company Super Limited. Then 12 lakh 25,000 into 25%. 3 lakh. This is minority interest. This will get added to minority interest. Profit we have just divided, analyzed and apportioned here itself. Clear? There is no bonus, there is no dividend, there is no revaluation, nothing, straight away. Okay. Now, tell me one thing. Do I have my own reserves and surplus? Should I add whatever I got from there? Yes. But so many things are there. Unrealized profit is there. And what is the other thing? We have to see whether there is goodwill or capital reserve also. Now, understand this. Okay, understand this. My profit was what? Where did it go? Yes. Now, couple of things we have to always calculate. Okay, rest of the things we can avoid. Okay, now understand this. What is the share capital? Share capital in the question. Whose share capital we are worried about? Clear Limited. Clear Limited share capital is 50 lakhs. So 50 lakhs into 25% will be 12 lakh 50,000, which will go to minority interest. And what is the share of profit? 3 lakh 6,250. So 3 lakh 6,250 will also go to minority interest. That makes it 15 lakh 56,250. 15 lakh 56,250. So you should have minority interest of 15 lakh 56,250. Clear? There is no bonus, there is no unrealized profit, nothing. Now, what about holding company? Holding company, what is their reserves and surplus? Holding company reserves and surplus. 1 lakh 20. No, holding company reserves and surplus is 25 lakh 75,000. We have 25 lakh 75,000 plus what is the share I will get? Share I am getting is 9 lakh 18,750. I am getting 9 lakh. Where did it disappear? 9 lakh 18,750. I am getting share. I cannot conclude yet. But minus unrealized profit 30,000. I still cannot conclude. Because I don't know whether I am getting goodwill or capital reserve. That also makes a difference. So what is my cost of investment? How much is my cost of investment? Can you see over here? 41 lakh 50,000. Do you have any pre-acquisition dividend and all? Nothing. Share of net assets. What is the equity share capital? Equity share capital is how much? 50 lakhs. In 50 lakhs, how much is my share? 75%. That makes it 37 lakh 50,000. Plus, do we have any capital profit? No. I have purchased shares on the date of acquisition itself. So this becomes 37 lakh 50,000. Am I paying more or less? More. That means 4 lakh is goodwill. So you should find 4 lakh in intangible assets. 4 lakh in intangible asset goodwill. That means I can conclude my profit calculation. 25. $34,63,750. Is this clear? Okay. Now, long-term borrowing and all, what you are going to do? 5 lakh, 2 lakh, 7 lakhs. Finished. Clear? Short-term borrowing, 4 lakh 50. Finished. Trade payable, 365 plus 245. But, there is something that they have told, which is intercompany owings. What did they tell? 25% of trade receivable of super limited. Super limited trade receivable is how much? 4,90,000 is what I can see. Oh, super limited, sorry, clear limited, that is 5,85,000. 5,85,000 into 25%. This is the common item. So what I will do? 5,85,000 plus 4,90,000 minus 1,46,250. Add the two, remove the common. 4,63,700. Can you see this? Okay. PPE will change only if there is revaluation. Otherwise, it will not change at all. Go and see what is the property, plant and equipment. 77 plus 54. You will get 131. Done. Finished. Clear? Inventory will change only if there is stock reserve. Is there stock reserve? Yes. Unrealized profit is there. Okay. 675 plus 565 minus 30,000. 12 lakh 10,000. Are you getting it? Yes. Next, trade receivable, we have already addressed it. Okay, cash and cash equivalent. Add both, you'll get the value. That's it. Trade receivable also, what you're going to do? You're going to just add both and minus 146,250. That is the intercompany owing. So major calculation is what? Whenever there is consolidated balance sheet, one. Okay, major, and you can see the allotment of marks also will be for these things only majorly. Okay, understand this. This is major, reserves and surplus. It depends on multiple steps. And then minority interest calculation is another major thing that we have to remember. And then the goodwill or capital reserve that you're going to get. Those three areas will have the maximum marks in consolidation. Remaining things are just plus minus. You're just going to add. If it is intercompany, remove one thing. That's it. So, reserves and surplus calculation, minority interest calculation, and the intangible asset or goodwill or capital, so whatever it might be. Clear? This is question number 1. They've already done the calculation. See, shareholding pattern, analysis of profit, computation of goodwill or capital reserve, minority interest, general reserve, reserves for consolidated P&L, reserves and consolidated P&L, both they have done. This is your step 8 basically. Yes, question number 2. Yes, let's continue. What? 8 more. This one is just starting. 8 more to go. Okay. CA Inter September 2024. This is something different. Something different. They didn't ask consolidated balance sheet only. Like on MCQ they asked, tell this, tell that, tell this, tell that. We'll see what they are asking. Okay, on 1st February 2024, Best Limited acquired 80% equity shares of Cool Limited. Okay, for 14,80,000. What is this 14,80,000? Cost of acquisition or cost of investment. Clear? Now, on 31st March 2024, 2 months later, Best Limited also acquired 25% equity shares of Good Limited for 3,80,000. What is this? What is this? Yeah, but cost of first of all, you see the percentage here, then cost. What is it? Related party, yeah. AS 23. Investment in associate in consolidated financial statement. We don't know whether it will impact or not, but this is an associate. Clear? Now, AS 23 is applicable only if you are going to prepare consolidated financial statement. Here, are you going to prepare consolidated financial statement? Yes, because you have 80% over here. Clear? Now, we don't know what they have asked. Wait. Following are the balances extracted from the books of Best, Cool and Good. Holding company. Best is the holding company. Cool is a subsidiary company and Good is the associate. Good is the associate. Clear? Yes, you have equity shares, securities premium, debenture, general reserve, P&L credit balance, investment, property, plant, equipment, current assets, trade payable, including bills payable, sales and other income. That also they have asked. Raw material consumed, wages, production expense. Okay, little only information. Additional information. Little only, that's it. Profit and loss account of Cool Limited showed a credit balance of 30,000 on 1/4/2023. When did you acquire the shares? 1/2/2024. That means starting of the year balance they are giving. Okay. Of Cool Limited. Cool Limited is the subsidiary company. General reserve balance is brought forward from previous year. Whatever you are seeing is last year's only. That means everything is pre. Clear? On 31st March 2024, all the bills payable in Cool Limited's balance sheet were acceptance in favor of Best Limited. This is called as intercompany owings. Correct? Mutual owings. Yes. However, on the date, Best Limited held only 3 lakh of these acceptances in hand. Only 3 lakh is there. Remaining is endorsed or discounted. We don't care. 3 lakh is the mutual here now. Okay. Rest having been endorsed in favor of its creditors. See, endorsed. If I drew a bill on you, you accepted it and gave it to me. We both are getting consolidated. Now it's intercompany. But the bill which you accepted and gave it to me, I discounted it to bank. Now the bill is with bank. It's not intercompany for me. You are supposed to pay to bank. If you are supposed to pay to me, intercompany. I gave it to my creditor. Now you are supposed to pay my creditor. Is it intercompany? No. Okay. Best Limited purchased goods costing 5 lakhs from Cool Limited on 1st June. Best Limited purchased goods costing 5 lakh from Cool Limited on 1st June at a price of 6,50,000. What is this? Intercompany again? No. If you are preparing consolidated P&L, we have to eliminate it. Yeah. Entire goods remain unsold. Unrealized profit is also there to be computed. Best Limited is preparing consolidated financial statement for the year ending 31st March 2024. When did you acquire the shares? 1/2/2024. That means only for you 2 months is post. 10 months are pre. February, March, 2 months is post. 10 months are all pre. Clear? But we don't know what they asked. Simply we are telling pre-post and all. Wait, we'll see what they asked. You are required to calculate trade payable. Trade payable. Trade payable will be what? Holding company plus subsidiary company. Correct? How much is the holding company? Trade payable. 3 lakh 80, 4 lakh 10. See over here. 3 lakh 80, 4 lakh 10. Oh, what is this 3 lakh? Remember, bills. 4 lakh 90. Done. First question of the this thing already done. But trust me, students don't like these kind of questions. Students don't like this kind of questions. Sir, quietly give me consolidated balance sheet. From step 1, everything I will do, I will get the last result. Suddenly in middle you are asking me trade payable and all. This I don't know. You are getting my point. Notes to accounts. Yes, I heard it. Yes. Now, next you see what they have asked. Current assets consolidated. What do we have? Current assets. Where do we have current asset? 965, 560, elimination. 965, 560, and we are eliminating the 3 lakhs. 12 lakh 25,000. Clear? 2 questions done. Now, let's continue. Minority interest. Minority interest. This is not an easy thing. Correct? So, what we have to do? Yeah, actually, what is the confusion? Yeah, we have already removed, right? Okay, now listen, minority interest we have to calculate, no? Yeah, even I am thinking what she's asking suddenly. Okay, minority interest. Now tell me one thing. What is the share capital of Cool Limited? 20 lakhs. How much is my shareholding? 80%. So out of 20 lakhs, 20% should go to minority interest. 4 lakhs. How much is the reserves and surplus that is there? 2 lakh 20 is there and 84,000 is there and 2 lakh 70,000 is there. Whatever is there over here, 20% should go. Correct, to minority interest? Okay. See over here. Securities premium 20%, general reserve 20%, P&L 20%, share capital 20%. This is your minority interest. This is your minority interest. Everything 20% will go to minority interest. Is it clear? Share capital and profits. Now, next we will go further. What did they ask next? Goodwill or capital reserve on the acquisition of Cool Limited shares. There is also goodwill or capital reserve on the acquisition of Good Limited shares. AS23. When you have investment in associate, there also goodwill or capital reserve will come. Same step 6 will be done there also. Now, for goodwill or capital reserve, first thing we require is cost of acquisition. How much did you pay for acquiring? 14,80,000. In this entire question, did we see anywhere dividend word used? No. 14,80,000 minus share of net assets. How much is the equity share capital of Cool Limited? 20 lakhs. I should get 80%. 20 lakh into 80% is 16 lakhs. How much securities premium is there? 2 lakh 20. But 2 lakh 20 into 80%. Why fully? Everything pre. Securities premium, everything pre. Are you getting this? We have issued shares somewhere in the past. We don't know about shares being issued now. Somewhere in the past, fully pre. Pre will be subtracted over here. Now, understand this. General reserve. General reserve also they told it is coming from last year. See over here, general reserve balance is brought forward from the previous year. That means everything is going to be pre-general reserve also. Take 80% of general reserve. Take 80% of general reserve. Now P&L, how much is P&L? 2,70,000. 2,70,000. In this, everything is not pre. 10 months is pre, 2 months is post. Analysis of profit says 10 months pre, 2 months post. 2,70,000 into 10 by 12. 2,25,000. And remaining 45,000 is post. Correct? Do we have any dividend or anything that is given? No, right? P&L opening. Where did they give the opening? Somewhere they have given, I think, no? Here. P&L is 30,000 on what date? On 1st April 2023. 1st April 2023 is what date? When did we acquire the shares? 1st February 2024. So starting of the year there was 30,000. Now see what they have done. 30,000 into 80%. But 80%. Oh, okay. That number I can see there. Okay, 24,000. Now 2,70,000 minus 30,000 into 10 by 12 into 80%. That also will be there. That only we were taking, no, fully. Are you getting this? Out of 2,70,000, already we know 30,000 was there at the starting of the year. That means 2,40,000 is earned during the year. In this 2,40,000 also 10 months is pre, 2 months is post. So again we have to do 10 by 12 and you are getting what? 1 lakh? No, that is 80%. You will get 2 lakh and 140,000. Directly reading the numbers, sir. 1,60,000. Okay. So this will become 1,60,000. Is this clear? Are you following this? Okay. Now, see over here 160 and 24 both are going to be considered as pre only. 100% is going to be considered as pre. See, understand this. This was already there at the starting of the year, pre. But for me, pre is how much? 80%. Because 20% is going to minority interest. No. Here, out of this 10 months is also pre. But for me, pre is how much? 80%. Because 20% already went to minority interest. This is post. But this post will get added to the reserves and surplus. Later when we prepare reserves and surplus, it will get added over there. Now, if you see, no, after doing all that circus, you are getting 547,200 as capital reserve. How are you getting capital reserve? What you are paying is more. What you are getting is less. Okay. Sorry. What you are paying is less. What you are getting is more. You can take your calculator. 16 lakhs plus 176 plus 67,200 plus 24,000 plus 1,60,000. You're getting 27,200 minus 14,80,000. 5,47,200 is capital reserve. They've just presented it in a different way, but when you do it in your methodology also, you'll get 547,200 only. Capital reserve. Is this clear? Now, that is the fourth question. What did they ask in the fifth question? Goodwill or capital reserve on the acquisition of Good Limited's shares. Associate also does step 6. Okay, just for calculation of goodwill or capital reserve. What is the cost of acquisition? 3,80,000. Cost of acquisition is 3,80,000. What is the share capital of that company? Can you see share capital is 10 lakh. How much is mine in that? 25%. Can you see 25% is 2,50,000. Do they have general reserve? General reserve is 1,20,000. How much is mine in that? 25%. So you will take 30,000. P&L. How much is the P&L balance? 50,000. How much is mine in that? 25%. 12,500. Here we don't know the months. Here we don't know how much was there at the starting of the year and all that circus we don't know. Directly we take. Because in AS 23, if you remember, AS 23, you are just comparing what you are getting and what you are paying. Remaining everything is goodwill or capital. So here it is goodwill. Why goodwill? If you take this now 250 plus 30, 280, 280, 292, 500. 292, 500 is what is there, what you are getting, but you have paid 3,80,000. Remaining 87,500 is goodwill. 87,500 goodwill. What did they ask after that? P&L consolidated. Consolidated P&L. So you have your own P&L. Holding company has its own P&L. Can you see general reserve and P&L in there? Okay, now they said consolidated P&L. So I'm thinking they are assuming only for the P&L part. Reserves they are not asking only. So 3,26,000. Can you see 3,26,000? Now, share post-acquisition profit from Cool Limited. Who is Cool Limited? Subsidiary company. Subsidiary company, remember, we did one diagram. It is over here, 2,40,000. How much is post over here? 40. 40,000 is post into, how much is mine in that? 80%. 32,000. And this totals up to 3,58,000. Is this clear? Consolidated P&L. This is what they are asking. Sir, how unrealized profit is? 3 lakhs. We'll get to that. Okay. Your doubt that times. General reserve consolidated. General reserve consolidated. They have asked next question. Can you see over here? General reserve consolidated. How much is general reserve? 2,69,000. Clear? How much will you get out of that 84,000? Will you get everything? See, why did they write general reserve consolidated 2,69,000? What, sir? Wrong. Why they have written only holding company? See, sir, general reserve is there here also, sir. General reserve is there here also, sir. Why they have written 2,69,000 only? Because the other things are all pre. If it is pre, it is already considered in goodwill capital reserve calculation. RPRR only will come to the reserves and surplus. CP, that is capital profit, will not come here. Capital profit will go where? Straight into cost of control. That's why only 269 is taken. Can you see only 269 is taken over here? Yes. Next question is revenue from operations consolidated. Revenue from operations. Did we make some sales? 56, 38. But there is some intercompany to be taken care of. Clear? 56 plus 38 we will not get fully. How much we will get? 2 by 12. Why 2 by 12? I have purchased the shares on 1st February. So February, March. 2 months will be taken. Clear? This will be my revenue from operations. Clear? Now, then what did they ask? Sir, wait, 1 second, sir. There is one unrealized profit, no, sir, here. Best Limited purchased goods costing 5 lakhs from Cool Limited on 1st June. This is purchased before acquisition. It is not even mutual. I have purchased the shares on 1st February 2024. Before that, there is purchase and sale. Can you see when I am calculating sale, I am taking sale only for 2 months. Only for 2 months it is taken as sale. This sale happened before. That time there was no relationship only that time. It is not even mutual. Is this clear? Yes. Now, after that, last question that they have asked, cost of material consumed, consolidated. Shh, guys. Raw material, 36 lakh 50. From where am I getting? See over here, 36 lakh 50. Now, consumed, what should I do? Again, I should do only 2 by 12. Only 2 by 12. So, if at all it was from the starting of the year, then I had to remove the mutual owings, like when I prepare P&L. I think your unrealized profit situation is covered. Okay. We have sold and purchased before we had become the holding company and subsidiary company. So it doesn't impact my P&L at all. But the 3 lakh what you're talking about or what you're thinking about is not this one. Which 3 lakh you are thinking about is this 3 lakh. Bills receivable, bills payable. That is the 3 lakh. Is this clear? Yes, that should be it with that question. You should have, yeah. See, consolidation happens from the day the holding subsidiary relationship is formed. I purchased shares on 1st February. So after that only your sale, I will take a share. No, before that your sale, I will not take a share. Are you getting this? Yes. Let's go further. 2 months only we are taking. Huh? Minority interest is a person in the balance sheet, not in the P&L. What did you understand? See, I will prepare P&L, consolidated P&L, then there will be some profit. That profit, little will go to minority interest, little will go to holding company later. Are you getting this? When you prepare balance sheet, minority interest won't come in P&L, no. Creditor, will creditor be in the P&L or in the balance sheet? What happened to you guys? Too much studying makes you kuchambata. Yes. So URP will not be here. Yes, it will not be here. It will not be there also. Yes, question number 3, guys. May 2024. Okay, guys. May 2024 question. Small question. 14 marks only they have asked. We'll do one thing. We'll keep one page for calculations. Okay, third question. We still have 6 more in consolidation itself. Third question. Sorry, 7 more. The balance of Art Limited and Craft Limited as on 31st March 2024 are as under. We don't know who is the holding subsidiary here. I don't even have to look at the balance sheet, regular balance sheet only. Okay. And you can see the share capital, reserves and surplus, you have general reserve and P&L. Short-term borrowings, you have bank OD, land and building, plant and machinery, non-current investments, you have investment in Craft Limited. That means this person is the holding company and this person is the subsidiary company. That means Art Limited is the holding company, Craft Limited is the subsidiary company. Clear? Now, Art Limited acquired 3,200 ordinary shares of Craft Limited on 1st October 2023. That means date of acquisition is during the year, not at the starting of the year. Clear? Reserves and surplus and P&L account of Craft Limited showed a credit balance of 40,000 and 58,000 respectively on 1st April 2023. Starting of the year, they have given the balance 40,000 and 58,700. Now, this is important. Revaluation. Plant and machinery of Craft Limited, which stood at 2,50,000 as on 1st April, was considered worth 2,20,000 on the date of acquisition. Depreciation on plant and machinery is calculated at 10% on the basis of useful life. Useful life means what? Straight line method. Revaluation of plant and machinery is to be considered at the time of consolidation. Revaluation is to be considered on what date? On the date of consolidation. Clear? That means we have to do the entries. This is missing. Then Craft Limited deducts 1% from trade receivable as a general provision against doubtful debts. This policy is not followed by Art Limited. One question is there about change in accounting policy. From that they picked one point and put in the question. Now see, who is Craft Limited? Craft Limited is the subsidiary company. Who is the Art Limited? Art Limited is the holding company. They are telling that, okay, Craft Limited deducts 1% from trade receivable as general provision. But that policy is not followed by Art Limited. So what we should do? We should not deduct that when we are doing consolidation. Where is the trade receivable? Can you see trade receivable? 1,68,300. They have given a note also. I don't know. Number is little mismatched here. I think 6 was for cash and cash equivalent. 1,68,300. How much provision they have made? 1%. So what should I do? I should add that 1% back. I cannot take 1,68,300. I should take 1,68,300 plus, correct. This is 99. How much is 100? What plus? How much is 100? 1,68,300 divided by 99. 1,70,000. So my trade receivable will be 1,70,000. And what will you do? Reserves and surplus. How much is 168,300? 1,700. 1,700 will be added to reserves and surplus. If you create provision, what will happen? If you create provision, P&L will reduce and provision will get created. Clear? If you reverse the provision, what will happen? Debtor balance will increase again and that will get added to P&L. It will get added to reserves. Clear? Then only we can go ahead with anything else that we should remember. On 31st March 2024, end of the year, Craft Limited's inventory includes goods which it had purchased from Art Limited for 1,03,500, which made a profit of 15% on cost price. Okay. Whose inventory is including? Craft Limited. Luckily, it is downstream. If it is upstream, too much work is there. It is downstream. Is this clear? What did they ask you to do? Consolidated balance sheet as on 31st March 2024. Clear? Now, let's quickly understand what is the date of acquisition. What is the date of acquisition? What is the date of acquisition? 1st October 2023. 1/10/2023. What is the shareholding pattern? What is the shareholding pattern? 3,200 shares. How many shares are there over here? 4,000 shares. So 3,200 divided by 4,000 is 80%. Minority interest is 20%. Clear? 3. Analysis of profits. What and all we have? First one is general reserve. How much was their general reserve? 40,000. General reserve is 40,000. How much was there at the starting of the year? Can you see starting of the year general reserve balance was 40,000. We don't even have to think further. Full thing is called as pre. Nothing is post. Clear? After general reserve, what is the next thing we need to worry about? Revaluation, not P&L. Revaluation. What is asset value? Asset value which stood at 2,50,000 they said. What is asset value? Balance 2,50,000. On what date? 1/4/2023. Starting of the year. Correct? It is considered 2,20,000 on the date of acquisition. What is the depreciation rate? 10% per annum. 10% per annum. Correct? Okay, so now what you are going to do? If you see the balance sheet, no. See their plant and machinery. 2,25,000 it has become. How? 10% they have removed. 2,50,000 minus 10%, 225 it became. But we are doing on what date? We want the balance on what date? 1/10/2023. That is date of acquisition. So what will you remove? Minus 12,500. This will become 2,37,500. 12,500 because 6 by 12. Okay. So it will become 2,37,500. What is it revalued to? What is it revalued to? 2,20,000. That makes it 17,500. What is it? Loss or profit? Loss. This will be pre. This will be pre. Clear? Now, 2,20,000 into 10% into 6 by 12. How much we require? We need 11,000 depreciation. Correct? But what they would have done, they would have taken 12,500 depreciation for the second half of the year also. So we need 1,500 depreciation to reduce. We need 1,500 depreciation to reduce. Is this clear? Analysis of profits is the most important thing in this particular question. Clear? So what I'm trying to tell you, see, we had balance of 2,50,000 on 1/4/2023. Okay, we reduced 12,500. Why? 6 months depreciation. 2,50,000 into 10% into 6 by 12. 12,500 you remove. That time you are getting balance of 237,500. This is on the date of acquisition. They said on date of acquisition we want it to be only 2,20,000. 2,20,000 we want it. That means it is going down by 17,500. 17,500 will be considered as pre. 17,500 will be considered as pre. Why? Always the revaluation is happening on the date of acquisition. Asset value went down. Depreciation also has to go down. Clear? What happened to depreciation over here? 10% into 6 divided by 12. 10% into 6 divided by 12. According to us, we need only 11,000. According to them, they would have done 12,500 for the second half also. So now 1,500, we don't want depreciation at all. Now see, P&L. How much is there in my P&L? Oh, sorry. How much is there in my P&L? P&L is 2,08,000. But should I add something? 2,08,000. Should I add this 1,700? Actually, we should add no provision. We reverse no. When provision is reversed, what will happen? Profit also will increase, right? So 2 lakh. Where am I writing? 2,09,700. Do we know what is opening balance? They have already given. What is opening balance? 58,700. Can you see? They gave a number which will be good for you to calculate. You didn't figure it out. You write 58,700 and you will write pre. Clear? Now 2,09,700. Trust issues. 1,51,000. Clear? 1,51,000 you have. Now this what you will do? 6 months again in this also will be pre. 6 months will be post. 75,500. 75,500. Yeah, we'll do that. Okay. Plus depreciation 1,500. This becomes 77,000. This will be post. This will be pre. This will be pre. I told you why. If you would have missed that number, no, you would get some different weird numbers. They gave 58,700. If you match this over here, that means if you have added that 1,700, then this 700 will get cancelled and you will get easy numbers to calculate. And when you add depreciation, it becomes 77,000. They framed it in a question in such a way. Now see, if you have missed, no, you will do 2,08,000, I think, right? Minus 58,700. How much will you get? Imagine dividing this. You will not get the comfortable numbers that you are looking for. So you will get the comfortable numbers. And when you add 1,500 again, it will become some 150 and all. Yes. So every time if you get comfortable numbers, it's not right also. Sometimes you'll get 333. Don't think that you're on the wrong path. You can be right path only that time also. Okay, but this is the situation. Clear? Now listen. Shh. Step 4. Apportionment. Do we have capital profit, revenue reserve, revenue profit? There is no revenue reserve, sorry. Yes, no, it is. Because revenue reserves, everything is pre. From where you'll get revenue? 40,000 we got from general reserve. Is that right? Clear? From revaluation, how much we got? 17,500 loss. From revaluation, we got 17,500 loss. Okay. From P&L, we got 58,700. and 75,500, 134,200 capital profit, and revenue profit I am getting 77,000. One I will total, other one you total. 77,000 I will total. 1 lakh. I hope you have subtracted 1 in that. Okay. Now, who is the holding company? Art Limited, right? What is the shareholding? We have 80%. We have already calculated. So, at the rate of 80%, at the rate of 20%. 650. 25,000. 77,000.
61,600.
Okay. Clear? This is your apportionment. Capital profit, revenue profit. Clear? Did we have any unrealized profit and all in the question? Yes. But it is downstream. So we don't have to worry about minority interest right now. So now, only till minority interest I am doing. Okay. Minority interest. What is the equity share capital? What is the equity share capital? 30% now. 4 lakhs. 4 lakh into 20%. 80,000. Plus their share. 31,340. 15,400. Is there bonus? No. Is there unrealized profit? No. 80,000 plus 31,340 plus 15,400. 126,740. Clear till here? We should understand. The only adjustments that we have to worry about now is this thing, unrealized profit adjustment, that we have to worry about. Revaluation and all we have already taken care of. That is question number 3. 126,740. That is what we are looking at. Correct? Minority interest. What is the share capital? Share capital. No, 6,50,000. We will take only our share capital in consolidated balance sheet. 6,50,000. Clear? Now what we have to worry about? Only the reserves and surplus we have to worry about. That is the most crucial thing. But to do reserves and surplus, I need that step 6. I need the step 6, right? Cost of investment. How much did I spend on this investment over here? 4,32,000. I have spent 4,32,000. Anywhere in this entire question, did you hear the word dividend? No. So share of net assets. What is the share capital? 4 lakh. 4 lakh into 80% is mine. 3,20,000 plus capital profit. We calculated capital profit and kept. What is the capital profit? Our share 125,360. This one 125,360. Our share is 125,360. 4,45,360. Correct? Now, are you paying more or less? More. Sorry, less. 13,360 is capital reserve. Let's find 13,360 capital reserve, consolidated balance sheet. Where is the working notes? 13,360 capital reserve. Is this clear? Now, general reserve. General reserve, how much we had over here in the question? How much was our general reserve? Our general reserve was 3,12,000. Art Limited 3,12,000. Clear? Now, sorry, I'm seeing full reserves and surplus. Let's see the note only. How much was my general reserve? 1,20,000. Did anything get added? No, because it was all pre. So here what will happen? It will remain at 1,20,000 only. 1,20,000 only. And here P&L. P&L you have to be little careful. How much is the P&L here? 1,92,000. 1,92,000 plus you will get your share. What is your share of P&L? 61,600. 61,600 minus unrealized profit. That is one thing we have to minus unrealized profit. They have given in the question that the sale was how much? 1,03,500. 1,03,500, which made a profit of 15% on cost. So what I will do? 1,03,500 into 15 divided by 115. Percentage is on cost. We have the selling price with us, 1,03,500. Sorry, 13,500. Then what will you get? Yes, 2,40,100. Okay, can you see 2,40,100 in our solutions? Done. Reserves and surplus done. That's the most important thing. So reserves and surplus is sorted. Short-term borrowing, go to the question, see the short-term borrowing, see it and put it directly. Clear? Trade payable, no mutual owings were there in trade payable. Just total these two and enter it. Clear? Property, plant and equipment, see it but don't enter it directly. Okay, 4,21,000 plus 3,60,000 went down, minus 17,500, depreciation plus 1,500, 421 plus 360 minus 16, 7,65,000, lucky number, 7,65,000. Simply. Okay, then after that, non-current investment not there at all. Non-current investment won't be there, no. Because investment and share capital got cancelled with each other. Goodwill capital reserve we got calculated. Inventory 1,66,000 plus 2,05,000 minus unrealized profit. I think it was 13,500. If I am not wrong, it was 13,500. Where did I even calculate? I only don't know. 13,500. Unrealized profit was 13,500, 3,57,500. Trade receivable, 133,500 plus, correct, 170. 3,03,500. Why? We removed the provision. No, trade receivable went up. One place profit you have taken. Here if you don't take, balance sheet will not tally. No. Now, cash and cash equivalent money is with you only, didn't go anywhere, just add it, that's it, that's the end of the question. That is the end of the question, clear? I don't think there should be any trouble. What was the trouble? Revaluation, and that point is there in the study material. That point is there in the study material, where you acquire the shares in the middle of the year, and that on that day you are doing the revaluation, and it will change your profit. What is not there in the study material is this point. It is there, but it is as a separate question. It is there as a separate question. It is not integrated with the consolidation question. Okay. Otherwise, everything is fine. Yes, that should be it, guys. We should go forward. Question number 4. Sorry, it's called 6 more, by the way. 6 more. We have questions in consolidation. Once we finish that, we will go into preparation of financial statements. Do you need a 2 minutes breather? Bye. Do you need a 2 minutes breather? Yes, it's 58. I will start at 6. Study material question. X Limited acquired 70% equity shares of Z Limited at a cost of 70 lakhs. At a cost of 70 lakhs. Following information is available from the balance sheet of Z Limited on 31st March 2021. Correct? You can see all the assets and liabilities are given on 31st March 2021. When did you acquire 31st March 2021? For you, that means nothing is post, everything is pre only. Today only you acquired the shares. Following revaluation has been agreed upon. Property, plant and equipment will go up. Investment will go down. Depreciation they have not spoken about. Okay, if depreciation they speak about also, you ignore. Because today you acquire, depreciation will be from tomorrow only. Z Limited declared and paid dividend at 20% on its equity shares on 31st March 2021. Okay, at face value 10 rupees per share. X Limited purchased the shares at 20 rupees per share. Now, come calculate the goodwill or capital reserve they have asked. Now, what is the format to calculate goodwill or capital reserve? Cost of investment minus pre-acquisition dividend. You'll get some value. Share of net asset. Equity share capital plus capital profit. That time you will get, bonus is not there. Plus capital profit, that time you will get goodwill or capital reserve. Cost of investment. Is it directly given here? It is 70 lakhs. Investment we have purchased at 70 lakhs. 70. Pre-acquisition dividend. Did they declare and pay dividend at the rate of 20%? Correct? Can we take 70 lakh into 20%? No, 70 lakh is the cost of investment. We need the face value. Now understand over here. How much rupees per share did we pay? 20 rupees per share. So 70 lakhs divided by 20 is equal to 3.5 lakh shares. 3.5 lakh shares is what I purchased. 3.5 lakh shares. 3.5 lakh shares is 70%. How much is 100%? That means 5 lakh shares were there. Total there were 5 lakh shares. Now dividend will be what? At the rate of 20%, right? So you will do 5 lakh into 10 into 20%. 10 lakhs. But I will get how much? Only 70%. So 7 you remove, you will get 63. You will get 63. This is your net cost of investment. Now you need equity share capital. Equity share capital we calculated. No, 5 lakh over here. So 5 lakh into 10 into what is my share? 70%. This becomes 35. Now only thing that I have to do is find the capital profit. Clear? Now they have not given me the reserves and surplus. They have given assets. Asset minus liability is a formula. Asset minus liability is equal to capital. Now this is asset, this is asset, this is asset, this is asset. Correct? This is liability, this is liability. Use your calculator and minus. 120 plus 55 plus 70 plus 15 minus 140. 120. Did you get 120? So net asset is, okay, you got 120. In this 120, do you agree? There is equity share capital which is 50. 5 lakh into 10. Okay, then balance everything is reserves and surplus which is 70. Which is 70. This 70 I should get a share. But remember, there is also revaluation that has happened. Remember, revaluation also is there. Okay, revaluation, what did they tell? Plant and property, plant and equipment 20% more. 120. So 120 into 20%. That makes it 24. Profit. Investment 10% less. How much is investment? 55. So 55 into 10%. That makes it 5.5. 18.5. So 70 plus 18.5. Total is 88.5. 88.5. For me, my share is how much in that? 70%. So 61.95 plus 35. 96.95. Did I pay more or less? I paid more or less? Less. 33.95 is our capital reserve. 33.95 is our capital. Everything is looking more or less only. More. What is our this thing? 63. What are we getting? 96.95. Did you understand this calculation? ICAI has done it in a different way. Okay. They just totaled everything and they will do it. That's why I showed the calculation in this way. So it is easy to understand. Is this clear? This is our question number 4. Question number 5. Question number 5. Variety limited. This we have to see. Very different question. Variety is there in this question. Okay. Now here. AC we need. Yes. It's very hot. AC we need. FM. What FM? Little bit of FM also you need to understand. Some yield and all they will tell. But otherwise, just understand the question. You will be able to solve. Now, Variety Limited holds 46% of the paid up share capital of VR Limited. Ignore. No consolidation. You are holding only 46%. Yes. The shares were acquired at a market price of 17 per share. So you had acquired the shares at 17 per share. The balance of the shares of VR Limited are held by a foreign collaborating company. That means Variety Limited is holding 46% and VR Limited or the foreign company is holding 54%. Memorandum of Understanding has been entered into with the foreign company providing for the following. What did we enter into memorandum? We entered into a memorandum telling that I want to buy this 54% also. That time I will become holding company by holding 100% of the shares. Now, Go to the end of the question. Find out goodwill or capital reserve. Find out goodwill or capital reserve. That is what they have asked. Clear? Now, cost of investment. We need the cost of investment. We don't know. Dividend and all, I don't think they have spoken about only in this question. So, share of net asset, equity share capital plus capital profit. If you get this, you'll get the goodwill or capital reserve. Clear? Now, cost of investment. Tell me one thing. Already we know that 46% of the shares we had. For that I have paid 17 rupees per share. Okay. Shares held by the foreign company were sold to Variety Limited. This foreign company is giving me shares. Okay. The price per share will be calculated by capitalizing the yield at 15%. Price per share will be calculated by capitalizing the yield. That means, yield means what? Whatever return you are getting. The return that you are getting is called as yield. If you capitalize the yield, that will give you the value of the company. If you capitalize the yield, you will get the value of the company. When you have the value of the company, you will get price per share. Now divide by the number of shares, you will get the price per share. That is the logic that they are using in this question. Now, yield for this purpose would be 40% of average pre-tax profit. Average pre-tax profit. See, pre-tax profit means what? Profit before tax. Everything won't be yours, no. Everything won't be yours. That's why they said take 40%. So 30 plus 40 plus 65 divided by 3 is equal to 45 is the average pre-tax profit. 45 into 40% will be 18 is the yield. 18 is the yield. A company that is giving yield of 18. What is the value of the company? 18 divided by 15%, they said, divided by 15%. What are you getting? 120 lakhs. That is the value of the company. 120 lakhs. Okay. Now, let's continue. Actual cost of the shares to the foreign company was only 5,40,000. This paragraph we'll ignore now. They are telling how to give the money to the foreign company. Out of the net consideration, 50% would be remitted to the foreign company. Let's ignore that also for the time being. Above agreement was approved by all concerned being affected. The total assets of VR Limited is 1 crore. Asset is 1 crore. It was decided to write down the property, plant and equipment by 1,75,000. Current liabilities of VR Limited as on the same date were 20 lakhs. Asset minus liability will give you what? Capital and reserves and surplus. Capital and reserves and surplus. Paid up share capital of VR Limited was 20 lakhs. Divided into 2 lakh equity shares. Did they tell you 2 lakh equity shares? Now understand this. Understand this. Cost of acquisition. We had 2 lakh shares. Out of 2 lakh shares, do you agree that I already had 46%? And this 46%, I had purchased it at 17 rupees per share. 15,64,000. Correct? Now, 2 lakh shares into 54%. Now I am going to buy it. I am going to buy it now. Okay, now I am going to buy it at what value? 120 lakhs is the value of the company. 120 lakhs is the value of the company. How many shares we have? 2 lakh shares. That means now the price of this share is 60 rupees. Clear? Now this paragraph becomes very important. They said shares held by the foreign company will be sold. Price per share will be calculated by capitalizing the yield. Yield is the return that you are getting as an investor. That yield, if you capitalize, you will get the value of the company. Divide by the number of shares, you will get value per share. How to get the yield? 40% of the average pre-tax profit. Take the average pre-tax profit, multiply into 40%, you will get the yield. Divided by the discounting rate, which is 15%, you will get the value of the company. Value of the company is 120, divided by the number of shares, 2 lakh 60 rupees per share. 60 rupees per share you are going to have. So what you are going to do into 60? 64 lakh 80,000. So therefore 64 lakh 80,000 plus 15 lakh 64,000. 80 lakh 44,000 is your cost of investment. You purchase 100% of the shares, finished. Equity share capital, we already know it is 20 lakhs, right? 2 lakh into 10 rupees, 20 lakhs. Should I do 80% and all that? No, full 100% mine only. 20 lakhs. Clear? Now, how to get this asset minus liability again? Asset is how much? 100 lakhs. They only told asset is 100 lakhs. Okay, liability is how much? Liability also they have told. On the same day, liability was 20 lakhs. That means how much is this? 80 lakhs. But out of this 80 lakhs, 20 lakhs is equity share capital. That means 60 lakhs is reserves and surplus. 60 lakhs is reserves and surplus. Everything belongs to me only. 60 lakhs into reserves and surplus. Sir, wait, sir. 46% before, no, sir. Only 54% we have to see now. When there was 46%, no. I did not have holding subsidiary relationship. I purchased today. So for me, everything is free. I purchased today. Everything is free. When I had 46% shares, I was not the holding company. Today I purchased 54% of the shares. I became holding company. So today what is there? Everything is free. From tomorrow post will start. So 60 lakhs into 100%. Okay. And then they also told there is a revaluation. Property, plant and equipment was written down by 1,75,000. So 1.75 you are going to minus. So 58.25 lakhs you will get. That is 58,25,000. That makes it 78,25,000. Am I paying more? You are getting 2,19,000, which is considered as goodwill. 2,19,000, which is considered as goodwill. Now if you go and check, no. Where is that question? Fifth question, right? Goodwill. Now, this is actually what they asked. This is actually a question which has come from old scheme CA final. Old scheme CA final. There was more in this question. Question they have kept like that. The content of the question they have kept like that. But what is asked is only this much. So that extra paragraph actually doesn't make sense, but they can always ask in the exam. Now see, understand this. Out of the cost of the shares of foreign company, cost was 5,40,000 for the foreign company. The profit that would accrue to them would be taxable at an average rate of 30%. Capital gain, 30% they are telling. Tax payable will be deducted from the proceeds and Variety Limited will pay to the government. When you are making payment, little tax you remember, when you are making payment to a foreign company, that time what you have to do? You have to deduct TDS, right? So they are telling deduct the tax and then make the payment. But whatever you are supposed to pay after deducting tax, 50% only you pay, remaining you take it as loan. 50% you pay and remaining you take it as loan. Tell me one thing, how much you have to pay? 64,80,000 we had calculated that. 64,80,000. Now how much is the tax that they have to pay? Should I calculate on 30%? No. Capital gain, consideration minus expense, net consideration minus cost of acquisition, capital gain. On that you will calculate tax, not on the sale value. So now 64,80,000 minus 5,40,000, whatever is there, on that you will calculate 30%. So your tax is how much? 17,82,000. Remove the tax that you are supposed to pay to the government. So now 64.80 minus 17.82, you are getting how much? 46.98 in your calculator. 50% you pay now, 50% you pay later. Did you understand this calculation? They have not asked in the question, but they might also tell, show how the PC or purchase consideration will be discharged. They might tell how the purchase consideration will be discharged, or they can give it in MCQ and tell what is the amount that is considered as loan. What mistake you can make? Directly on 64,80,000 calculating 30%. That doesn't, capital gain doesn't work like that, no. Then people would stop doing investments only. Directly if you calculate. So minus cost of acquisition, don't worry about indexation all, please, over here. Okay, don't think too much about tax. Okay, 5.4 lakhs, remove it. That time you will multiply 30 by 100, you will get the tax amount. This will go straight to government. Balance amount you have to pay to that foreign company. 50% you pay, 50% you pay later. Done. Is this clear? Very important question. Variety Limited. Okay, something totally different it is. So you have to remember this. Okay, next. What do we have? That was your question. Question number 5. Now we'll go into question number 6. Again, this is a study material question. Okay, study material question. Why did I pick it? God alone knows. Why? They didn't ask consolidation. What did they ask here? Restate the balance sheet of B Limited on 31st December after considering the above information for the purpose of consolidation. Would restatement be necessary for making the accounting policy adopted? That one point you saw, no, making the accounting policy proper, that is from this question. That is from this question. What did they tell? See, I am the holding company, you are the subsidiary company. You are following some other policies only, some other accounting policies. I am following some other accounting policies. Now, when I consolidate, does it make sense actually? Different. No. So what you have to do? Just for consolidation purpose, I am not going to come to your company and tell change your policies because I am the holding company. Just for consolidation purpose, what I will do? I will change the policies of which company? Subsidiary company, so that it can match with the policies of holding company. Just for consolidation. After changing the policies, you will get a new balance sheet. Take that balance sheet and then do consolidation. Clear? Okay. Now, let's see what's happening. One balance sheet is given. Beautiful balance sheet. Okay, we'll go straight into the additional information. B Limited is a subsidiary of A Limited. Both the companies follow calendar year. Very good. Otherwise, you are in deep trouble. One is following calendar year, one is following financial year. Then you have to take 3/12, take 9/12 and make one new year and then you do consolidation. Okay, luckily that is not there. I think Tamil New Year is today, tomorrow. 14th. Okay. A Limited values inventory on weighted average basis. Who is A Limited? Who is A Limited? Holding company. Who is subsidiary here? B Limited. So who will change? Subsidiary only. If you want to change A Limited also, no, you don't have the capacity to change A Limited. You know why? Because in the question, they have given balance sheet of only B Limited. Are you getting my point? If you want to make mistake also, they didn't give you opportunity. Why? Because balance sheet of B Limited only is given. Change B Limited, that's it. Subsidiary company you change. Okay, now. See, A Limited values inventories on weighted average basis, while B Limited uses FIFO. Okay. Bring B Limited's values. They didn't tell you to bring A Limited's values in alignment. To bring B Limited's values in line with those, okay, of A Limited, its value of inventory is required to be reduced by 12,000 at the end of 2020 and 34,000 at the end of 2021. We are doing for which year now? 2021, no? 2020, what we are going to change? We are not bothered. We are preparing financial statement 2021. So this 34,000 will reduce. It will reduce. Okay, value of inventory required to be reduced. 34,000 you are supposed to reduce. If you reduce closing stock, profit also will reduce. If you increase opening stock, profit also will increase. Remember that trading account concept. Okay, now this one. Can you see? I'm focusing on the profit. Okay, reserves which are given in the question is 7,14,000. Did they give you 7,14,000? Did we just reduce the stock there? If you reduce the stock, what will happen to profit? See over here. Reduction in value of inventory. 34,000 meant. Reduced. Clear? Okay. Now, B Limited deducts 1% from trade receivable as a general provision against doubtful debt. B Limited is deducting. I am not deducting. So I should not let them also deduct. Okay, we should add that. 8,91,000. Where are you? Yes, here you are. 8,91,000. Should I just add 1%? No, this is 99. How much is 100? You will get 9 lakhs. That means difference is how much? 9,000. 9,000 provision is not required. So we will add it back to profit. So if you go and check, 9,000 is added back to profit. Clear? Any doubts with this? No. Then after that, what did they tell? Prepaid expense in B Limited include advertisement expenditure carried forward 60,000 in 2020, 30,000 in 2021 being part of initial advertisement expenditure of 90,000 in 2020, which is being written off over 3 years. Similar amount of advertisement expenditure has been fully written off in 2020. When I have advertisement expense, no, full I will take it as expense only. But what subsidiary company did? They had 90,000 expense, 30,000 they removed in last year, 30 more thousand they removed in this year, 30 more thousand they were actually planning to remove in the next year. We should not allow that. What we will do, we will remove it this year only. So can you see 30,000 is removed from profits? Prepaid expense is not prepaid, they will take it as expense only. So remove it, you will get the new profit that you are supposed to show. This will be your reserves and surplus. This will be your reserves and surplus. Now see what has happened. Balance sheet. 5 lakh was there? 5 lakh. Clear? Short-term borrowing. I did not touch it at all. 170 is there? 170. Trade payables. Okay, where is trade payable? Oh, sorry, I'm seeing the notes. Sorry. Okay, trade payable 494. I did not touch the trade payable at all as it is 494. Provision, I did not touch the provision at all, as it is, 4,30,000. Done. Liability side. Asset side, first one. Property, plant and equipment, did I make any modification? Depreciation method, did I change? No. 2,24,000 as it is. Non-current investment, nothing. 4 lakh as it is. Inventories, did I make some change? We reduced the value of stock. 742 minus 34, no? 34,000. That time you will get 7,08,000. Reduce the value of inventory. Then trade receivable, it will increase because provision is reversed. So it will become 9 lakhs. We had already calculated 9 lakhs. Clear? Cash and cash equivalent as it is 3,000. And prepaid was 48. Out of that I removed one thing and showed it as expense only. 48 minus 30. So this becomes 18,000. Is this clear? This is called as changing the balance sheet of subsidiary company to align with the accounting policies of holding company. Only for consolidation purpose. You will not go and tell them you have to follow this. Only for consolidation purpose you will realign everything. Is this clear? Yes, that is your question number 6. Now we'll go into question number 7. Color for a reason. 7, 8, 9. Prepare consolidated balance sheet of H Limited and S Limited. For a reason I have taken this question. Otherwise we have discussed everything in this question already. Why I have taken this question is because almost everything is there. Almost everything is there. Following information is also provided to you. Only certain areas I am going to address here where I know people will make mistake. Okay. H Limited purchased 180 lakh shares in S Limited on 31st March 2020. When did you, what is the balance sheet that is given to you? 31st March 2021. When did you purchase the shares? 31st March 2020. That means starting of the year only you had the shares already. When the balance in general reserve and P&L stood as 3,000 and 1,200. I know the balance in general reserve and P&L. Okay, very good. On 1st April 2020, first day of the year itself, declared dividend at 20% for the year ended 31st March 2020. H Limited credited the dividend received to its P&L. Is it pre-acquisition or post-acquisition? It is 100% pre-acquisition. I purchased on 31st March 2020. First day of the year, they are giving me dividend. Obviously, it is pre-acquisition. What did I do? Credited the dividend received to its P&L. So, I have to remove from reserves and surplus, and I have to remove from investment also. Investment anyways I am supposed to remove. That is the correct treatment. I had added it to P&L. So, I am removing from P&L, I am removing from investment. Clear? Okay. On 1st January 2021, that means 9 months later, issued 3 fully paid bonus shares for every 5 shares held out of the balance in the general reserve. Clear? Then they said all bills payable in the balance sheet were acceptance in favor of H Limited. On the day they held only 45. That means 45 is intercompany. We have seen this in some other question as well. On 31st March, S Limited's inventory. S Limited is a subsidiary company. Included goods which it had purchased for 100 lakhs. Made a profit of 25%. That means holding company has sold to subsidiary company downstream. No problem with that. Consolidated balance sheet. You know what is my problem here? You will not make mistake in analysis of profits. You will make mistake in shareholding pattern. You will not make mistake in analysis of profits and all. You will write over here. Now what will you write? You will write date of acquisition 31st of March 2020. Shareholding pattern. You know what you will do? Shareholding pattern. Oh, how many shares we have purchased? 180 lakhs. Okay. 180 divided by. What is the shares of subsidiary company? I will go and check. What is the share of subsidiary company? Here 4,800. 4,800 divided by 10. How many lakh shares? 480 lakh shares. Okay, sir. Okay. Usually I do like this only. I have so many shares. I'll divide it by the total. 480. 180 divided by 480. Sir, no need to prepare consolidation. It is showing only 37.5%, sir. I don't have to do consolidation only. Can I go to the next question? No. Why? This was the shareholding. Numerator is before bonus. Denominator is after bonus. Numerator 31st of March 2020. Denominator you are taking 31st of March 2021. When you are comparing, compare on the same day, no? So, they gave bonus. In between they gave bonus. How much bonus they gave? 3 fully paid up shares for every 5 shares held. Now, how much I have? 180, no? 180 into 3 divided by 5. 108. Now 180 plus 108 divided by 480. Oh, consolidation is required. Are you getting my point? Happiness was short-lived. Consolidation is required 60%. Is this clear? Now understand this. 180 lakh shares, they said it is purchased on 31st of March 2020. 180 lakh shares. But I am seeing the denominator on 31st of March 2021. This I am seeing 4,800 on 31st of March 2021. Between 31st of March 2020 and 31st of March 2021, there was a beautiful date called 1st January 2021. On that day, they issued bonus. So now you cannot compare numerator and denominator on two different dates. So you have to add your bonus. Is this clear? Now, how much bonus you got? You got 108. Correct? That is basically 60%. How much is 100%? 180. 180 lakh is the bonus. 180 lakh is the bonus. That means now what is the share capital? 4,800 is the share capital now. Clear? Minus bonus. Bonus is how much? 1,800. 180 lakh shares, 1,800. That means before bonus it was 3,000 lakhs. 3,000 lakhs was before bonus. I had how many shares before bonus? 180. Do 180 divided by 300. Remember you had 60%. Many people have asked me this question, sir, when you give bonus, no, the shareholding will change. No. When the bonus shares are given, it is given to you also. It is given to minority interest also. So both are getting the same bonus. So the shareholding will be same. Before also you had 60%. Now also you have 60%. If you take different numbers on different days, then you will be in trouble. Otherwise it is same. It is correct. Is this clear? Now, one thing, minority interest will be 40%. This is one thing where you can make mistake. In this, revaluation is not there. Revaluation is not there. What is there? Only the bonus and the dividend. Which is happening first? Which is happening first? Dividend. Okay. What is my general reserve? What is my P&L? See the balance sheet. You will find general reserve of 1380 and you will find P&L of 1620. You are supposed to see subsidiary company. Which are you looking at? 1380, 1620. Correct? Now, you are supposed to see how much was there at the starting of the year. How much was there at the starting of the year? They said when I purchased, no, 3,000 lakhs was there in general reserve. Oh, very good. 3,000 lakhs. But out of that I removed for bonus. How much did I remove for bonus? 1,800 lakhs. That means 1,200 lakhs are remaining and this is considered as pre. 1,300 became 1,380. That means 180 is post. 180 is post. 1620 is the P&L. What was the P&L on that day? P&L balance 1,200. But wait, you have to give dividend also. Dividend you are giving on how many shares? 4,800 into how much is the percentage? 20%. Not 4,800. You have to give only on 3,000 into 20%. Sir, what is this? Sir? Why? It became 4,800 on 1/1. We are giving on 1/4, 9 months before. So this will be 600. This will be 600, which is going to be pre, and this will be 1020, which is going to be post. This is going to be post. Is this clear? This is the major calculation that you need to know in this particular question. Again, I'm going to explain from 7, right? All for a reason. No. I will show from here only their calculation. Okay. See general reserve balance. They are preparing general reserve like ledger. Can you see 1380? Can you see 180? We have done this already. P&L also. Can you see? I think 1,000. No, don't worry about it. 1,000. 1020 is post. No. It's correct. Just that their methodology is different. See here. share in capital profit 1080. Okay. Where is this 1080? 1200, and I think we should not look at their method only, then it will confuse us more. They have written it in the notes. Huh? Oh, out of 1200 lakh profit for the year, 180 lakh has been transferred. 1020 lakhs as post acquisition profit or loss, and 180 lakhs as post acquisition general reserve balance. Final answer will be same. Final answer will obviously be same. Okay, let's not look at it. They have used some other assumption only. Don't worry about it. Okay. They are merging two things and preparing ledger and all. Ultimate answer will be same. Is this clear? Now, what else you have to worry about in this question? The very important thing that you have to worry about in this question is this bills payable. How much will you minus 45? How much will you minus 45? Now tell me, okay, understand this. How much will be your minority interest? How much is the share capital over here? Go to the share capital. 4,800. 4,800 into 20%, sorry, 40%. 1,920. Then how much is the revenue profit and capital profit? How much is the capital profit here? 1,200. Can you see 1,200? 1,200 plus 180. He has to get everything, no? He has to get everything, no? Capital, revenue, everything he has to get, plus 180. And here 600 plus 1020. Total is 2460. 40% belongs to that guy. 984. I'm doing direct calculation, huh? 984 plus 1920. 2904. 2904 should be the minority interest. Where are you guys? Oh, they have some alternative solution, guys. We have missed something, huh? Oh, what number did I take wrong? 1380 plus 1620. Oh, okay. There was something that we have missed. 1000. Okay, correct. So 3000 is the profit, total profit, capital, revenue, everything will go to minority interest into 40%. 1 second. Yeah, 3000 into what is the percentage? 40%. 1380 general reserve plus 1620, 3000. Capital profit, revenue profit is only for the holding company to put into different places, but minority interest they'll get capital also, revenue also. Everything they'll get. 3000 into 40% is 1200. And what is my share capital right now? 4800. 4800 into 40% is, yeah, including bonus, 1920. That makes it 3120. That was the minority interest, 3120. Is this clear? Are you getting this? Now, do we have goodwill or capital reserve in this question? That has to be checked, no? Goodwill or capital reserve? Now, what is the cost of investment? Cost of investment is how much did we pay to buy this? Where did they tell that? You have to find it in the question itself. Can you see the cost of investment? Where is it? They have given, wait. Shares in S Limited, they have given 3000, correct? 3000 minus, do we have pre-acquisition dividend? How much was the dividend we removed? 600. Out of 600, my share is only 60%. That is 360. That means 2640 is there. Net cost of investment. What is the share of net assets? Equity share capital. 4800 into 60%. 2880. then plus capital profit. We have done the analysis already. Capital profit, this is capital profit 1200 and this is capital profit 600. So that makes it 800 into 60%, 1080. 1080 plus 2880, 3960. Am I giving more or less? Less. So minus 2640. I'm getting 1320 as capital reserve. 1320 is capital reserve. We'll see this thing, 1320 capital reserve. Is this clear? Now, general reserve. Understand, what was the general reserve I had in my own company? My own company general reserve is 2784. 2784. Okay, take this 2784 in your calculator, and how much you are getting from them? Post is 180. So 180 into 60%. 108. You should have general reserve of 2892. Okay, P&L. Now P&L, you see here only they have done the calculation. What is H Limited's P&L? H Limited's P&L you can see over here. It is 2715. Can you see 2715? Dividend was wrongly credited to P&L. Wrongly credited. So remove that 360 dividend wrongly credited. And unrealized profit is also there in the question. Where did they tell? See over here. 100 lakh and profit is 25%. So 100 into 20%. 25 by 125 is 20%. Because it is 25% on cost. Remove unrealized profit also. That time you will get the value. Add the share of revenue profit they are telling. Revenue profit, can you see we have done the share? 1020. 1020 into 60%. So 612 I will add. I will get my total P&L. This is how you calculate the P&L. If you go in steps, it will be more of fill in the blanks. Now we are just understanding it from everywhere. Okay. Now apart from that, share capital, you know, direct. Reserves and surplus we discussed. Trade payable, what will be there? Is there some elimination to be done in trade payable? Intercompany owings, do we have something? Yes. Can you see 45 we have to remove? 45 we have to remove. Okay. Other than that, short-term provision and other things and all, revaluation has not happened. So just add. Inventory, what we have to remove from inventory? Unrealized profit. 20 we have to remove from inventory. Unrealized profit. Trade receivable, again 45 we have to remove because that is the intercompany transaction. These two are just straightforward. That's it done. Okay. Shouldn't be a problem. The main thing is first only you will get one hiccup over here. When you start only, you'll be like 37.5%. Okay. So there you have to be careful. Obviously, they can handpick this question also and give it in the exam. Let's go further. Question number 8. Okay, this is the question. Only one question I have put for consolidated P&L. Okay, because consolidated P&L, there is nothing. You just add two things and you show it over there. Consolidated P&L, you see over here. Okay, these are the things that are there. On 1st September, the Chand Limited acquired 5,000 equity shares of 100 each in Sitara. 1st September 2021. Where are we? 31st March 2024. Once upon a time they have acquired shares. Why are we bothered now? Nothing. Okay, so there is no pre-post and all. Everything is post only. Like remember in one question we did 2 by 12 examination question, 2 by 12 revenue. That we don't have to do because we are in 23-24 and they have acquired the shares in 21-22. They acquired the shares in 21-22. Yes. Now understand this. 5,000 equity shares of 100 each, fully paid up. 5,000 equity shares of 100 each, fully paid up. Is that correct? Okay. Now Sitara Limited paid a dividend of 10% for the year ended 31st March 2023. The dividend was correctly accounted. Is this pre-acquisition dividend or post-acquisition dividend? It is post-acquisition dividend because we have purchased in 2021. It is post-acquisition dividend. Don't worry, they have treated it correctly. They have accounted correctly. Now, Chand Limited sold goods of 1,75,000 to Sitara at a profit of 20% on selling price. Okay. Inventory of Sitara includes the goods of 70,000 received from Chand Limited. Unrealized profit. First for sale, what you will do? You have to remove from sale also. You have to remove from purchase also. Now, Remove this, remember this 1,75,000. You have to remove from sale also. Otherwise, no, consolidated P&L is this plus this. That's it. Okay. Only when intercompany comes, you have to remove it. 1,75,000. I will show directly from the notes itself. Can you see they have removed 1,75,000 from revenue from operations, and they have removed 1,75,000 from cost of material consumed. Cost of material consumed, because cost of material consumed formula is opening stock plus purchases minus closing stock. So here they have purchases. No, from purchase only they have removed. Yeah. Yes. Array, see, I'm selling to you. For me, it is that selling price. For you, my selling price is your cost. My selling price is your cost. So both the places I'm removing, from sale also, from purchase also. Clear? This is what you're supposed to do. You're eliminating that intercompany things. Next, selling and distribution expense of Sitara Limited includes 21,250 paid to Chand Limited as brokerage fees. One person is taking it as income, other person is taking it as expense. So what you will do, 21,250 you have to remove from income. Can you see 21,250 is removed from revenue from operations? And then 21,250 you have to remove from expense as well. Can you see in your other expense you will remove 21,250. Can you see other expense we have removed? Selling and distribution expenses, 21,250 is removed. Why can't we remove from other income? Because in this question though they said consultancy fees, royalty, brokerage received is to be considered as operating revenue. That is why they have, otherwise it would have been treated as other income. Okay, now general administration expense, okay, of Chand Limited include 28,000 paid to Sitara Limited as consultancy fees. So what we have to do, 28,000 you have to remove from general administration expense. Can you see from expense I have removed 28,000, and from income also we have to remove 28,000. Just you are removing both the places, then you will prepare the consolidated P&L. Now, Sitara Limited used some resources and Sitara paid 5,000 as royalty. One person you are removing from income, once you are removing from income, and then you are going to remove the 5,000 royalty from expense as well. Can you see 5,000 minus 5,000 became 0 here. Only one royalty was. Okay, next. That's it. Unrealized profit is the only thing that is there. Now, all these intercompany things, purchase, sale, consultancy fees, expense, brokerage, expense, royalty, expense. You eliminated, right? Unrealized profit will impact P&L and it will impact balance sheet. Unrealized profit is there in this question. Inventory of Sitara includes goods of 70,000 received from Chand. So you're going to do 70,000 into 20% directly. No 20 by 120. Selling price only is given. This is 14,000 unrealized profit. You're going to remove from the P&L, and the 14,000 will get subtracted from inventory in the balance sheet. Okay, so if you see changes in inventory, where are you? Can you see 14,000? Changes in inventory, you're removing 14,000 and you're taking the net over there. Okay, this shouldn't be an issue. That is it. That is consolidated P&L. Rest of the things are all plus, 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 plus. Yeah. Why? Yes. Why? Yeah, she is there from morning. She told that only traveling is a problem. Otherwise, she would have come to class itself. Yes. CA Inter November 2023. Okay. Hello. CA Inter November 2023, guys. I have put this question just for one reason. Okay, just to explain one concept to you. That's all. Otherwise, I'm not going to discuss this question in detail. What do you want? November 23. I have put this for only one reason. You know what is that reason? When you are calculating minority interest, okay, you calculated minority interest already. Okay, imagine this is current year minority interest. How you did that? First you did, what did you do? You will get equity share capital, capital profit, revenue profit, everything you will put. Next year, will the minority interest change? Yes. If you make profit, they will also get one share. So minority interest will go up. If you get loss, minority interest will go down. Can you see? huge losses are incurred. This question is in study material also. So minority interest can't go into negative. Okay, cannot go into negative. For example, if you see what is the share capital over here, had equity share capital, they have asked you to calculate goodwill capital reserve. That I am not doing. That you should be able to do. 50 lakh is the share capital. Reserves and surplus is 4,64,000. So 50 lakhs into what is the shareholding? 20% for minority interest. This makes it 10 lakhs. This makes it 10 lakhs. And what is the reserves and surplus? 4,64,000 into 20%. 90,000? 92,800. So right now minority interest is 10 lakh 92,800. I made a loss, 14 lakh 50,000 loss. So what will happen? 14 lakh 50,000 into 20%. 2 lakh 90,000. Remove. Now your minority interest has gone down. 10 lakh 92,800. 8 lakh 2,800. Still you are in positive only, yeah? Okay, now what happens? 23 lakh 20,000 is a loss. 23 lakh 20,000 into 20%. 4 lakh 64,000. Remove that loss. 4 lakh 64,000. 3 lakh 38,800. Still minority interest is positive only. Now you see next loss is 29 lakhs. 29 lakh into 20%. 5,80,000 loss. Correct? This will become 0. Minor interest will become 0. So 5,80,000. Now 241,200 is there? No. This will be borne by holding company. Here 241,200. Extra loss of minority interest will not be put into minority interest. It will be borne by holding company. Now it will continue like that only. Whenever they start making profit, whatever was adjusted with holding company, that will first be reversed, then the profit will be given. Okay, I can quickly show it to you over here itself. Can you see? They have made some nice table and all. I only can't understand where that number is. 241,200. 241,200. Can you see here? Loss is adjusted. Then next time what happens? Again there is a loss only, no? 1,39,200. Again it is adjusted. So total is 380,400 what holding company has taken. Again loss only 38,000. Because 2021 what has happened? 1,90,000. 1,90,000 into 20%. 38,000. What they have done now? This much loss was taken by holding company. 38,000 is removed and still it is 342,400. Minority interest is still nil. Can you see nil over here? Yes. After that they made profit of 680. 680 into 20%. 1,36,000. 1,36,000 is adjusted and still there is a loss of 2,06,400. Then they made a profit of 12,70,000. 12,70,000 into 20%. 2,54,000. That time 2,54,000 minus the old loss 2,06,400. 47,600 is minority interest. Can you see? When there is negative, it will not be taken. It will be put into holding company's head. After that, what happens? Again and again, when there is, it will keep getting accumulated. When you make profit, don't start putting positive here. Remove all the negatives, then you will become positive again. Is this clear? This is one question which was asked. And guess what? This question was asked for 15 marks. Yeah, but the other day when I was seeing the material, no, the question paper, I saw that it's actually 15 marks. Even I thought it was 8 marks. 15 marks they have asked. 15 plus 5 was that question number. Nothing. Good, no. But they will not ask. Don't worry. They will not ask this for 15 marks now. Old scheme they asked. And when they asked in old scheme, you see, November 2023, last attempt of old scheme, take one gift they gave and told go. Okay, now that is it, guys. That is it with the consolidation. We have finished consolidation successfully. We'll take a break for some 10 minutes. Okay, 10 minutes break we'll take. And we'll start with financial statement after that. 15 minutes you take break and we'll start with financial statement. Okay guys, let's begin. Let's continue with the next thing. Okay, after a short break, we are back in the marathon. Day 1. Preparation of financial statements is the next thing. Okay, you need to know the format. I'm not discussing the format so much in detail, but you need to know the format. Certain things. Okay, I'm going to discuss that. 1. Always share capital when you prepare a note. You need to have the authorized capital. Authorized capital should be there. Clear? Issued, subscribed, called up capital should be there. Issued, subscribed, called up capital. If at all calls in arrears is given in the question, minus the calls in arrears, you will get the paid up capital. Issued, subscribed, called up capital minus calls in arrears, you will get the paid up capital. Clear? Calls in advance will not affect your share capital. It will go directly into other current liabilities. Calls in advance will not get added to share capital or something. It will go to other current liabilities. Long-term borrowing, short-term borrowing. We know what to do. Amount payable within 12 months, short-term borrowing. Amount payable after 12 months, long-term borrowing. Debentures are issued 5 lakhs on 1/4/2022. Redeemable after 5 years. First 3 years you will be calling it long-term borrowing. The last year when only 12 months are left for payment, no, within 12 months when you will call it as short-term borrowing. Loan borrowed 5 lakhs. Payable in equal half-yearly installments. So 50,000 into 2. Now see, understand this. This question they asked in MCQ in one of the previous exams. Loan borrowed 5 lakhs. Payable in equal half-yearly 10 installments. Half-yearly 10 installments. That means 2 installments are due within 12 months. 8 installments are due after 12 months. So 1 lakh will be taken as short-term borrowing. 4 lakh will be taken as long-term borrowing. Is this clear? Now, long-term provision, short-term provision. Amount set aside, payable after 12 months, long-term. Payable within 12 months, short-term. You kept money aside to pay tax, short-term. You kept money aside to pay something in future, that is going to be long-term. Yes, trade payable, 3 things we are going to discuss together. Trade payable, other long-term liabilities and other current liabilities. Okay, now imagine you're doing furniture business. You're doing furniture business. Purchase of furniture. If it is on credit, payable in 3 months. Purchase, your business is what? Furniture only. And you have purchased furniture payable in 3 months. Then it is within 12 months, no, trade payable. If you are going to pay in 15 months, that is after 12 months, no, it is also trade payable, but trade payable is not there on the non-current liability part. So you will put it into other long-term liabilities. Is this clear? Other long-term liabilities. See, if you have to pay after 12 months, it is trade payable only. But if you have to pay after 12 months, it becomes a non-current liability. Non-current liability falls into, in that you will put it into other long-term liabilities. It won't be a borrowing. It won't be a deferred tax. Clear? Now, if you purchase computer, your business is what? Furniture. You purchase computer on credit 3 months. Within 12 months, no. But still you will not call it as trade payable. It will be called as other current liability. It is not your trade only. Computer is not your trade itself. You cannot call it as trade payable. You will put it into other current liability. But if you have to pay after 15 months or after 12 months, it will become other long-term liabilities. Clear? Capital work in progress. If your building looks like this, it is property, plant and equipment. But if your building looks like this, it is capital work in progress. That means one floor is still getting constructed. If your chair looks like this, property, plant and equipment. But if your chair looks like this, it is capital work in progress. That means still you are constructing that one leg. Okay. Non-current investment and current investment. Now here it's about intention. Intending to hold to be sold within 12 months, current investment. You are planning to sell it after 12 months, non-current investment. Clear? Other non-current assets. Other non-current assets, other current assets and trade receivable. Same logic again. You are selling cookies. Okay, you are selling cookies. Okay, sold. Credit sales, 3 months, trade receivable. Credit sales, more than 12 months, it will not be trade receivable because trade receivable is sitting under current asset. You have to put it under non-current asset. So you'll put it under other non-current assets. Clear? But if you sell the cookie making machine only, and you're going to get the money after 3 months, other current asset, because selling the machine is not your business. Selling the machine is not your business. Selling the cookies is your business. Clear? After 12 months, other non-current asset. Is this clear? Now, when to prepare a note? When you're preparing financial statement, you always get this doubt, no, when to prepare a note. Understand this. Whenever there are multiple items, you have to prepare a note. There is no doubt about that. But when you have single item also, you will have to prepare a note if it gives you extra information. Clear? When there are multiple items under a sub-heading, or when there is only one item under it and it provides additional information. For example, long-term borrowing is the heading. Under that 12% debenture, borrowing can be from anybody. So now 12% debenture is giving you some extra information. Prepare a note. Financial statement chapter, they are testing your format. They are not testing too much concepts here. They are testing your format. So you have to prepare a note. Trade payable, they told creditor, you can avoid the note. Because trade payable, they are not giving you extra information. Trade receivable, debtor, you can avoid the note. But if they tell you debtor, due for more than 6 months, due for less than 6 months, extra information, you have to prepare a note. Clear? Yes, as per schedule 3, dividend declared, no entry. You see dividend declared, just ignore it in the additional information. Dividend declared and paid, then only you will pass the entry. What will be the entry? P&L or general reserve account debited to bank account. You are just making the payment. Okay. Now, next. P&L. Okay. Subtracting reserves and surplus note. Now, tell me one thing. Some important things that you have to understand. Opening stock is given in the trial balance. Okay. And then closing stock will be given outside the trial balance. Opening stock is given in the trial balance. It will go to changes in inventory. In the P&L, it will go to changes in inventory. Purchase is in the trial balance. You will put it into purchase of stock in trade. Closing stock is given in the adjustment. Then it will go into changes in inventory, and in balance sheet you will show it as inventory. Clear? Now if you see adjusted purchases in the trial balance, you see something called as adjusted purchases. Adjusted purchase means already the stock is adjusted. Opening stock and closing stock are already adjusted. Stock is adjusted against the purchase. So closing stock will be there in the trial balance. If you see adjusted purchase, closing stock will be inside the trial balance, not outside the trial balance. If it is inside the trial balance, directly you will put it into closing stock, balance sheet, directly balance sheet. Clear? So how do they do this adjusted purchase? They'll pass an entry like this. Purchase account debited to opening stock. That means opening stock is removed. Opening stock is removed. You are just adding it to purchase itself. Closing stock account debited to purchase. This is how the purchase gets adjusted. Clear? Now you think about one thing. In the question, if you see closing stock in the trial balance, then no changes in inventory and all. Straight to balance sheet. If you see closing stock outside the trial balance, then opening stock will be inside the trial balance. Then you have to do changes in inventory. Is this clear? Bad debts. Amount not recoverable, that you already know. Okay. Bad debt account debited to trade receivable. The entry. Provision for bad debt. P&L account debited to PBD. That is the entry. If there is PBD, remember a movie fund which we are talking about? If there is a PBD, then PBD account debited to bad debt. That means bad debt will be removed from PBD. Bad debt will not go to P&L. It will not go to P&L. You have provision, you take it from provision. If there is no PBD, then bad debt will go to P&L. Clear? That should be it. Okay, that's it I wanted to discuss. Format you should know. I'm not teaching the format now. Now, CA Inter, September 2024 question. They asked for only 14 marks. Only 14 marks they have asked. Okay. Now, let's quickly discuss this. Now, understand this. Okay. Tell me, small thing. What did they tell? You are required to prepare Shivam Limited's P&L account for the year ended and balance sheet as at that day as per provisions of the Companies Act 2013. After considering the above information, ignore previous year figures, they said. Whatever has adjustments that we will discuss, other things we are not going to discuss in financial statement. Land, where will it go? You have to tell me the headings. Land, where will it go? Property, plant and equipment. Plant and machinery, where will it go? Property, plant and equipment. Debtors is nothing but trade receivable. Closing stock in the trial balance. Directly it will go to balance sheet as inventory. Bank, cash and cash equivalent. Adjusted purchase directly. So you will put it into purchase of stock in trade. Factory expenses. Factory expense you can put directly into other expense because you don't have cost of material consumed. Okay. Administrative expense, other expense. Selling expense, other expense. Debenture interest, finance cost. Finance cost. Total, nowhere you will put it. Okay. Equity share capital. This is share capital. 10% debentures. No, 135, no. 135. Long-term borrowing. Yes, correct. Long-term borrowing. 135 into 10% is how much? 13.5. How much you are seeing here? Debenture interest. Oh, that means 0.5 is correct. Prepaid. 0.5 is prepaid. I don't know whether they have given it intentionally or not. Okay. General reserve, reserves and surplus. P&L, reserves and surplus. Securities premium, reserves and surplus. Sales, revenue from operations. Creditors, trade payable. Provision for depreciation, minus in PPE. Subtract it in PPE. Suspense account. Oh, if suspense is there, that means there is some mistake. Okay, let's see. It should be taken as prepaid actually. Yeah, it should go. We'll see what they've done. On 31st March, the company issued bonus shares to the shareholders on 1:2 basis. One equity share as bonus for every 2 shares held. No entries relating to this has been made. How much is the share capital? 200. 200 into 1/2. That means 100 is the bonus. Clear? We have general reserve 90. We'll take from general reserve and we'll take it from P&L. Let's address this point before going further. Okay. Now, can you see share capital has become 300 after bonus? Okay. Reserves, we have to see the note only. Can you see the note here? Add bonus shares 100 and it became 300. Then reserves and surplus you can see. Okay. Securities premium. Securities premium was there, no, in the question 27. Remember, bonus issue, first preference CRR, not there. Second preference securities premium there. So 27 is removed from securities premium. Securities premium became 0. You still need 73, right? 73 you removed from general reserve, it became 17. Clear? Bonus issue, no problem. We are not passing entries, but we are giving the effect in the financial statement itself. Next, the authorized share capital of the company is 35,000 equity shares of 10 each. Where will you put it? Just information. See, in the additional information which you are giving, no, 2 types are there. One, just info. Just tell them, that's all. Another, adjustments. That you will give 2 effects. Clear? Now, see here. Authorized capital, you will just tell over here. And can you see this underline over here? Why? Because it's not considered for the total, just for information. Next. Company on advice of the independent valuer revalued the land at 245. How much is the land right now? 148. That means land value has to go up. You can see it in property, plant and equipment. Can you see added revaluation is added over here 97. Other effect for this revaluation will be what? It will be there in reserves and surplus as revaluation reserve. Where is it? Where is it? Where is it? Oh yeah, here. Revaluation reserve directly 97. Is this clear? Double effect given. Next, after that, the directors declared a dividend of 10% on 5th April 2024. Very good. You should declare dividend and we will ignore you. Okay, and also transferred profit at the rate of 10% to general reserve. This you will get the amount at the end. When you finish P&L, you will get the amount. Whatever profit comes, transfer from P&L. Can you see they have done 7.07? Whatever profit comes, 7.07 they have transferred. See, profit for the period is 70.7. That's why they have removed 10% and they have put it to general reserve. General reserve we are adding, from here we are removing. But you are not getting the number now. You will get the number when you finish P&L. P&L end you will get on profit for the period, 10% transfer to reserves. Clear? Next. Suspense account of 3,000 represents cash received from sale of some machinery on first day of the financial year 2024. Why they are telling first day? Because there is no need to calculate depreciation till the date of sale and all. First day only sold. No depreciation on this. Now, cost of this machinery was 10,000. Accumulated depreciation is 8,000. Now you have to remove 10,000 from cost and you have to remove 8,000 from accumulated depreciation. And 2000 is what? 2000 is the value you sold for 3000. 1000 will be profit or loss. I'm asking you, profit or loss? It will be profit. 2001 you have sold for 3000. Other income. Where is your other income? Oh, can you see here? 1. Profit on sale. 1. Now PP, you have to be careful. Can you see PP? What is happening? Plant and machinery cost 10 is removed. Plant and machinery accumulated depreciation 8 is removed. Can you see 8 is removed over here? Clear? Yes. Then after that, depreciation is to be provided and suspense will go, obviously. Suspense will go because you have rectified the error. Depreciation is to be provided on plant and machinery at 10% on cost. What is the plant and machinery value here? 520, don't take it. 520 out of the 10 is gone, no? 510. On 510 you will calculate depreciation, that makes it 51,000. 51. And depreciation also has to be shown in one more area, that is depreciation and amortization in the P&L. 51. They are also lazy. They have not prepared notes too many, only few notes they have finished and suggested answer. Suggested answer is just suggested. They have told before. I see it. Okay, next. Provision for income tax is required at the rate of 30%. From where will I get this? When I finish my P&L, I will get 101 over here, profit for the period. Okay, 30% you are going to remove 30.3. 70.7 is there. This 70.7 only 10% we transfer to reserves. 30.3 will also go to one more area, short-term provisions. You didn't make the payment, you just provided short-term provisions in the balance sheet, 30.3. Rest of the things are coming direct. All the adjustments whichever are there we discussed. Clear? I don't think we should spend too much time on this. Now you know. Rest of the things fill in the blanks. So I'm not talking about it. Next, second. See, enter July 2021. Little older. Okay. Few adjustments are there. You are required to prepare balance sheet and P&L. Very, very good. 20 marks only they have asked for. Okay, 20 marks. Yes. Now they can't ask because that was 100 mark paper. Now it is 70 mark paper. 30 mark is MCQ if you are thinking for how it became 70. Okay. Yes. Equity share capital will go into share capital. Okay. If you have solved financial statement, when you see this 8,05,000 only, something will trigger in your head. Something will trigger in your head when you see this 8,05,000. That is one error which is there. Out of this 5,000 will go to capital reserve. Exact question is there in the study material. 5,000. If it doesn't trigger, we will trigger it. Wait. Now, preference share capital will go to share capital. Debentures will go to long-term borrowing. General reserve, reserves and surplus. Profit and loss of previous year, no problem. Reserves and surplus. Sales, revenue from operations. One second. One thing I wanted to see in the previous question. Yeah, that's what I'm saying. No, they have put full only, man. Prepaid they have not done. Actually, it should be prepaid. No. Prepaid they have not done. Actually, if you calculate and see, it will become, what do you say? Maybe last year's outstanding is paid this year or something, but still it will not be 14. No. Last year's outstanding, if it is there, it will be minus. No. Huh? Note, they have also not given any note. Okay. Some final dividend only they have given note, that we already know. Bonus shares they have given note, that we already know. Alternatively, they have given the notes here. Alternatively, since the amount of interest is 135, debenture comes to 13,500, while the debenture interest in the trial balance is listed as 14,000. Difference of 500 may be treated as advance payment. That's what I was telling you, prepaid. If you treat it as prepaid, it will go into other current assets, and finance cost will only be 13.5 or 13,500, whatever that is. Is this clear? They have not solved it, but they have told alternative. Actually, alternative only is the real solution. Alternative is the real solution because you are following accrual concept. Clear? Okay, next. Yeah. Let's go to the next one, guys. Revenue from operation. Trade payable will be trade payable. Provision for depreciation will be minus from PPE. Suspense account again. Oh, very good. So, two errors, that means. Already we know that 8,05,000. What does it look like? 40,000. Yes. Land at cost. PPE. Property, plant and equipment, PPE, trade receivable, inventory, 31st of March 2020. No. ICAI made errors here. This should have been given as 31st of March 2021. It's closing stock only. ICAI made error. They would have given grace marks in July 2021. See, 31st of March 2020. No. 20 marks. Instead of that, they will directly make you pass only, instead of giving 20 marks grace. Okay, 31st of March 2021 it should be. They put the star and they corrected it in the suggested answer. Now inventory is there. Closing stock is there in my trial balance. Where will it go now? Directly it will go to balance sheet as inventories. Bank is cash and cash equivalent. When closing stock is there in my trial balance, I know that the purchase is adjusted purchase. Can you see adjusted purchase here? You will write it as purchase of stock in trade. Factory expenses, other expenses, admin, other expenses, selling, other expenses, debenture interest, finance cost, goodwill, intangible. Now, tell me one thing, debentures are there, 4 lakh into 9%, 36,000. This time it is matching. This time you don't have alternative solution. Okay, now we'll go in order. Authorized share capital of the company is 5,000 preference shares of 100, 10,000 preference shares of 100. Is this an adjustment or additional information? It's just an additional information. Then go and put it, that's all. Throw it on the face. Let it be there. Okay, adjustment, 2 places. Why? Double-entry system of accounting. Now, let's see. Authorized capital. Can you see? Just a presentation over there. Next, issued equity shares as on, issued equity capital as on 1st April 2020 stood at 7,20,000. That is 6,000 shares of fully paid and 2,000 shares 60 paid up. Same adjustment is there in study material. Same adjustment. The directors made a call of 40 per share on 1st October. Shareholder could not pay the call of 100 shares and his shares were then forfeited and reissued at 90 per share as fully paid up. Clear? Now, if you don't remember, I have to remind you now. Okay, now 6,000 shares fully paid up. That means 6,000 into 100 makes it 6 lakhs. And 2,000 shares 60 paid up, that makes it 1,20,000. So this becomes 7,20,000. 7,20,000. Can you see? They said the share capital was 7,20,000 at the starting of the year. Now after that, what happened? I thought I had not pressed the recording itself. Okay, 7,20,000. Then after that what happens? They made a call of 40 per share. 40 per share, 2,000 shares into 40. When you make the call, you pass the entry, equity share final call account debited to equity share capital. Whether you received or not, you already put it to equity share capital. This becomes 80,000. That means my share capital has touched 8 lakhs. My share capital cannot go to 8 lakh 5. My shares only are 8,000. If they are all fully paid up also, it should be 8 lakh only. But share capital is showing 8 lakh 5. So now what happens? 8 lakhs. Now they said what? Shares are forfeited. If shares are forfeited, okay, what will you do? You will write equity share capital account debited. Now it is 8 lakh, no. Equity share capital account debited. How many shares? 100 shares. 100 shares into 100. That gives you 10,000. This makes it 7,90,000. This makes it 7,90,000. Clear? Then it is reissued. When it is reissued, if it is reissued at 90 also, we will still do 100 into 100, 10,000. This will still be 8 lakh only. Because if it is reissued also. What is the entry for forfeiture? Equity share capital account debited. To share forfeiture account to whatever, calls and areas or final call. Correct? When it is reissued, bank account debited 90, share forfeiture debited 10 to equity share capital account. Full face value will go to equity share capital account. Now, how much profit did we make when we cancelled the shares? How much profit did we make when we cancelled the shares? How much did they pay? 60 rupees was paid. So 60 rupees is the profit when we cancelled. How much loss did we make when we reissued the shares? 10 rupees. So net we made a profit of 50. How many shares? 100, 5,000. Whatever is remaining after forfeiture and reissue. whatever is remaining after forfeiture and reissue should go to capital reserve, should go to capital reserve. Therefore, what they did, full 8 lakh they have put there only. So if you see the solution now, 8 lakh only will be there in equity share capital. Can you see? And 5,000 is sitting in capital reserve. This is the rectification which is not told directly, but it's there. Are you getting this? Okay. Now, suspense account of 40,000 represents amount received on the sale of some of the machinery on 1/4/2020. Starting of the year, cost of the machinery was 1 lakh and accumulated depreciation thereon being 30,000. Cost of the machinery is 1 lakh and accumulated depreciation thereon being 30,000. What will you do? 1 lakh you will remove from the cost, 30,000 you will remove from the depreciation, but that makes it 70,000. You sold for 40,000. That means 30,000 should be shown as loss on sale. 30,000 will be shown as loss on sale. Let's find it in the P&L. Other expenses, you should find it. Where is it? Loss on sale, 30,000. Only adjustment related things we are discussing, 30,000. Is this clear? No. Let's go further. What we have to do now? 1 lakh we have to remove from cost. Let's see property, plant and equipment. 1 lakh disposed of. Correct. Depreciation. How much is the depreciation in the question? Depreciation is, where is that provision for depreciation? 172. So here they have not shown the calculation. 1,72,000 minus, how much is the provision that we calculated? I mean, how much is the provision for depreciation? Where is it? Where is it? Down. Oh, next page. We missed something. Huh? Declare. We'll discuss that. Okay. 30,000 is the accumulated depreciation. So minus 30,000. That makes it 142. But there is depreciation to be charged. There is depreciation to be charged. They have told depreciation 10% on cost. Cost is how much now? 770. That means 76,000. So plus 76. Sorry, 670. 67. This becomes 670. No, 6,70,000. 67,000. 172 minus 30 plus 67. 209. Can you see the depreciation being 209? Are you getting this? 172 is the opening balance. From that 30,000 is the depreciation on the asset which is sold. So you are removing 30,000. Then 770 minus 1 lakh is 6,70,000. On the 10% depreciation is 67,000. Okay, same thing was there in the previous question also, but numbers are different obviously. Okay, and I think I missed one adjustment over here. Land is revalued at 36 lakhs. I think land is showing 24 lakhs. Land is showing 24 lakh. So 12,000 you're going to add over here to the property, plant and equipment, and you'll also show it in reserves and surplus, revaluation reserve. Then they told one more thing. 31st March 2000, directors declared a dividend of 5% on equity shares, transferring any amount that may be required from general reserve. They declared we will ignore them. Okay. Depreciation done. Amortize 1/5 of the goodwill. What was the goodwill? Last thing in your trial balance was the goodwill. 12,50,000. 12,50,000 into 1/5 is 2,50,000. We'll go and sit in depreciation and amortization. Depreciation and amortization. Can you find it? Yes, 3,17,000 is there. 2,50,000 is this one, and 67,000 is the depreciation which we charged. That is 3,17,000. Where is the 67,000? Just now in PPE we saw 67,000 depreciation for the year. Clear? After that they have told. No? Sorry. Yeah. Depreciation amortization. Yeah. They didn't prepare a note. Did they prepare note? 9. Yeah. They prepared note also. See, the working was there. Both of them are there. Okay. Loss on sale and all we have done. Rest of the things are direct. Rest of the things are direct. We don't have to worry about it. Clear? This is very important. Understand this. This equity share capital 8,05,000. This adjustment is there. No. So many places they have repeated in RTPs, in mock tests, in past examinations also. And this suspense account information is there. No, this they have repeated with different numbers. Numbers have changed. Sometimes you're getting profit, sometimes you're getting loss. Clear? Yes. Next, we'll go into the third question. See into November 2023. No. See, we'll go to reserves and surplus. Oh, they have done it, okay, dividend declared, but you don't do it because it's an old question, right? What is the, see, July 2021. That time this thing was not introduced by this thing, Schedule 3. Now you don't declare, because if you see the previous question was a latest question, no? Recent question. See, final dividend will not be recognized as a liability at the balance sheet date, even if it is declared after reporting date, but before approval of financial statement as per accounting standards. Hence, it has not been recognized in the financial statement for the year ended. Such dividend will be disclosed in the notes only. That they told, that's what I'm told, and that's what I'm telling. Earlier they used to do it. Okay, earlier. This is 2021 wala question. No. Here they are doing it, but right now. No. First question we didn't do it. That is to reserves. That is not dividend. We took money from P&L and put it to reserves. That is not dividend. Here what they have done in this question, they have removed from this thing for dividend itself. Can you see less dividend declared? That is not there now. That is not there now. That's 2021. Then they have amended Schedule 3 only. Okay. And anyways, recent question was September 2024. There they told don't do it. Don't do it. Next, we'll go to the third question, guys. Financial statement, November 2023. Okay. Only little adjustments are there. Sir, this is midterm mock question. Oh, is it? I don't remember, man. Okay, equity share capital will go to share capital. Preference share capital will go to share capital. General reserve, reserves and surplus. This is long-term borrowing. Securities premium, reserves and surplus. Land at cost. PPE, plant and machinery, PPE. Furniture, PPE. Provision for depreciation minus from PPE. Provision for depreciation again minus from PPE. Trade receivable is trade receivable. Trade payable is trade payable. Cash and cash equivalent. Cash and cash equivalent. Bank overdraft from nationalized bank long term. They only told long term borrowing. 6% secured loan from State Financial Corporation repayable after 3 years. Long term borrowing. But in long term borrowing, trying to show separately that secured, unsecured. Separately you show it. Unclaimed dividend. Other current liability. We told come and collect the money, but nobody came. They were somewhere outside. Okay, so they never turned up. So other current liability. Loan from director, short term borrowing. Adjusted purchase of stock in trade. Closing stock in the trial balance. Directly inventory. Sales, revenue from operations, carriage inward. Other expense, only if you have cost of material consumed, you would have taken it, otherwise directly other expense. Miscellaneous expense, other expense. Selling and distribution, other expense. Depreciation, not other expense. Depreciation and amortization. Salary, other expense. Employee benefit expense. Director's fees, other expense. Traveling expense includes 50,000 for foreign tour. You go foreign tour, you go to space also and come back like Sunita Williams. No problem. It is other expense only. But because it is given foreign tour, you can tell traveling expense, foreign, domestic. Foreign, domestic, you can show the bifurcation. That's all. P&L, reserves and surplus. Office expense, other expense. Rent received. Shabash, other income. Other income, rent received. When you see rent, we don't decide. Okay. Yes. Authorized capital divided into 20,000 equity shares of 100 each and 10,000 preference shares of 100 each. Information. Where will I show the information? I will just go and prepare notes and show the authorized capital and end the story over there itself. Then they have told equity share include 2,500 equity shares for consideration other than cash. Information in share capital, right? Just write of the above 2,500 shares have been issued for consideration other than cash. Information, you are going to present it. Clear? Then after that, company has land professionally valued and decides to include it in the balance sheet at its valuation of 8,50,000. How much is the land right now? Oh land, where are you? 7 lakhs. Okay, now the land is becoming how much? 8,50,000.
So where will I show? Revaluation reserve, can you see 1,50,000? And land will be shown in PPE note at 8,50,000. Okay, next. It is proposed to capitalize part of the undistributed profit by making bonus issue to shareholders by allocating one equity share of 100 each for every 5 shares held. What entry to be passed? Twist of the ICAI, they told. Since bonus issue is in proposal state, no adjustment has been made in the given answer. Are you seeing this? Huh? Actually, they make sense. They are not bluffing over here. They make sense. What did they tell over here? It is proposed to capitalize part of the undistributed profit. Did I approve as a shareholder? No. They didn't tell bonus issue. Proposed. Proposal rejected. Focus on exams. Are you getting my point? If it was issued, we have already done in the first question. Undistributed profit means free reserves. You would have issued bonuses. We did in the first question. Remember, 37,000 or something was removed from securities premium, then remaining we removed from general reserve and we issued bonus. They said proposed to be capitalized. They didn't pass any bonus entry because they proposed. No, ignore. Trade receivable of 46,000 due for more than 6 months. Remaining everything is due for less than 6 months. Information, we will find it in trade receivable note. See, due for more exceeding 6 months, remaining everything is due for less than 6 months. Other debts, they said. There is no doubtful amount. Okay, very good. Depreciation expense include depreciation of 1,10,000 on plant and machinery, 70,000 on furniture. Again, it's information only. What we are going to do in our depreciation and amortization, you're going to show it separately. And in your PPE note, what we are going to do, we are not going to do any minus because already the minus is done. Provision is there. In the provision, it's included. We don't know, sir. What is happening, sir? Can you see anywhere depreciation? Already depreciation is in the P&L. That means depreciation amortization. If depreciation was outside, then I have to put it into depreciation and amortization also and subtract also. Now already it is passed, the entry is passed. You will show what? Only depreciation amortization and we will subtract the full provision from the PP. Provision is already there. Now see, once upon a time you studied one chapter called as depreciation. In that there are two methods to record depreciation. Key. First method is depreciation account debited to asset account. Second method is depreciation account debited to provision for depreciation. That means in this provision already the depreciation which we are talking is added. How do we know, sir, it is added? Because depreciation is inside the trial balance. That means entry is passed. If it was outside the trial balance, we would have passed double entry. Clear? Yes, I hope it's clear, guys. Next. Cash at bank includes 55,000 with Desire Bank Limited, which is not a scheduled bank. What will you do? Presentation again. Go to cash and cash equivalent. Okay. Cash at bank with scheduled bank with others. 55,000 is others. Remaining everything is scheduled bank. Clear? Only presentation. Miscellaneous expense includes 5,000 being audit fees paid to auditors. So what you will do in your other expenses, audit fees you will show here and miscellaneous expense you will remove 5,000. It is no longer miscellaneous because I know it is audit fees. Are you getting my point? That's why I separate and show it. Next, after that, bills receivable for 35,000 maturing on 31st July has been discounted. Contingent liability. Contingent liability. There is a contingent liability for bills discounted but not yet matured amounting to 35,000. We always should show contingent liability. AS29, we'll discuss it tomorrow again. AS29 contingent liability should be shown on the foot of the balance sheet. They have shown it. They have written the information. Clear? Next, balance of secured loan from State Financial Corporation is inclusive of 36,000 of interest. Interest should not be there with the long-term borrowing. You should remove the interest and show it as other current liability. Interest on debentures under other current liability. Can you see 20,000? Sorry. 36,000. SFC is 36,000. And what you should do in long-term borrowing, you should remove the 36,000 and show it.
Otherwise, it will not tally balance sheet. That's all. Both the places you are showing 36,000. Yes, doubt. No. Okay. 4,50,000 is there, including 36,000. Remove 36,000. Show it as current liability. Remaining will be shown as long-term borrowing itself. Clear? Next, after that, directors declared final dividend on 6th April. Very good. They should declare like that only, and we should ignore it. Transfer any amount that may be required from general reserve. This is also old. November 2023. Let's see if it's done. Yes. Can you see anywhere? Reserves and surplus. I think by now the dividend, that rule change has happened. There is no minus dividend over here. It was there in the previous question. It is not there over here. Clear? So just ignore it. Then interest on debentures for the year is outstanding as on 31st March 2023. You are required to prepare balance sheet. Did we have debenture in the question? How much is my debenture? Where are you? Debenture. Oh, debenture. Where are you? Yes, 2 lakh. 2 lakh into 10% is 20,000. Anywhere in the question we didn't find finance cost at all. Debenture interest was not there. So what we will do, we'll take 20,000, add it as outstanding interest. Then you have to show 20,000 as finance cost. Both the places done. Clear? Huh? Did you get up from sleep? They said interest on debenture is outstanding. We are not paying. It is outstanding. What is the confusion? I know battery is low. Because it is outstanding and I'm still showing in P&L, it's called as accrual concept. Are you getting my point? We are not showing in P&L only if it is paid. If it is payable also we show it in P&L. We will still show it, yes. 2 lights, they are there from morning. It didn't come now, okay? You are required to prepare balance sheet, that's it. Other things are all directly, you are going to enter it. That is it, guys.